Why give up a love found? Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely
To work from anywhere in the world and build the life you've always wanted. If you're serious about building a six-figure online business, then you need a roadmap. And that's exactly what our
just to walk away.
不動産投資をご検討の皆様、不動産投資なら楽マッチ収益部。
It's Friday, so it's time for a pizza party. We are following two analyst upgrades today. One for Domino's out of BMO and one from Wedbush for Fubo TV. Let's start with Domino's here because there's a lot to really look into here, particularly as we're seeing the stock react by about 3%. They've set a new price target. $430 is that new price target, and they've got an outperform rating on the stock. There's been a lot of chatter around Domino's over the past couple sessions. We had also seen even more from Deutsche Bank. They had lowered their price, actually. Their price target now $373. So kind of some mixed reviews here coming in on the pies, if you will. But this larger kind of annexation to some of the kind of restarts of social functions and events. Domino's Pizza, of course, continues to be one of the core brands that is a net beneficiary of events coming back together, the start of football season, even though the partnerships with different leagues, those are highly coveted partnerships. And for Domino's, it's a larger question of how will they continue to navigate through everything from some of the input costs for just making a pizza or menu innovation, perhaps? All right, well, we won't get into the menu innovation conversation here today. But I think for Domino's and where the mixed takes have been, there's still a lot of opportunity for leaning into the digital customer and that annexation that they've really pioneered that connection point in the pizza category with too.
What do you eat when you're watching football?
What do I eat when I'm watching football? Usually wings.
Pizza?
Pizza. I love tater tots. I love tater tots when I'm watching football.
See, I don't think about pizza and football in my brain, but I'm not a football fan, so I think about wings and football.
Yeah,
Or like nachos in football.
Nachos and football, that's good. My first ever job was actually at a sports grill where every Sunday people would just line up, get the wings out of Westchester, Pennsylvania, Stadium Grill, and yeah, I was all about the wings there.
Oh, I'm getting an affirmation from our producer who is a big football fan. Nachos and football is good. Thank you very much, Val. Let's talk about that other call real quick here that we had on Fubo. Speaking of football, on Fubo TV here. This coming from Michael Pachter over at Wedbush, who is upgrading this to outperform from neutral. The stock has really plunged this year, so part of it has to do with valuation, that there's an attractive entry point here. According to Pachter, Fubo TV has a solid head start in offering live sports programming to its subscribers, thriving and growing advertising business. The issue of the business has been cash burn, and so he talks about that the company needs to focus on raising capital and cutting its cash burn to extend its cash runway. He says, we're confident the company can do both, although there could be some dilution from any kind of capital raise.
Get you a streaming service that can do both. I mean, at the end of the day, for Fubo as well, and I think they make a great point when it comes to the sports rights and being able to have that streaming capacity. Sports is going to be a major kind of opportunity that Netflix is not going into getting sports licensing outright. Sure, there are other ways that they're trying to backfill for all the lost 30 for 30 content, but at the end of the day, for the sports rights that have been continued to be either competed for, or whether that's by an Amazon and Thursday Night Football, or whether that's even by an Apple, which we'll talk about a little bit later on, I think there's so much opportunity for the annexation of streaming to sports. It's really just a matter of how much all of these brands in the streaming space are willing to pony up for that new customer acquisition, and hoping that they'll consume some of the other content that they're paying millions, if not billions of dollars to produce over time too.
Yes, indeedy.
Yeah. Guys, coming up, which housing markets are holding up the best, and I guess on the other side of that, the worst? We'll break down that with UBS Home Builders Analyst coming up next.
暗号資産交換業者財富からの提案です。リスクはありますが、資産運用や投資は一般的なものとして認識され始めています。投資の基本は安く買って高く売る。この基本を暗号資産取引で自動で繰り返すのが暗号資産交換業者財富の提供する自動売買お手軽トレード。暗号資産投資初心者でも簡単。難しい価格設定は必要ありません。どの暗号資産をどれだけ下がったら買い、どれだけ上がったら売る。設定はとってもシンプル。売りと買いの設定をするだけで、あとは自動で売買を繰り返す。老後資金対策も財富の自動売買お手軽トレード。
Welcome back to Yahoo Finance on this Friday. I'm Brad Smith alongside Julie Hyman. Brian Sazi is on assignment. We'll be back next week, though. About 30 minutes into the trading day here on this Friday, let's check in on the markets. Not so yay there. In fact, it's a nay. Now, Dow Jones Industrial Average has slipped lower, and it is down by about 1.4% at this point in time, 428 points, the negative territory. The S&P 500, you're also seeing that down 1.8%, and the NASDAQ Composite also lower by 2% for the tech-heavy average. We're going to continue to track that very closely, and coming up in this hour as well, Qualcomm revving up its partnerships, announcing a deal with Mercedes-Benz for its upcoming vehicles. We'll be joined by an executive from the company. And one of the largest U.S. crypto exchanges getting a major leadership change. We talk with Dave Ripley, who has been tapped as the newest CEO of Kraken. And Yahoo Finance's Brian Sazi caught up with Slack's chief product officer and talked all things return to work. You do not want to miss that. But first, let's get on over to Julie Hyman at the Yahoo Finance Interactive.
Hello there. I want to start with oil prices, actually, because the move that we are seeing today is fairly remarkable in oil here. Right now, down almost 6% for WTI, below $80 a barrel. So that's the first time we've seen going below that threshold in quite some time. Here you have the 3-month chart for crude oil prices. And this is really feeding over into what we are seeing in terms of the groups within the S&P 500 as well, as I'm trying to figure out how to get us to the sectors here. I'm going the wrong direction, apparently. Here we go. As we go down to the sectors, we are seeing energy stocks really under pressure here. Energy stocks down about 6% right now. They were down as much as 6.4% as a group earlier in the session. So this, again, I really want to put a fine point on this. This is the best performing group of the year. We have been seeing oil prices slide. Gasoline at the pump has slid, as we've talked about before, for 100 straight days before pausing in that slide. But if this is any indication for what we are seeing with oil prices and energy stocks, we could continue to see a cap on gasoline prices by extension. Here's the year-to-date chart. It's still up 28% for the year. So really important move here that we are seeing today in energy prices, really a breakdown in these stocks. Consumer discretionary also under pressure today. That's the year-to-date. It's exactly the inverse, down 28% and still down today. And then real quick check on material stocks, down 25% year to date and under pressure once again today. And let's talk more about that group, materials and home builders for that matter, because we've been talking a lot about the recent housing numbers and the softness that we've been seeing as we have seen sharply higher mortgage rates. For more on all of this, let's bring in John Lovallo, UBS home building products analyst. John, thanks for being here. We heard from some of the home builders recently. We've been getting home builder confidence numbers that are not great here. There are so many constraints on these companies' business. Let's start with mortgage rates here and how you view the trajectory here. Do we continue to see pain all the way up as mortgage rates continue to go higher, or at some point do consumers make an adjustment?
経営の肝は科学的人事、人材の見える化も。そんなのできちゃうんです、これが。
人材の能力、性格、感情などを分析。人事の今と経営の未来を変える。タレントパレット。
It's a great question, and thanks for having me. I would say that historically, when we have seen these sort of sharp moves in rates, there's always an adjustment period. It takes time for consumers to realize that, hey, we're not at that 3.25% rate anymore. We're closer to 6.25%. But let's take a step back and see what we can do to make things work. And there's a lot of levers that the home buyer can pull. You think about the first-time home buyer in general. I mean, you can move to a smaller footprint, further away from city centers. There's a huge in-migration trend in the U.S. where folks are moving into the Sun Belt, into lower-cost areas. There's a massive wealth transfer that's going on in the U.S. $68 trillion being channeled from baby boomers to millennials and Gen X. And there's a lot of student debt relief going on, and even more in the pipe. There's been $25 billion so far. So things are tough when rates move very quickly. There will be a reset period, and there are a lot of levers that can be pulled.
Okay, and so there's a lot to break down even within that. So I guess starting things off with where home buyers do have any type of leverage, because for the builders, the confidence, that has sputtered. We've seen that slip for consecutive months. Where, I guess, are home builders going to start to see some of their confidence return. And it seems like some of that, or much of it, is directly hinging on some of the supply chain concerns also alleviating themselves.
Yeah, really good question. I mean, there's a lot going on in the market right now. Consumer demand has certainly moderated. That's to be expected given what we just talked about. But there are lots of supply constraints still in the market. The fact that builders getting land even zoned and entitled has taken a tremendous amount of time, much more than it would historically. So what does it take to get builders confident again? It's a good question. I think that, one, we're starting to see some easing in the supply chain on the margin. So that will certainly help. And the moderation in demand is going to also help that. But I think what's interesting on the consumer standpoint is that we've seen over the summer months, and this was actually reported by both KB and Lennar yesterday that reported, that we've seen improvement, at least sequentially, through the summer. And the summer is historically a slower time. So this is really unseasonal, the strength that we've been seeing. Now, it's not great, but we are seeing a little bit of signs of improvement, which suggests perhaps that the consumer is getting a little bit more comfortable with rates.
John, we talked earlier in the week to the president of the National Association of Home Builders, and granted, his realm was much more political than yours, but he did interestingly point the finger at policy in part as being to blame for some of the weakness in the housing market in terms of zoning not being more favorable, for example, and also, of course, the effect that the Fed has had on interest rates. How do you view those issues and whether anything's going to change on those fronts?
That's a tough one.
Yeah.
I think that there are certainly some restraints that have been put into the market in terms of regulation, whether that's on the land side or just zoning in general, and that's a challenge across the board. I mean, I think on the margin maybe it's gotten a little bit worse, but I think it's always been somewhat of a challenge. In terms of rates, I mean, Powell's in a tough spot where we need to get inflation down, and I think that he and his team are doing the best to kind of manage that. Where rates go from here, it's very difficult for us to tell. But at the end of the day, people need homes, and there will be still homes that are sold, and I think that will be good for the home builders over time once we can kind of get a little bit more comfortable with the current environment.
That's really interesting because previously there was this advice to prospective home buyers to wait for this pivot in Fed policy. But now that we know that the pivot has essentially paused in any type of fodder for conversation, where are we going to see home builders home buyers rather? Should we see them? Should we expect to see them kind of rush in to try and take advantage while rates are lower before they get even worse?
Perhaps. I think right now, though, we're still in that adjustment period where we saw about 140 basis points of rise, since late summer. It's really been sort of unprecedented times. So I think there is a reset period that's going to need to happen. Now, will folks rush in and try to, beat the next leg up? I don't know that anyone knows the answer to that because no one really knows the direction of where rates are going. And I think that's a big challenge for not only home buyers, but for investors in the stock is we don't know where rates are going. So it's really tough to figure out what you're underwriting when you're buying, agreeing to buy a home or buying the stocks.
John Lovallo, UBS Home Builders Building Products Analyst. Thanks so much for the time this morning. Appreciate it.
Thanks for having me.
Definitely. Everyone, let's take a look at a trending ticker right now. Take a look at shares of PINS, pins, down 4% right now after reports from Deal Reporter saying the company's largest investor, Elliott Investment, may push for a sale. Elliott's involvement with Pinterest was reported back in July by the Wall Street Journal, which said at the time that the firm had built a stake of over 9% in the company here, Julie. This has been really interesting to track in terms of what Elliott's ultimate goals were with that stake that they had built up in Pinterest.
Yeah, what's interesting is that the stock is not going up, right? We had a little bit of a spike earlier in the session when this first started percolating out there. This was reported by Deal Reporter, which is behind a paywall. So then it sort of trickles through, right, the system and the chatter among traders. But you would think if Elliott's pushing for a sale, that Pinterest would be higher. So the fact that it's not maybe throws a little bit of skepticism into the equation, or questions about if they were going to sell themselves, who would buy them?
It is, and it's a question of, as well, what category still Pinterest wants to play in. It's not clear. The company was trying to step away from being annexed to the other social media companies at the time when it went public. It's still tried to be, and largely has been, kind of this inspirational platform for finding out new things that you might be interested in, and whether that's DIY projects, or whether that's just finding new recipes, or just finding inspiration for everything from your next outfit that you want to wear, all the way to the way to kind of propagate a new plant. And so all of that has now gone increasingly to some of the other social media platforms that Pinterest didn't want to be annexed to. So it's a larger question of, for whoever would be that acquisitive company, the company that would come in and swoop in and ultimately kind of put them under their umbrella, what vision they have for growing out Pinterest and that average revenue per user on the platform too.
Right, lots of good questions about all of this, and like, would it be someone in e-commerce who could link up and monetize all of those different? I mean, they've done some of that already, right? A lot of the Pinterest stuff has links, but I don't know.
We'll have to continue to watch shares as we move on throughout the day. Yeah, coming up, Brian Sazzi spoke with Slack's chief product officer at the Dreamforce conference. We're going to share that interview on the other side of this short break.
不動産投資をご検討の皆様、不動産投資なら楽町収益物件数ナンバーワンでございます。楽に待つで楽町で検索。不動産投資サイトナンバーワン楽町。
Let's get down to business now and take a look at some of the other headlines that we're watching. Boeing set to pay $200 million to settle charges by the Securities and Exchange Commission that Boeing misled investors by making false statements about the 737 MAX's safety risks while under the leadership of past CEO Dennis Muilenburg. SEC Chairman Gary Gensler saying in times of crisis, it's especially important that public companies provide fair, truthful disclosures to the public and Muhlenberg failed in the most basic obligation, Gensler said. Muhlenberg will pay the securities regulator $1 million to settle the agency's claims. Tesla recalling over 1 million vehicles over window finger-pinching concerns. Tesla says the automatic window reversal system may not react correctly after detecting obstructions, according to safety documents posted by U.S. safety regulators, and that is a violation of federal safety standards. Tesla discovered the issue in August. It will roll out an update to fix the problem. The company also filing a countersuit, meanwhile, against the California Civil Rights Department after that agency accused it of fostering racial bias in its Fremont factory. Tesla says the agency did not give adequate notice or earnest engagement in efforts to resolve violations. And it's official, Apple Music is replacing Pepsi as the primary sponsor of the National Football League's Super Bowl halftime show. It'll begin with Super Bowl 57 in February. The Super Bowl, usually the most watched TV event of the year, with over 120 million viewers tuning into this year's show. Though terms of the deal have not been released, it's expected to become a key platform for Apple, which has been a key player in music since it introduced the iPad in 2001. Apple's also among a number of companies bidding for the NFL Sunday Ticket. DirecTV's deal expires at the end of this season, and this is reportedly part of the negotiation, the ongoing negotiations between Apple and the NFL that it is getting this sponsorship deal for the halftime show. Coming up, Qualcomm is revving up its investment in the automotive space. We'll speak with the company's automotive senior vice president next.
「サントリーから新発売大人の男性向けスキンケア顔の印象が変わる10日間始まる」
つい鏡の前でにやけてしまいます恥ずかしい触り心地も良くて毎朝「おお!」って「バロンいいじゃん」って
顔の印象が変わる10日間始まるサントリーバロン。
One of the largest U.S. crypto exchanges is getting a major leadership change amid the current meltdown. Kraken's CEO, Jesse Powell, stepping up to the chair and that of the exchange's board. In that role, he's going to oversee product and dip his toes into advocacy work after finding himself in the hot seat due to insensitive comments and a poor corporate culture. Joining us now is Kraken's COO, Dave Ripley. He's been tapped to succeed Powell as CEO. Good to have you here with us today. First and foremost, the leadership changes coming after a time where corporate culture has certainly taken a hit. So with all of this in mind, what is the company and the executive team trying to signal to the team, the employee base, even amid so much of the challenges that the broader macroeconomic environment have presented?
Yeah, well, thanks for having me on here. I think a couple things there you wanted to touch on. So culture and then the broader environment. So first of all, on culture, Kraken's culture is thriving. It's amazing. We just recently, of course, did some great work articulating and codifying our culture, and we released that publicly. And it's been a resounding success for us. On the heels of that, we launched our annual engagement survey, and across the board, we're above industry rankings on almost every category to a considerable degree. So just a fantastic set of team members, Krakenites, as we affectionately call them. So culture is in a fantastic place, and we wouldn't make this move if that wasn't the case. On the broader market, for sure, absolutely. It's probably a crypto bear market here, but this isn't our first rodeo. I've personally been through 3 bear market cycles in my time in crypto. And this one more than ever is an opportunity for us. We've been doing a great job of adding new talent to the team as the recruiting environment gets a little bit more amenable to opens up a bit more, and have been focused on scaling the business, scaling the product operations, and all these types of things that we have an opportunity to do while the market plateaus here. So we're really excited about the opportunity to catch our breath, to really fortify the business and get ready for some significant growth to come.
Dave, I'm just curious. I know you've been around with Kraken for a while, and so between this leadership shift, is there any meaningful change the company will see that you want to speak to? I mean, I know obviously the company has been talking about doing something like an IPO for years. And
sure. Yeah. So great questions there. So, first and foremost, I'll just hit on the similarities. Kraken is incredibly mission driven. Our mission is going to remain steadfast. Our values and our culture, they'll remain unchanged, and this is the constant. But you're absolutely right. Look, Kraken is, since the time I joined, we were 50 people, and now we're over 3,000. So, as we look forward to grow, we will have to change and adapt, and we'll have to scale the business and, look to operate differently, ideally keep some of that innovative and entrepreneurial potential. But, frankly, scale and meet the challenges of a larger organization. So that's undoubtedly going to be the case. And then with regard to, IPO and fundraising, for sure. So we, are always, kind of top of mind with regard to our capital structure and where we sit. We have a strong financial position, balance sheet right now. We haven't actually tapped capital markets and fundraising significantly in Kraken's past relative to our peers, if you will, but it's absolutely something out there that we could, look to fundraise in the future. And, whether that be private or public is, something that would be TBD.
Dave, I gotta say, there's a lot going on at Kraken. I mean, we talked about the cultural issues a little bit. You guys are reportedly under investigation from the Treasury's Department of Office of Foreign Assets Control over potential sanctions violations. The former CEO told people to leave the company if they didn't like the culture of the company, if they didn't like what he had to say. And a lot of people didn't like what he had to say. Did you guys have an exodus of people? Are you now, as you're rebuilding and changing the culture, are you trying to hire a lot of new people if those people left to replace them? It's from the outside looking in, feels like there's a lot of turmoil there.
Yeah. Like I said, could not be more inaccurate on that last piece there. So, I'm not too sure how else a company would want to operate other than to clearly articulate their culture and ensure that people that are part of the company are actually happy there and want to be part of the culture. And that's exactly what we did. I'm nearly certain in the absolute dozens of companies that I've worked with, public companies, Fortune 500 companies that, those with the, kind of like the strongest mission and culture are the most successful. And that, that's definitely Kraken. And so, upon articulating our culture, we did actually take the step to say like, hey, if you're the guys, if anyone here isn't on board with this, we're happy to help you find your next opportunity. And
so did people
that's
leave?
What we did. Yeah, it was about a fraction of a percent, so a little less than a percent of the total. So it was something just under 30 people, and we have about 3,300 total in the company.
Yeah, Dave, turning towards the staking side of your business, which has gotten a lot of attention since Ethereum just sort of transitioned to proof of stake and it's created this whole staking industry. I wanted to ask, have you seen like any significant changes with your staking business since the Ethereum merge? I've seen a note from JP Morgan that sort of pointed out that Ethereum staking hasn't really grown as much as was necessarily anticipated after this merge upgrade.
Yeah, I don't know if we expected any kind of like instant change or growth in total assets staked due to the Ethereum merge, but we do think it'll continue to grow over time as of course the network moves through this transition from wholly proof of work to wholly proof of stake. There's still time left on the overall transition until it's like fully complete. And so, yeah, we expect staking balances to grow as a share of the total. I mean, in the end, it won't be that all, 100% of Ethereum tokens are staked. For a whole host of technical reasons, the network, of course, wouldn't function if that was the case due to lockups and so forth. But yeah, we expect it to grow from here and continue to. We see kind of like the same continued growth that in Ethereum staking that we've seen over the past 6 months.
Dave, you were reportedly valued at $11 billion in midsummer this year. The crypto markets have taken a massive plunge even since that point in time. How has that impacted the company's valuation, the cash positioning, and even as you're kind of looking across where crypto in the broader kind of buildup of some networks and the still speculation and speculative asset that many investors look at it with, how does that directly correlate to the company's value itself? Yeah, so we of course don't know definitively, right? Kraken's a public company and there isn't necessarily, a private company, and there isn't necessarily price discovery on the valuation of the company in real time. And so, that's something that, will come about when we do subsequent fundraises or, someday if the company's public, that would be the case. Do you need to raise funds right now? We don't. We don't. I mean, this is, on your second piece there. Yeah, we have a, strong financial position. The broader, drawdown in market caps of companies, of course, don't impact our balance sheet at all. So, that remains unchanged from that standpoint.
And a quick follow-up on that, Dave, we've seen some other exchanges going out and making acquisitions, right, in this environment. Do you guys see yourselves doing any of that?
We do. We have, a strong and fully built out M&A team, and, they're active. We did a significant acquisition of a company called Staked to really fortify our position in the staking market less than a year ago. And, we're kind of continually looking for acquisitions, primarily a lot in, new product and tech within the crypto sphere that makes sense to add to our portfolio.
Dave, thank you. Dave Ripley, and thanks to Dave Hollerth as well. Appreciate it, guys.
Yep, thank you.
Well, turning now to the world of semiconductors. Qualcomm is revving up its partnerships, announcing a deal with Mercedes-Benz for its upcoming vehicles at its Automotive Investor Day. The chipmaker also announced the expansion of its automotive design win pipeline to $30 billion. Joining us now to discuss, Qualcomm Automotive Senior Vice President and General Manager Nakul Duggal. Thank you so much, Nakul, for being here. looks like investors, when you guys made this announcement yesterday, were pretty pleased with the results. This was a bigger than expected pipeline than they were looking for, right? So talk to me about the process here. I know that automotive is about 12% of your sales or so right now. What are you guys pushing towards here in terms of goals?
Good morning. Thank you for having me. Look, we had a fantastic Investor Day. The auto industry is betting on the Qualcomm Snapdragon digital chassis platform, which we are working with a large number of automakers on. As the industry goes through this massive transformation that is upon them, every car company has to very rapidly become a technology company. And Qualcomm is being selected by a variety of different automakers globally as that technology partner of choice. We expect, rapid transition in terms of how the market evolves when it comes to automated driving, digital cockpits, connectivity. So the definition of the new car of the future is going to require this shift in technology adoption, and that's what we are driving.
Is that total addressable market based on clients, customers, partners that you're already working with, or is that also in competition where you're going to seek to take on a certain extent of the market share of that total addressable market? And if you can kind of parse through some of your competitors that are also going to be really competing for that, how that really looks like and how ready you are to accelerate that too.
Yeah, so we have been, consistently and patiently investing in this space. There are a few things that are absolutely evolving. One is the silicon and the software content is rapidly expanding in vehicles as every vehicle starts to become software defined. That is certainly a big accelerant in terms of the addressable market. I think the other big shift that is happening is that automakers are making direct bets on technology partners that they want to be able to work with over multiple generations. So, sitting here today in 2022, we are involved in decisions for production years 26 and beyond. And this is why we are actually able to provide visibility in terms of what the business starts to look like over the rest of this decade, because the pipeline that we announced is actually providing us that coverage over an extended period of time. We've shared the $30 billion number, but we are essentially seeing a rapid transition in the market in terms of making these technology bets, and that's how we are able to go forecast that larger addressable market.
Nicole, I want to ask about supply chain for a moment here. Now, I know you guys aren't fab, you're designers and licensors, but nonetheless, you're affected by what's going on in supply chain. We're hearing from the likes of Ford that they've got 40,000 to 45,000 unfinished vehicles sitting around. Is any of that because, or not Ford specifically, but are we seeing still issues with getting automotive chips into vehicles?
That's a good question. One thing that Qualcomm did early on, right at the beginning of the pandemic, was we prioritized automotive supply above all other verticals that we are involved in. So we wanted to make sure that none of our customers were impacted by the supply chain crisis on account of anything that Qualcomm was shipping. Now, obviously, automakers put in a variety of different semiconductors that have various set of dependencies across a fairly complex supply chain. We do see that the supply chain complexity is going to improve over the second half of next year. We ourselves are not necessarily seeing any specific challenges on the products that we supply and so on.
Nicole DeGaulle, Qualcomm Automotive Senior Vice President and General Manager and owner of a Birds of Paradise and Monstera plant behind you there. Appreciate it.
Thank you for having me.
Guys, coming up, Brian Sazi spoke with Slack's Chief Product Officer at the Dreamforce Conference. We'll share that interview on the other side of this short break.
Budosan 投資をご検討の皆様、不動産投資なら楽町、楽町、収益物件数ナンバーワンでございます。楽に待つで、楽町で検索。不動産投資サイトナンバーワン、楽町。
The Dreamforce conference is all wrapped up in San Francisco, which means Brian Sazi is on his way back to New York. Before he left, though, he sat down with Slack's chief product officer and talked all things return to work. Take a listen.
We've been working very closely with our customers to understand what they need, and some people are coming back to the office. Some people are working in this hybrid situation, and some people are fully remote. But what we find is they all need the same thing. They need to be able to collaborate effectively and to have tools to increase productivity.
What is the next generation of Slack?
So we're continuing to enhance our tools and enhance our platform so that we can build in more collaboration, more connection. People miss not seeing each other in person, and even if they are going into the office, every time you collaborate, you want to make it feel more personal, more human. So we've added into our Huddles feature, which is a audio first collaboration, the ability to have video and to have fun effects and emoji reactions to make it feel human.
Do you find it weird that we still have meetings as if it was pre-pandemic?
You know, a lot has really changed. People think about meetings in a different way. The whole concept of video fatigue is you really don't like being on screen all the time. And I think people are more open to changing how they meet. And people are talking about how do we have fewer meetings? How do we have more asynchronous meetings? The word asynchronous was not a word that a lot of people used before the pandemic. Now you hear from everyone. So a lot of our meetings we've stopped having, and they've gone asynchronous with video clips. So you just eliminate the meeting altogether. So I find people are more open to change.
There's this knock on Slack that we're always on Slack. If we're on Slack, we're not maybe getting things done. Where do you stand in this debate?
So work is communication, and most of our work is communication. And you should be using whatever communication tools you have to increase more effective communication and be off the tools when you need to. When I need to focus, I turn on my do not disturb and I focus. And there's an etiquette of when something's really important and you have to respond. But people are going to use whatever tools they have. If they don't want to focus on their job, it's easy to do that with email, it's easy to do that with any tool. So you have to use your tools in a way that make you more productive, beyond them when it's going to actually help you with your work.
Be right back, I'm gonna check my messages. No, I'm just kidding. But how do you think about, one thing I've learned or I've picked up on the keynotes at Dreamforce, talking to folks, is better integration between a Slack, a MuleSoft, a Tableau, and that core CRM software. Is that the right way to think about it? These things are finally starting to integrate and communicate with each other?
100%. Slack's platform has always been one of the key parts of Slack in that you can integrate with any third party. So in the very early days of Slack, developers used it for incident management, of integrating with all their tools. And we've really focused since the acquisition on integrating with all of the Customer 360, all of the clouds. This adds so much value to your productivity. So instead of having to leave where you're engaged and go check another tool, you get a notification right where you are, and you can actually respond with a workflow to whatever that issue is without leaving Slack. So it just increases your efficiency. So that's another big focus of ours, is automation.
How do you keep developers and your software team focused? This is a challenging time for the economy, the world, but how have you kept them just focused on the mission, on what you need to achieve?
So for us, it's all about the customer. And the closer people are in the product organization, the engineering organization, to the customer, the more motivated they are, because you see that you're helping them. Yesterday in the Slack keynote, we had some people from Janssen, some customers who are helping to eradicate cancer. And nothing could be more motivating than to make them more efficient and more productive. So if you constantly are talking about the customer and how what you're doing really has an impact, then people will focus on building the things that will help the customer.
I've asked Stuart Butterfield this numerous times about Slack hacks. He has told me a couple of his. What are some hacks that we're not using that we should start using?
Well, one that you probably don't have yet is the Huddles that's coming out with the effects, which is bring people together in a video. But one of the things I use a lot is scheduled send, because you don't want to bother somebody.
There's a schedule send on Slack?
Oh my God, you didn't know that?
I didn't know.
Oh, I'm so glad
I'm not
I told
supposed
you.
to say that, but just an authentic moment. Like I didn't know that.
Yes, so by the little send, there's there's a little carrot that you can schedule it whenever you want. So
Sometimes I catch up on all my messages on the weekend and I don't want to bother people, so I schedule send it for Monday morning.
Wow, I didn't. And it is okay to have your do not disturb on. That's okay.
100%.
You put yours on. Like, when do you set yours?
I put mine goes on every day at 10 o'clock.
Okay.
And until the morning, I think it's 7 or 8. But every night I have my do not disturb on. If somebody needs to reach me, they can override it, but every night.
Coming up, going viral, we'll break down this week's top TikTok trends. It's a new feature from us, a new segment. Stay tuned, it's on the other side of the break. Quick check on markets now, because we are still seeing stocks in the red and in fact deepening their declines, being led by energy stocks. As we talked about earlier, the slump in oil today is definitely having an effect on those energy shares, although it's a broad-based decline. Last I checked, all of the groups in the S&P were down. Right now, the index is down 1.75%. Turning now to TikTok. It's risen through the ranks over the last few years, moving on from just catchy dances and short-form skits to a place where rising businesses garner traction. And we want to chat all things TikTok now. Bring in Kelsey Barbario, Yahoo Finance senior TikTok producer. She's making her Yahoo Finance Live debut in what is going to be a weekly segment where we talk about what's happening on TikTok. We are excited too. First of all, we wanted to sort of set the scene here and talk about why we are doing this, why we're going to be talking about this weekly. And one of the reasons that TikTok is increasingly important is because of how the interplay between TikTok and business, how TikTok trends are affecting businesses. So talk to us about that.
TikTok is having the most major effect on businesses, especially small businesses. You know, we're looking at makeup creators who can sell out a product in mere minutes. And so for some smaller businesses, that can be huge. That can be life-changing. And so we've seen stuff like that. We've seen, single moms who are able to, completely provide for their families because of what TikTok has been able to do for them. And it's just been really remarkable. And I feel like it's happened since the start of the pandemic. So that's been really neat too.
Absolutely. One of the major kind of movements in the competitive landscape, because it's all about the screen wars, right? And they're competing for screen time. And that also means you've got to cozy up to the creators and the influencers as well. We saw earlier this week, YouTube announced major changes to its YouTube partner program as well, seemingly to compete more with TikTok. And so, is this really going to result in people moving away from TikTok, creators moving away from TikTok to go over to YouTube Shorts?
I think that's their goal, obviously. I think they're giving away, 45% of their revenue or their ad revenue is meant to be going towards creators, which is huge. I've talked to creators who are in the creator fund for TikTok, and they are not seeing numbers even close to that. Like for a creator to make it on their own, what they're often finding is that they have to do some brand deals, like they have to work with different businesses if they want to actually make a living off of TikTok. It's really not coming from the creator fund, despite what people may think. So I think that seeing something like YouTube Shorts do this, like that could be a big push. I know we're on YouTube Shorts for Yahoo Finance, so we're already in it, but I don't know if we're eligible to make any money, but maybe.
One of the other things that we're tracking on TikTok is not just what's going on with businesses, but also there's like, I track FinTwit, which is like the financial world on Twitter. And I know there's something like that it also occurs on TikTok. So what are we seeing trend-wise on TikTok this week, I guess in finance and just elsewhere?
Right, so we've got obviously some finance trends. Finance, I think, is inherently a little bit less trendy, so to speak, for TikTok. But they've got, have you seen the guy, he goes out and he's like, I'll give you $20 or I'll double it and give it to the next person. He goes out in like Washington Square Park in New York City. And people, it's like a social experiment to see who's gonna take the money. So we've got stuff like that. That's kind of in the finance realm, I guess. But outside of that, we've got some exciting things. We've got a great dance, TikTok initially known for its dance videos. And so we've got Beyonce's new song, Cuff It. That one's been a very popular dance of the moment. I never dance on TikTok, that's not my vibe. But I appreciate the people who do. Outside of that, there's a trend where girls ask their boyfriend to give a word to describe them. So like you'd say, what color am I? You can do it for each other even. What color is Julie?
This is why I'm not on TikTok.
And then they'll be like, you are burnt sienna. And they're like, no.
Burnt sienna?
Yes, something so random. And so they do these crazy trends like that. And then there was the corn guy, the corn kid.
Yes.
Yeah, we know.
Yeah, we love him.
He's like, I think that trend has kind of died out at this point.
Yeah, but run him his check. Give him all the money.
I know. I think he's probably got his college set up. So honestly, for him, great.
Kelsey, this has been really insightful. I'm looking forward to even more of these conversations because there is so much of that correlation between what's really driving business and what's the most social parts of kind of commerce that's really emitting through TikTok as well. Appreciate you joining us this morning.
Thank you so much.
Kelsey.
Absolutely. Everyone, switching gears here, Netflix is looking to cut back costs in the comedy department. The streaming giant has begun changing its compensation plan for the specials, now licensing some for 2 years for $200,000, according to the Wall Street Journal. Yahoo Finance's Ali Canal joins us now. Okay, Ali, what do we know about this so far?
Well, Brad, this really is part of Netflix's larger goal to cut costs for the sake of profitability. So according to this Wall Street Journal report, this new licensing plan will shift some of that financial burden onto the comedians. So they will have to pay for their own production costs, which is something Netflix previously covered. In return, though, the comics will have more control over their work. So once this 2-year licensing period ends, they will regain full ownership of that content and can then shop that out to other outlets and platforms. We know comedy has been such a crucial element for Netflix. They've heavily invested in this space, hosting specials from Dave Chappelle, Bill Burr, Pete Davidson, just to name a few. Whitney Cummings was cited by the Journal as one of the comedians who will receive this 2-year licensing deal. And just to put this into further perspective, the streamer previously bought these comedy specials outright. So they would pay performers a lump sum. That lump sum could amount to as much as $1 million to help with some of those production costs, sometimes more, depending on the comic. So this is really just another option. Certainly more cost effective for Netflix. There's some pros and cons there for performers. So, we'll see. I think Netflix will want to buy some deals outright, especially for some of those more popular stand-up comedians. But the flexibility of choice, very important here as Netflix gets more aggressive with cutting costs. And also important to note that some of those other streamers that you're seeing on your screen, like Amazon, Apple TV Plus, they'll now have greater access to some of this talent. So perhaps it could shake up the landscape a bit there too.
All right, a lot to keep track of in the streaming space as of right now. Ali Canal, thanks for keeping tabs on it and breaking it all down for us. Coming up on the other side of this short break, everyone, Amazon, they're cracking down on its ebook return policy. Guess what? It's also correlated to those TikTokers we were talking about a moment ago. We've got more on this story on the other side.
不動産投資をご検討の皆様、不動産投資なら楽マッチ、楽マッチ、収益物件数No.1でございます。楽侍ではなく楽マッチでございます。不動産投資サイトNo.1、楽マッチ。
It's time for Cut for Time. 2 stories, 1 minute each. We start with this today. Got to talk about Amazon curbing its e-book return policy amid increasing pressures from the Authors Guild. Now, returns will now be limited to purchases where no more than 10% of the ebook has been read. Okay. Prior to this, customers could return a book up to 7 days in and get a refund, even if they've read the entire book.
Wait, you know what that's called?
This is the ebook stuff.
A library.
Well, yeah. So,
I don't understand.
I'm sorry, I'm leaning back because I'm just kind of floored by this. I mean, yeah, obviously they wouldn't let you return the ebook if you'd gotten through a certain amount of it.
Well, apparently they did.
What? I mean, there's so many other things that I like. I don't get to return a digital copy of something that I purchased if I've only gotten a certain amount into it.
Listen, I just want to say a word in favor of the library. Libraries also have ebooks, by the way.
What's your library?
If you don't want to pay anything for a book, go to the library.
And they're free.
Take it out.
Yeah.
It's a wonderful thing.
Free cards.
You might have to wait a little bit sometimes for the book. If you need that immediate hit,
Yeah.
then it
The
doesn't
bestsellers.
fill that. Yes, the bestsellers, you got to wait a little bit. But it's, you know what, patience is okay. Google CEO Sundar Pichai sending a clear signal to tighten belts at the tech company in audio obtained by CNBC. Pichai said at an all hands, quote, "We shouldn't always equate fun with money." And what he was replying to, that's sort of taken a little bit out of context, but apparently there was a big discussion about the pullback that the company has done in expenses and various perks for employees, and people are not too happy about that. And he's saying, listen, this is a time of belt tightening. We have to realize what's going on in the wider world.
Oh, a lot of that was self-brought on, though, too, for retention mechanisms, for talent acquisition. They were trying to make it so that this is a place you want to come and spend more than 8 hours of your day at. You want to be here for 12 or 14 hours instead and have the ability to have your gym or all of your food experiences all in one, ping pong, everything of the like. And so now that they're saying don't equate fun with money in essence here, it also does come with the realization that there's going to be talent out there that very much even thinks back to the GFC and is like, well, those things were still remaining intact at that time, at least.
These kids in their ping pong. Coming up, Akiko Fujita is going to speak with Evercore ISI's Mark Mahaney on his latest upgrade to Netflix. And this is as we see stocks way down today.
Welcome to Yahoo Finance Live, and happy Friday. It is 11 a.m. here in New York City. I'm Akiko Fujita. Let's do a quick check of the markets. It is not a pretty picture today. Take a look at that. The Dow down more than 460 points. The S&P 500 down 69, and the Nasdaq down 208. We are seeing energy, the biggest laggard on the day, but it is pretty much a bloodbath across the board here. A lot of this being led by bond yields soaring, particularly on the short end of the curve. The 2-year yield we saw shooting above 4.2%, hitting a new 15-year high. We've seen a pullback since, but take a look at the 10-year yield there, jumping to a level we haven't seen in 11 years there. So big moves in those yields there, leading to a broad-based sell-off here in the equity space. The recent moves prompting Goldman Sachs to cut its year-end target for the S&P 500 from 4,300 to 3,600. As part of its reasoning, Goldman Sachs says the interest rate path is now higher than it had originally forecast. For a closer look at all the market action today, we've got Yahoo Finance's Jared Blickery here with me. And Jared, you're also watching currencies.
Yes, and we're going to get to those in a second. The British pound racing towards parity with the US dollar, just as the euro did a month or two ago. But let's go to the Wi-Fi Interactive, where I'm charting the price action in the S&P 500. This is a 6-month chart, and we are racing towards those lows that we saw in June. So basically, we are looking at a situation where we're potentially heading to new yearly lows. And if you take a look at the Dow is already there. In fact, it has taken out those June lows. Let's see if I can get that up there. Looks like there's a little bit of lag, but that's good enough for government purposes. Also checking in on the US dollar. Now, this has been racing higher, and this has been placing a lot of stress on global currency markets. And I have a little graphic here I prepared writing this up today, and you can see at the very top there we have the Argentine peso. All right, now that has been devalued about 40% versus the US dollar, along with the Turkish lira. Turkish lira gets a lot of press because they are actually cutting rates, the opposite of just about every other central bank out there. But then you go down. So after the peso, after the lira, then it's the yen. This is a problem because the yen is a much bigger currency, the third or second most heavily traded currency in the world. I believe it's the third. Then the Swedish kroner, then the British pound. These are developed market currencies. Usually you do not see 15, 20, 25% moves in these currencies. You start getting these kinds of exacerbated moves with highly leveraged instruments, and then you see an unwind. Think of the flash crash. Think of some of that Lehman moment. In the global financial crisis, it was really about corporate debt and banks. And now we have the opposite situation where it's sovereign. So sovereign debt reared its ugly head later after the GFC, 2011, 2012. That's when we had the Euro crisis of confidence. That's when Mario Draghi, head of the ECB, had to say, we'll do anything that it takes. Is it going to come to that? You and I have been talking about possible more intervention by the BOJ. By the way, that hasn't done much. The yen has come back, and it's actually a little bit weaker today after that big strengthening move yesterday. So all of this looks to be a little bit too little, too late, and I think we're still going to see a lot of fallout.
Yeah, and with the yen, we're talking about a developed market currency. These are often EM currency swings that we see. Obviously, for EM, it means more debt, more expensive.
Yes.
A lot to follow there. Thanks so much for that, Jared. Well, let's continue the market conversation here with Scott Ladner. He is Horizon Investments Chief Investment Officer. Scott, it feels like it has been a step down every day of the week here. How much of what we're seeing today is a direct reaction to really concerns that the Fed is moving too aggressively too soon?
Hey, Akiko. Yeah, yes, quite a lot of it probably, and it's not. But it's, let's be honest, it's not just the Fed. Today, in reaction to Liz Truss's budget, UK rate markets are pricing in 100 basis points for November. So it's not just the Fed that's going really hyper aggressive right now. It's the BOE. It's basically it's everybody except for the central bank in China and Japan. Other than those, everybody's going really, really hyper aggressive. And the problem with that, as we all know, is that they're targeting a lagging indicator in CPI or PCE. And if they're targeting a lagging indicator and they're being very fast and aggressive with their rate hikes, the probability that they get it right and avoid some sort of recession or avoid some sort of hard landing is asymptotically low. It's just probably not going to happen. And so that this is what the markets are trying to grapple with right now. Not only falling multiples, which has been the story of most of this year, but now we're going to start hearing about earnings downgrades, and that's probably the next leg that we're experiencing right now.
So much of the jitters we're seeing today, driven by the big swings we're seeing in bond yields today. We mentioned that the shorter end of the curve spiking in a big way, the 10-year up as well. I mean, how much higher does it get? If we're talking about the 2-year at 4.2% right now, what are you looking at?
I think actually we're probably right about where we're going to get to on the 10-year. The market reaction today, we're seeing 2-year rates up a lot, and we're seeing obviously 10-year rates up in places like England, but in the U.S. 10-year rate's actually down a basis point or two right now. And so, I think that's the market saying, hey, listen, we think that we know that the Fed is going to go super aggressive, and so short end rates, that is the 2-year rate, can continue to go higher. But at some point, they're going to break it, and rate cuts will end up following. And what they're doing right now is not good for economic growth, and certainly downward pressure on inflation. And so, economic growth and inflation are the things that really drive the 10-year rates, whereas Fed policy really drives the 2-year rates. And so we're starting to see the market discern and sort of discriminate between what are the drivers of a 2-year rate versus a 10-year rate. And I think we're starting to see that the 10-year rate kind of peaking out around the 3.75 ish is probably about as high as we're going to get this cycle because the Fed is being so darn aggressive.
With that said, there's a lot of investors who are looking at the bond market saying, well, these yields don't look so bad when you look at the broader markets right now. Is this kind of a time you think to maybe move into bonds, or how are you looking at your portfolio and potentially shaking things up?
It's a little bit tough to call. Getting really aggressive moving into bonds right now. Frankly, it's hard to get aggressive moving into anything right now on a day like this. But it does probably make some sense to start nibbling at duration. But we wouldn't play in the belly of the curve. We wouldn't play in the short end of the curve necessarily. If you're going to start nibbling on duration, you probably want to go out about as far as you can stomach in terms of the curve, because that is where we're going to start seeing some real value. And we might be getting close to those points right now, but you're going to have to stomach some volatility over the next month or two. This is going to be probably a pretty whippy next 6 to 8 weeks.
So in terms of equities, where do you move then, Scott? Do you just hold cash? Is this kind of the safest way to go, given that so many have said that there could be significant downside going into year end?
Yeah, I mean, look, if you have some sort of de-risking instrument or some sort of process or algorithmic process to get you in and out of markets and kind of deal with risk in that way, that's one way to address it. If you're going to be more of a buy and hold kind of person and sort of move within equities, then probably moving more closer to the U.S. is going to continue to make sense. It's been sort of an old story. It's been a story all year long. You want to be as close to home as possible if you're a U.S. investor. That's still going to continue to be the case, and we're probably getting pretty darn close, Kiko, to the place where you're going to want to start moving away from value securities and more towards the growth securities. So those mega cap tech names and the really growthy names, not the profitless growth tech names, but the profitable tech names, that's going to be a safe haven in terms of where we can actually get to in equity markets, because growth is going to be scarce pretty soon. And that which is scarce is valuable, and we know that those mega cap tech names really have quite a lot of growth, and so they will start picking up some value and some allocations as we move into the back half of this year.
Yeah, some good takeaways there. There's a lot of investors reassess their portfolio today. Scott Ladner, Horizon Investments Chief Investment Officer. Appreciate your time today. When our trending ticker today, the prospects of higher shipping rates and cost cutting pushing shares of FedEx lower. The stock is down nearly 3% there, hitting a new 52-week low today. The company announced it's raising rates by nearly 7% for its express ground and home delivery services. It's part of a move to slash $4 billion from annual costs. The news comes 1 week after the shipping giant warned its fiscal first quarter results were being weighed down by weak global demand, sending stocks tumbling. Despite those concerns, the company is maintaining its forecast, projecting annual revenue growth of 4 to 6%. Coming up next is now the time to buy Netflix. Our next guest looks past the streaming giant's recent struggles and makes the bull case for the company. That's coming up on the other side. Welcome back to Yahoo Finance Live. We've got a new bull on Netflix. Evercore ISI citing the upcoming ad-supported tier and password-sharing crackdown as reducing user churn. The move comes as Netflix struggles to retain dominance in an increasingly competitive streaming space. Let's bring in Mark Mahaney, Evercore ISI Senior Managing Director and Head of Internet Research. Mark, it's good to talk to you today. You know, early on this year, you mentioned, you were kind of critical of Netflix, saying that they have been slow to pivot in this changing landscape. But it sounds like you see real levers here with this ad-supported tier, a crackdown on password sharing. What are you seeing?
That's right, Kiko. I think that's the right setup. And I also, fully agree with what your prior guest, Scott Wagner, said about you need safety. Megacap can maybe help you. I'm looking at names that have been really beaten down, and Netflix is probably at the top of that list, down 70% at one point year to date. Now, it's had a 40% rally recently, and it's because of this ad-supported business that they're rolling out. So, look, you've got Netflix now that's finally beaten down to a place where you could buy it at a PE multiple, like 16, 17 times earnings, first time in a company's history. And then you've got a new revenue stream. One of the big problems that Netflix has created for itself is that they've raised prices consistently over time. They're the leading streaming service globally, but they've kind of painted themselves into this kind of premium price, premium product corner. Offering a lower price ad-supported solution gets them out of that corner. I think expectations are still super low, and so I think this is just a great upside opportunity for the company and for the stock. It's the most identifiable catalyst that I see out in consumer tech today.
So let's walk through your thesis a bit. You said 20% of churn users are likely to return to Netflix with this cheaper ad-supported model. That means 10 million in incremental subscriber net adds, $1 to $2 billion in incremental revenue. How much of that churn, you think, or return back to Netflix comes from previous subscribers? How much of it is about bringing in new subscribers on board for those who may have said before, this is a little too much for me?
Well, Kiko, it's almost impossible to know that. And in all honesty, none of us know what the real price point is going to be for Netflix. We don't know how they're going to market it. So there's a lot of what ifs in the analysis. But what was interesting to me is the survey work I've done for 12 years, we have seen since the beginning of 2018 rising price sensitivity amongst Netflix customers. And we've seen declining satisfaction, at least in their most mature markets like the US. And then when we looked at what the other streaming companies are doing, they're able to generate $5 to $10 in ad revenue per user. And so the light bulb that went off in our heads was, wait a second, Netflix could lower its pricing, its subscription pricing by $2 to $3 and still generate more revenue per user because they can get $5 plus in ad revenue per sub. So we've got something that kind of addresses the price sensitivity and is positive for unit economics. I don't think that was captured in the company's valuation. I still don't think it is. And I don't think it's captured in street estimates. That was kind of the upside call for us on Netflix.
So, Mark, price sensitivity is one thing, and you point to the declining satisfaction among those users, but what about the actual quality of the content? I mean, this is a company that spends about, $17 billion in content. Some would argue that they have really gone for quantity over quality. That's at the core of the churn.
That's possible. Now, that's why we do the survey work. So, Kiko, we've surveyed 2,000 people in the U.S. and in other countries, and we've done this for 12 years. And we ask people, why did you leave? Why would you leave? What would get you to come back? And what is, for the first time, just in the last year or two, shown up as the number one factor is price sensitivity. And then we do also ask people, to rank all of the streaming services in terms of the perceived quality of content. I mean, that's really a judgment call for all of us, where really is the best content in terms of streaming. But, the objective answer we try to get at through surveys clearly shows that Netflix is perceived as having content as good or better than anybody else. And I'm not terribly surprised by that. They've been longer into streaming than anybody else. Now, there's some wonderful other streaming companies like HBO and Disney Plus, but Netflix is spending probably about the industry high in terms of $17 billion in cash spend per year. And every once in a while, it produces these mega hits, Bird Box, Stranger Things, Squid Games. And I think what's happened to the stock is people kind of forgot about that. There's probably another Squid Games out there. The odds are that there is. I sometimes think about it as 17 billion shots on goal. Something's likely to go through for Netflix. Yeah, so that's kind of part of the call.
I mean, that's a fair point. I don't think anybody would have predicted the big hit that Squid Game would become. You were on with us earlier this year saying Netflix is no longer a premium growth story. Does that case change you think, as a result of the potential catalyst you see coming from the ad-supported tier as well as the crackdown on password sharing? Are we still talking about below 20% plus?
Yeah, Kiko, thanks for pointing that out. No, I don't think that Netflix gets back to premium growth. I don't think it gets back to 20%. As a stock picker or as a potential stockholder, what you should think about is if they were, this stock is going dramatically higher. So why? Because the street right now is looking for 8, 9, 10% revenue growth. I think that ad-supported, particularly ad-supported offering, but also some password sharing crackdown, they have to be really careful about that. They have to do that. You have to do that right. But if they get those out, that could bring growth back up to kind of 15%. So this isn't the go-go days for Netflix. They have them. It was the best performing stock of the S&P 500 last decade. I doubt it will be this decade. It won't be able to generate that kind of growth that they did so consistently over the years. But this stock can still nicely outperform from here. You want these dislocated stocks that have been beaten down, that have got reasonable valuations, and are starting to generate real interesting free cash flow stories. That's the setup on Netflix, a stock that's been hated, but starting to turn. And I think this turn can go on for quite some time.
Finally, Mark, when you look at the broader streaming space, Amazon's seen a lot of success in the first 2 weeks of Thursday Night Football. Obviously, that has been a big catalyst to get more on board with Prime. You look at Apple moving aggressively on sports, whether it's MLB or MLS. You think Netflix can continue to stay on the sidelines when it comes to sports streaming?
It's possible that this gives them the entree in the sports. I've talked with the management team about this numerous times over the years. The one pushback they've always had is, we're an on-demand streaming service. Like, you come on when you want to watch something, and it's on your schedule, your dime, your schedule. And sports isn't built that way. Sports is on the team's schedule. So it's kind of a different value proposition. It's also extremely expensive. I think Netflix doesn't need to get into sports. I may be wrong on that. And, I've seen Netflix pivot. They refused to get into advertising until they finally did earlier this year. So they've refused to get into sports. It's possible that they change that, going forwards. But I don't think we'll see that kind of pivot from them in the next couple of years. I think they're all in on advertising, and they're going to run this and see how well that goes.
Yeah, they've talked about sports adjacent content, not necessarily live sports, but we'll see if that shift happens. Mark, it's always good to have you on the show. Mark Mahaney, Evercore ISI Senior Managing Director and Head of Internet Research. Well, taking a look at the crypto space today, moving this morning as markets digest the Fed's hawkish moves. Take a look at Bitcoin, still below that $19,000 handle. Ethereum up about 1.5% right now. Let's bring in Yahoo Finance's David Hollerith in the flesh with us in studio today. And David, we were talking about this off camera, the correlation that we've seen with crypto moving in tandem with the equity space. So much of this is about what's happening in the macro space, but you said that you're starting to see a bit of a divergence.
Yeah, so yesterday, leading up to the FOMC, all the analysts I'd spoken with pretty much made it clear that crypto was not going to fare well following the decision, and that it's actually held up better than expected. And that break in correlation that we saw yesterday is sort of returning now. So sometimes cryptocurrencies, because they trade 24/7, will just lead stocks. We're still kind of watching. I've heard other people say that it might be shorts having to cover. So we'll have to do a wait and see here. But the expectation was that cryptocurrencies were going to fall a lot more following that Fed decision. So it's interesting, and it says a lot about sort of the investors in the sector right now.
Well, I thought it was interesting. You're at a crypto conference here in New York earlier this week, and so many people are watching the Fed decision. Not necessarily something we would have said, a few years ago. But the other thing that made headlines there were some comments coming from Ripple's Brad Garlinghouse as he faces this lawsuit from the SEC. What's the very latest on that?
Sure, yeah. So the Ripple SEC lawsuit has caught a lot of attention since Saturday. What happened was the SEC sort of released their motion, and then Ripple sort of replied in a rushed fashion between Saturday and Sunday to sort of issue their statements too. And essentially, both sides of the case are asking for the judge to come up with a decision to see whether or not it has to be brought into court. And this is, of course, about whether or not XRP, the cryptocurrency, is considered a security. The SEC thinks it is, and Ripple Labs says it's not. And that comes down to whether or not it's an investment contract, which I won't go into too much detail there. But Ripple is up 45% right now, and I won't draw a conclusion there, but I think investors are pretty happy. Garlinghouse has come out as sort of saying that, this lawsuit is dragged on it's been going on for 2 years. But it's interesting outside of the Ripple company because for the overall crypto community, like a lot of people are really seriously looking at this lawsuit as a way that might actually bring clarity regardless of who it rules in favor for.
Not just for Ripple, but for the broader space.
Yeah. And so everyone's watching that. But the truth is, for that to really happen, it needs to go to court. And Ripple is sort of like saying that they don't think it does. So we'll see what happens. But if it does go to court, it'll be dragged out longer, probably will not be settled by the end of the year. But it will be a major decision about whether or not certain cryptocurrencies are deemed securities.
So more uncertainty in at least the short term.
Yeah, through the end of the year. But we're going to see more motions in the case, and we'll see how it's progressing in terms of whether or not Ripple has more evidence on their side or the SEC, what's going on there. And an interesting thing is that a third party has stepped in recently, a blockchain lobbying firm, the Chamber of Digital Commerce, and they're basically coming in as a third party. They've been approved by the judge, and that should make things interesting.
Okay, it'll make your next few months interesting. David Hollerith, appreciate you staying on top of the story. Good to have you in studio again.
Yeah, it's great to be here.
Coming up, inflation isn't taking a bite out of Costco's $1.50 hot dog and soda combo. We're going to break down the company's latest earnings report after this short break. Well, shares of Costco moving lower this morning, well down more than 2.5% here after the wholesale retailer reported earnings that beat expectations yesterday after the bell. But Wall Street was left disappointed in after-hours trading. Brooke DePalma is here with the details. Brooke, let's start with the membership fees, because the expectation has been for a while that it is going to go up. And yet this is a company that still has a lot of loyalty baked in.
That's right, a lot of loyalty here. Renewal rate about 90%. So customers are continuing to return year over year, willing to pay that cost. Of course, yesterday on the call, Richard Galanti, Costco CFO, saying, quote, "There are no specific plans regarding a fee increase at this time. We're pleased with our growth in both top line sales and membership households over the last several quarters, and member loyalty is reflected in increasing member renewal rates. We'll let you know when something is about to happen." Of course, let's take a step back and take a look at how much exactly it costs. So for a basic membership at Costco, it's about $60. Now for their gold membership, the executive membership runs about $120. Of course, that is a little more expensive than one of its top competitors, Sam's Club, that is owned by Walmart. They recently announced an annual increase set to take effect October 17th. That's about $50 for club members, $110 for plus members. That was about a $5 increase and a $10 increase. But of course, that was the chain's first in 9 years for the basic membership, and the first time since 1999 for Sam's Club. But to give more context here on when those Costco loyal customers might expect to increase, the CFO said that typically they do every 5 years and 7 months. So the last increase was June 2017. That would bring us to January 2023. They said no plans as of yet, but it's not a matter of if it happened, in a matter of when it'll happen. Of course, Wall Street reacting to that earnings report yesterday after the bell, but Goldman this morning reiterating a buy, saying that it continues to have increased confidence in the stock as the big box retailer's strong earnings report yesterday, and they have confidence in those customers to continue to return.
So Costco is always a good gauge of where inflation is right now, but also how customers are responding. The question they get over and over on every call is, what about that hot dog and soda combo? $1.50 is still an incredible deal. Are those prices going to go up now?
Well, Akiko, those prices are not going to go up as of now. Now, this has gotten a lot of attention in this past year. It even was brought back up on the call last night. In Q3, someone tweeted that they were adding an extra $1 because of inflation. And then quickly they shut down those rumors in the third quarter earnings call. This quarter, they also addressed that. They said that the fresh foods business, they saw about 40% sales, 20+% increase each year. They said that it's an improvement on the bottom line. They have no plans to make that price higher for the hot dog and soda combo, but they have increased a few other items in that fresh foods court, you could say, but no plans to increase that price as of now. Of course, it's a staple at Costco, and so customers will certainly respond if they do.
A big sigh of relief. $1.50. I think that's cheaper than
a 20-ounce soda,
cheaper than
and
pizza.
a hot dog, cheaper than pizza, cheaper than just about anything right now.
All right. Glad to hear they're keeping it for now. Thanks for that, Brooke. It's been a rough year for home buyers, with mortgage rates now above 6% and a massive affordability crisis now taking hold. Luxury home buyers have largely been exempt from that conversation around struggling real estate, but a new report by Redfin shows rising mortgage rates are finally catching up to them. Yahoo Finance's Rhonda Lee is here with that latest report. And Rhonda, what does that tell you about where the housing market is when we say even luxury home buyers are thinking twice?
So the economists have said that this has been the worst housing affordability crisis this year. First-time home buyers, entry-level home buyers have been pushed out of market since the beginning with low-level inventory and rising rates. Earlier in the year, high-end home buyers had an edge. They were using their all-cash offers to win bidding wars. Mortgage rates have surged above 6%, causing the luxury home sales to plunge by 28%. So what's happening is, if misery loves company, then regular home buyers in the market can rejoice in the fact that knowing that even high-end home buyers are now in the same boat of, maybe this isn't a good time for me to buy.
So where does that leave buyers right now? I mean, obviously their buying power has been decreasing because those rates have been going up. Prices may be coming down on some end, but that's being padded to the actual monthly mortgage they're going to have to pay now.
So here's the deal. Most analysts say that for every 1% increase in the rates, buyers are losing about 50 grand in buying power. So for your luxury home high-end buyer, if in the beginning of the year their budget was 1.5 million, now their budget is 800,000. So for everyone's feeling a crunch now. So that in particularly now you have with the inflation, you have the fluctuation with the stock markets. They're saying that some high-end buyers are looking elsewhere for their investments instead of getting that second home or buying at these rates.
Okay, more pain to come. Rhonda Lee, thanks so much for that. Coming up on the other side, the new Apple AirPods, all the rage, but are they worth the new $250 price tag? We're going to break down the company's slew of new products launching today on the other side. Apple's new iPhone 14 is already facing some bugs. Users reported the camera on the 14 Pro shakes when using certain apps. This is more new hardware, including the new generation of AirPods and Apple Watches are being rolled out. For more on what's ahead for Apple during this release period, let's bring in Francisco Geronimo. He is the Vice President of Data Analytics at IDC Europe. Good to talk to you today. Another big day for Apple. Let's start with the iPhone 14, though. What does this upgrade cycle look like when you consider the product itself, but also some of the headwinds consumers are facing, maybe thinking twice about spending up to upgrade on their device?
Hi, indeed, that's a very interesting question, because the reality is that the majority of clients are really concerned with the cost of living, with inflation, with many other economic concerns. But the reality is that the new iPhone is not targeting those who upgraded last year. It's targeting those who upgraded 3, 4, 5 years ago. And we also know that the majority of those clients are trading in their previous phones, so getting a very interesting discount for the new one. And they are buying the phones on a financing scheme where they pay a monthly installments rather than paying a quite high price tag when they buy the new one. So at the end of the day, yes, there's some concerns, but the majority of customers and consumers are looking to upgrade to something that is performing much better than the phone they have, which they bought 4 or 5 years ago.
So to your point, I mean, there are enough cost structures out there that allow users to get this device in a more affordable way. But in terms of the features themselves, is it worth the upgrade?
Well, there's always some criticism about when a new phone comes out, how much does it look to the previous one and whether the features are worth it or not. But what we also know is that the majority of us rely more and more on smartphones. So having good cameras, having good displays, having good batteries, good storage on the phones, it's critical because this is not just about making some phone calls or playing some games with some apps. It's about our daily lives and our work. And that's why most consumers around the world are moving to better devices, higher price points, because they know that they need to pay more for a device that really helps on their lives rather than just having a device that will crash over and over. And that's what we are seeing is most consumers upgrading for better and better devices, not just from Apple, but even from other vendors. Samsung facing the same kind of opportunities, growing their sales towards higher price points, and even the Chinese players also pushing towards price points, because what consumers really want is not just a smartphone, is a phone that really helps on their lives.
Another device that's getting very strong reviews, this is the AirPods Pro that's out today. In terms of what this means for Apple, and we often have been so focused on some of their other devices like the iPhone, but this has really been a big hit for the company. When you look to the whole pie that Apple has, how significant a revenue source do you think these AirPods can be moving forward?
Yeah, that's indeed a huge opportunity for Apple. Just to give you a specific number, Apple has sold over 328 million AirPods since launch in 2017. This means $63 billion in revenues. This is a massive opportunity for Apple, and we are just touching the surface, because at the end, what we are also seeing is that the majority of users don't yet have a wireless headset, and we all know how convenient it is when we moved from a wired headset to a wireless headset. And that's the transition that most consumers are doing, and that's the opportunity that Apple has ahead in the coming years, because we see on the wearable space, this is being the biggest category and the one that is growing the fastest because of this transition to wireless devices for the convenience and how easy it is to have something on your ears rather than having wires around. So this is definitely a massive opportunity for Apple. And we are seeing, and they are leading this space with a significant market share and a significant business. 63 billion is not a small business with one category only.
Francisco Geronimo, IDC Europe Vice President of Data Analytics. Appreciate your time today.
Thank you.
Well, it's time now to take a quick detour or look at the hidden headlines you should know. And this one is literally out of this world. NASA has released new images of Neptune from the James Webb Space Telescope, showing off some of the planet's rings. NASA said the telescope's advanced technology captured the clearest view of Neptune's rings in over 30 years, since NASA's Voyager 2 captured the rings during a flyby in 1989. The Webb telescope has been releasing pictures of deep space since July, offering people a better look at the galaxies far, far away. Well, coming up next, the future of work. PagerDuty is partnering up with Salesforce in a way that the company says will make work, in their words, unstructured and unpredictable. We're going to hear from PagerDuty's CEO on the other side. Welcome back to Yahoo Finance Live. We are continuing to see a broad-based sell-off across the board here on this Friday. Now at session lows with the Dow down more than 500 points. We're talking about 1.7% there. The S&P 500 down nearly 2%. And the NASDAQ down roughly 2% as well. So much of this stemming from what we heard from the Fed on Wednesday and concerns about the central bank moving too aggressively. What that means for the broader economy. Should point out sectors we're watching today. It is red across the board, but energy really taking the brunt of the hit. And let's take a look at where oil is trading right now. When you take a look at oil futures, well, energy sector right now down about 6.5%, but oil futures down there you go, 5% or more than 5% when we're talking about WTI. So certainly a pretty ugly day across the board to round out what has been a very choppy week. Well, the future of work is changing as macro trends drive the digital acceleration. Companies are looking to automate work and collaborate in new ways, including from the cloud. Standing to gain from these trends is PagerDuty. Yahoo Finance's Brian Sazzi sat down with its CEO, Jennifer Tejada, at the Dreamforce conference in San Francisco, where they discussed digital trends and the company's take.
Salesforce has been a terrific partner to PagerDuty for the last several years. I think this is my 7th or 8th Dreamforce, but this year it's really a family reunion, and we hear customers talking about innovation, automation, leaning into the future they want to build for work, which is digital. And we're essential infrastructure that sits at the core of the always-on, sort of on-demand world now. So it's a great opportunity for us to talk about our partnership with Salesforce, where they're using us with Service Cloud, our customer service ops solution, but also a great opportunity for us to reconnect with customers we just haven't seen in a really long time.
Absolutely. So I love this panel that you were on, the automation revolution, building the new future of work. Take us through that.
So I'm a huge believer in efficiency. You could call me an efficiency geek, actually. And we believe in building automation for our users in service of freeing up people, giving them the freedom to do the purposeful, intentional work that they signed up to do when they took their jobs. And so PagerDuty uses APIs and artificial intelligence to detect work through Signal's 700 integrations in our platform and intelligently orchestrate that work to the right people in the right moment to ensure that our customers can deliver on their digital promise to their customers. And we've really found that employees are embracing automation if it reduces the toil, if it takes on the mundane work that they don't want to spend time on.
Nobody wants to push paper anymore, Jennifer.
Nobody wants to do mundane stuff.
Take us through, how does this change? How does this change the business now that this whole workforce globally, many workforces are distributed globally? They're not in a central hub. There's no more office.
Well, the developers, led the way on this. So the developer community has been distributed by design for many, many years. And as with most things, they influence the way we work, and they often drag us towards exciting innovation and change. And so PagerDuty's platform was built for distributed workers and for this concept that we call interrupt work. This idea that the way we work is shifting from being planned and structured and super predictable to actually being unstructured, unpredictable, and often time sensitive and mission critical. And there aren't platforms out there that exist from a decade ago that enable you to do this kind of work. So machine learning, AI, really helps distributed teams not only detect the work, but prioritize it, understand what's the most important thing they should be working on, and in a distributed organization, orchestrate that work to the people who have the skills, the talent, the ownership that can help them get it done.
This has been this is a very interesting time for the economy, U.S., overseas. You had a good quarter a couple weeks ago. I think it surprised a lot of folks in the street positively. What are you seeing in the business, and were you surprised?
No, I wasn't surprised. We've been consistently delivering great results. Revenue grew 34%. Net dollar retention was 124%, I think above 120 for the 7th quarter. And really that's driven by the same macro tailwinds we've been talking about for several years, which are digital acceleration. The market and the world has moved towards digital, and we support all the services and the infrastructure that drives those outcomes. Cloud adoption continues at a very strong pace, and DevOps transformation has become mainstream. We're seeing potentially a fourth tailwind, which is there's still a talent shortage for technical workers, for developers. And every customer I've talked to, as I've been traveling the world over the last several weeks and months, is telling me they're trying to figure out how to improve the productivity of their technical teams because they need to do more with the same number of people they had last year. You know, we see some companies tightening their headcount growth and really wanting to make sure that their most talented technical workers are delivering the most productivity they possibly can.
When you talk to customers, and even when you talk to your own employees inside the company, how nervous are they about rising interest rates? And does that change how you plan and operate the business as you look into next year?
Well, look, we have been playing the long game for some time and been very focused on our path to profitability. We've committed to the market that we'll be profitable by Q4 this year and for the full fiscal year next year. And that's been a multi-year plan to demonstrate economies of scale as we grow. And I think, you know, people hate change, people hate uncertainty. So I try and keep our employees focused on this long-term legacy that we're building to be the operations cloud for our customers, to really help them automate and manage the work that matters to ensure that customer experience is perfect. And we've really seen that manifest itself here at Dreamforce, talking about our application for customer service ops, which integrates into Service Cloud and helps customer service teams bridge the gap between hearing about issues from their customers and being able to work automatically in collaboration with the developers and the product teams that actually build those services and can fix those, those applications, those web apps, those mobile apps that you're used to using when they're not working as well as they're supposed to.
That was Yahoo Finance's Brian Sazzi in San Francisco with PagerDuty CEO Jennifer Tejada. Well, it's time now for our chart of the day. And today we are locking in on New York Yankees superstar Aaron Judge in his attempt to break the American League's single-season home run record. You don't have to be a Yankee fan to be following this, by the way. The chase for that record leading to a big rise in average ticket prices for a Yankee game this weekend. According to SeatGeek, ticket prices to sit in left field in hopes of maybe catching the history-breaking home run ball have nearly tripled in the past few days since Judge hit his 60th home run of the season. He now needs just 2 more to break the record. And a lot of people checking their schedules to see if they can be at Yankee Stadium when that happens. Well, coming up on the other side, move over to Pepsi. The NFL has a new halftime show sponsor as Pepsi ends its decade-long run as the namesake of the event. We'll have details on the other side. Well, Pepsi's run as a sponsor of the Super Bowl halftime show has officially come to an end after a decade. The NFL now selecting Apple Music in a multi-year partnership to sponsor the halftime show. For more on what this all means for Apple, let's bring in Yahoo Finance's Josh Schaefer. And Josh, we're just saying, I mean, Apple just has so much money, right? Why not just go out and sponsor the Super Bowl halftime show?
They could do anything they want in terms of sponsorships, right? But I think this is an interesting play for Apple for a couple reasons. And one of the main reasons is I think it's probably one of the best Super Bowl advertisements you can get, if not the best. Of course, probably expensive. The estimates beforehand were about $50 million annually is what they thought the NFL was going to get for the halftime sponsorship. But when you look at what Pepsi got last year and sort of where they came out in post-ad metrics, I remember we did a story back right after the Super Bowl with Elevate Sports Ventures and Hive looking at some analysis. Pepsi was mentioned 11 times on the broadcast.
Right. Every time you say the halftime show, you have to say the Pepsi halftime show.
Right. And so Pepsi 11 times, that was more than double the next brand. The next brand was Toyota with 6. SoFi Stadium, where it was held, was only mentioned 5 times. And then you look at how often was Pepsi on screen. Pepsi was 4th in terms of brands on screen with nearly 4 minutes on screen because they keep showing the halftime show and they keep promoting it. So you keep popping up. 120 million people watched the Super Bowl last year and watched that halftime show. And it's kind of, from the experts we talked to, it's a little bit ingratiated into your head, right? Ingrained into your head that way, where, oh, okay, it's not as obvious as an ad, and they think consumers normally kind of respond better to that. And then, of course, there's the other side of this, Akiko, with Apple getting into sports, right? And we're kind of seeing more of that too.
So Apple getting to sports, but this is an interesting one for me because it's Apple Music, right? If you think, well, okay, if Apple's going to get mentioned 11 times, is that really that big of a deal? But Apple Music, still kind of lagging behind competitors like Spotify. When you've got music at the core of the halftime show, that's a good way to integrate the product.
Right, integrate the products, probably have some special releases on Apple Music, right, that come out that I don't know who the halftime show is yet this year, I don't think that's been announced, but whoever that is, you get specials that then go on to Apple Music. And another thing too we've heard for brands that kind of connect with the NFL is people trust that more because people trust the NFL. So if you can get Apple Music presenting something instead of Spotify, people are like, oh, the NFL likes Apple Music. Maybe I should like Apple Music too. And I think that's sort of how they see this from an advertising perspective.
Yeah, I know they haven't disclosed the full terms of this, but I'd be curious to see what the return is like, right? Because how do you really measure that? If you're a company like Pepsi over the last 10 years, having those mentions, having all that advertising.
I think it's an ecosystem play too for Apple. Because I talked to Dan Ives this morning over at Wedbush Securities, and I asked him, why are they doing this? Like, what's the play here? And he said, it's the drum roll for Sunday Ticket. He's been long on the fact that they already have Sunday Ticket and it's gonna come, but he's like, this is the sign that they're beating Amazon for that. And so then you have NFL Sunday Ticket, you're in the advertising, hopefully someone's watching it on an iPhone, all of a sudden the entire NFL experience is Apple or Amazon oriented, which would be pretty crazy.
It all connects. Josh, thanks so much for bringing us that story. Let's do a final check of the markets before we let you go. We have seen a broad-based sell-off across the board here, with the Dow now down more than nearly 2% here, really across all three majors. The S&P 500 down about.
Well, that's something people are kind of thinking
An
about.
eventful day of earnings. Julian Emanuel mentioning 20% of market cap was already reported, and we'll give you coverage of this on surveillance through the coming weeks, including that tech overload. Is it next week we get? Massive
Thursday.
Tech overload. We'll have to see on that. Red and green on the screen. We're watching London. Lizzie Burden is at 10 Downing Street. And Sterling, a 111.97. Stay with us.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Officials in China are said to be debating whether to reduce the amount of time people entering the country must spend in quarantine. They're considering setting the period to 2 days in a hotel and then 5 days at home versus the current 7 days in a hotel and 3 at home. The country's COVID-0 policy is leaving it increasingly isolated from the rest of the world. Hong Kong is reportedly looking to allow VIP bankers who test positive for COVID-19 during a gathering next month leave the city via private jet. About 200 people from global firms, including banks, securities companies, and asset managers, are set to attend the 2-day HKMA summit. Infected guests without their own planes may be allowed to isolate in their hotel rooms. Australian employment unexpectedly stalled in September, while the jobless rate held steady, a result that reinforces the Reserve Bank's decision to slow the pace of policy tightening. Employment advanced by just 900 people from August, well shy of the 25,000 gain forecast by economists. Unemployment held at 3.5%. Hermes sales have surged as luxury shoppers in China return to stores after pandemic restrictions eased, snapping up Birkin and Kelly handbags. Third quarter revenue rose 24%, excluding currency swings, topping analyst estimates. The results are more evidence that producers of luxury goods remain largely immune to the wider squeeze of spending. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
知っていましたか？実は暖房で温めた熱は大部分窓から逃げてしまっているんです。一般的な家の窓ガラスは1枚。そこでリクシルは熱を逃しにくい三重ガラスにしました。お住まいのまま窓だけをリフォームできて断熱効果を高め、省エネに、省エネ窓で CO2 の削減にも。いつもお幸せにリクシル。
人も街も変わっていくけど変わらないものだってある。特別ではないけどどれもかけがえのない大切な幸せ。顔を上げれば私の世界はいつだってなかなかのもんだ。
My message to the American energy companies is this: you should not be using your profits to buy back stock or for dividends. Not now, not while a war is raging. You should be using these record-breaking profits to increase production and refining.
The president speaking there on hydrocarbons yesterday, of course, X number of days before a critical, always critical midterm election. Couple market notes as we do housekeeping to keep you advised through the morning. Yen 150 print 2 hours ago, 149.78 is a weaker yen. That's demonstrable. Oil, not a story. We'll get to that in a moment. Well, a little if no oil. I stand corrected. Up $1. Futures red and green don't give us any love at all. And Chris from Tahiti emails, and thank you for watching in Micronesia. Gilts, British gilts extend their gain. This is price up, yield down. And Lisa from a 5%-ish level down to 3.87% on the 30-year British gilt.
I'm sorry, I'm busy watching the live stream of a head of lettuce and seeing whether it
Explain this to our American audience, because this is Greek to me too.
Tabloids in the UK have a live stream of a head of lettuce from Tesco, and they want to see if that will outlast Liz Truss's prime ministership. And there's even an entire, betting system around this, with people betting on the lettuce.
Well, it's a movable story. Let us go to some of the breaking news there. Lizzie Burden outside 10 Downing Street as well. Lisa, why don't you bring in Kevin Book? But Lisa, you and I saw something yesterday both of us have never seen, which is a White House is a Wall Street oil strategist.
Okay, one of the most stunning things that I saw yesterday was the White House putting a floor under crude prices at $67 to $71, $72 a barrel as an attempt to shore up confidence by oil companies so that they would invest. What does this say to the rest of the market in terms of how closely they will be intervening at a time where it's unclear what they can do on the key products of refined goods? Kevin Book is joining us, head of research at Clearview Energy Partners. What did you make yesterday, Kevin, of all of the rhetoric out of the White House?
Good morning, Lisa and Tom. Look, let me back up just a little bit and ask a question about where we are in market democracy. Markets essentially allocate by price and scarcity. Democracies allocate power through popularity, and scarcity isn't popular. So something's got to give. You can ask, are we looking at markets as they were? And the answer, I think you referred to this just a few minutes ago, is no, absolutely not. Governments are stepping in. We call it an age of intervention. But on the supply side, there's not a lot that governments, especially the government of the United States, can do because it doesn't have an oil company. So it's trying to send a signal to the companies that are out there that there is some demand that the government is willing to provide, and therefore a floor on prices. Not obviously going to convince when the price is skewed $20 to the upside with that floor, but it could have some potential to persuade if that free hedge stays on the books long enough for companies to use it.
Kevin, none of this really makes sense unless you view it through a political lens, because gasoline prices have come down dramatically and the real problem remains in diesel. And you're seeing those prices remain high and stockpiles fall to the lowest levels in decades. And there is very real concern that we will not have enough heading into the winter. What's your view on why now and what could actually be done and how perilous the situation in the diesel stockpiles really is?
Well, perilous because in February, the European Union is supposed to block Russian imports of Russian products, which means that if those products don't find other markets, more diesel scarcity coming when we're already short. One thing we didn't see yesterday, Lisa, was a product export limit. It's been talked about since March, June a lot, September continuously. Nothing yesterday, but I don't know that we're done, Tom.
Well, this is important. Lisa grilled Brian Deese yesterday on this, on the export question. Explain to our audience the ambiguities of a U.S. exporting hydrocarbons versus a U.S. saying, no, we're done with that.
Yeah, we've been essentially exporting products on a net basis for more than a decade and really going gangbusters with diesel. Price signals out there in the world calling for our inventories as an essential moderating part of balancing the market. And so inventories are extremely low in the Northeast, 60%, more than 60% below the 5-year average for distillate fuel. That's a real concern for policymakers going into the risks of shortage.
I look, Kevin, at the price of oil, and one thing we can say, and I'm beginning to see little tea leaves of China capitulating on quarantine of travel. In your Clearview model, is there the idea demand comes back in Asia, and what does that do to Brent at 93?
Well, if we've been looking at the Chinese effect on demand depressing crude prices relative to where they might go, again, let's just back up. Russian fossil fuel exports 5.5% of global consumption for decades. We're now missing 1.3 percentage points with more to fall away. If you come on the demand side strong from China, then you're going to tighten markets a lot. Now, you might argue inventories are still below the 5-year average for global petroleum OECD stocks. That means that there's still room. But of course, OPEC just cut.
Well, Kevin,
go ahead.
Just real quick. No, I want to link this into what we're seeing over in Europe, because you were talking about the potential export control. Where could we see the price of diesel? How much could we see it increase? How could we see the price of natural gas increase if there is some sort of export ban, or even not, but just based on where inventories are right now?
Well, we don't think that we're likely to see a natural gas export limit. Lisa, here in the United States, the White House, I think, has been pretty clear about trying to support allies by providing supply. But in terms of permitting new plants, in terms of getting through the regulatory process, high prices here at home may be already starting to put the brakes on that. In terms of diesel exports, about 10% of distillate in the U.S. is exported to Europe. So significant but not dominant from our export portfolio. We export zero gasoline, right? The gasoline price is really the political meter that so many people watch, but more than half of our gasoline goes to Mexico. So if there's export limits on hydrocarbons writ large, particularly on liquid fuels, then there's other parts of the world that could be short a lot sooner.
Kevin, terrific brief. Thank you so much. Kevin Book, Clearview Energy here. And with oil up a stick, $86.98, make it $87. American oil, $94. Brent crude, and I mean, it's not that far from 100. We have, as we mentioned, many pivots today, and one of them is the continuing news flow out of the United Kingdom. Graham Brady is with this, for me, not strange, that's the wrong word, but foreign 1922 committee. He runs it. These are the committee that makes the rules, Lisa, if a prime minister comes or goes, how many votes are needed, how do you get to one candidate, 2 candidates, 5 candidates, etc. And he's walked through the door of 10 Downing Street.
The clock is ticking, and I will just say that you're seeing the metaphor of that head of lettuce on Twitter pretty much lighting up the screen as people say it looks like it's going to win. How much are we looking at the last hours, as Lizzie Burden said, of Liz Truss's prime ministership? But what comes next, right? Because it's coming at a time when the economy is facing a really difficult moment where right now the Tories are flat on their backs, but there isn't a clear leader. Do we actually see Boris Johnson come back?
I don't hear that much. It's it's not our territory, but I will make clear, folks, the idea of Prime Minister Johnson returning is not in the zeitgeist this morning. It's about the former Chancellor, Mr. Sunak. I even don't hear Michael Gove much talked about as well. But again, it's a movable feast. I would say at 7 o'clock here, Wall Street time, the dialogue has changed for Lizzie Burden just in the last 60 minutes as well at 10 Downing Street. We're following that story. We're following higher yields. Futures go green now. Futures up 11. It's too much optimism. We've got to speak with Chris Harvey.
Enjoy TikTok!
喋れよ。もう急にやめてくださいよ。お前どんだけ TikTok を楽しんでんだよ。いや面白くて止まんないんすよ。あのな、TikTok は1日の視聴時間を決められるからな。ほらスクリーンタイム設定。へえ助かるかも。そうだろ。俺も TikTok 見てみろかな。あれ？あ、もう時間来ちゃってますよ。ちょっとお前の貸して。嫌です。貸してみろよ。嫌です。Enjoy TikTok! ケチ。
I think the Fed's going to be able to get inflationary pressures to subside, but at what cost?
They're not at levels where one can say we can declare victory now.
Over the next 3 to 6 months, we still have a lot of monetary policy tightening ahead of us.
It may be some time before we get back to low rates.
I don't see 2% rates coming back anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. Mr. Farrow on assignment. Futures up 7. Dow futures up 115. It doesn't matter. There's extraordinary movement of a number of different stories. And I guess, Lisa, we're not doing politics 101, but there we are. It is a movable story at 10 Downing Street.
It seems like the clock is ticking down on Liz Truss's prime ministership, and she's just getting to the end. She acknowledges Wednesday was a difficult day, file under, no kidding, and she is definitely under incredible pressure.
Moves.
She is going to evidently be meeting with Graham Brady. She has been asked to meet with him. He is the member of parliament for Sale West. All of these questions right now around what happens with Britain at a time when it's facing incredible inflation, high rates, and an economy headed downward.
The market's so important now. We're going to do that first and then go to Lizzie Burden at 10 Downing Street. We'll keep up to date on that story. Sterling was a 111 handle. We're now out to a 112.21. Buoyant, I would suggest 112.50 is a different story, to say the least. Completely idiosyncratic. Turkish lira just gives way as they cut their interest rate that's been widely anticipated. Erdogan doing Erdogan 101 economics, 8.60, a new level for Turkish weakness. You like how he slipped that in there?
Yeah, that was good. I like that. Actually, it is. It's sort of the unconventional monetary policy getting absolutely hammered in the currency market, which is the relief valve that we've seen certainly when it comes to Japan as well. And the yen there weakening. Continuing, though, to watch the front end of the U.S. yield curve, which arguably is pressuring everything.
Can we frame a 5% 2-year?
I think that we can. I mean, people are framing out a 5% Fed funds rate by March of next year. I mean, is that going to stick for 2 years? I don't know. But people are talking now about a new regime that's been moved up. And how much is that exacerbating the political woes that we're seeing right now around the world, in particular with the UK?
Brent crude, $94 a barrel. Let me go. I'm going to focus on foreign exchange, this data check. We welcome all of you from Global at Wall Street. We don't have a 113 DXY, but we're getting there quickly. Yen, a 150 print 2 hours ago, 149.78. Everyone there watching the Ministry of Finance. Euro doesn't give me much information, 0.98. When's the ECB meeting? Is October 27th.
Something like
I think
that.
something like that. Swiss franc is weaker. That's important. We haven't talked about Euro Swissy, and that's some relief there for the Swiss government and the SNB. Sterling 112.09 is moving around. Can't keep score of that as well. Futures up 11. Lisa?
So let's just talk about what we're looking at today quickly. 8:30 a.m. we get a U.S. initial jobless claims. Do we see that tick up that so many Fed members are looking for in this perverse reality where a softening economy is actually exactly what they're looking for? We get a host of Fed speak. Philadelphia Fed President Patrick Harker. Tom will be watching that closely. Fed Governor Philip Jefferson. Fed Governor Lisa Cook. Fed Governor Michelle Bowman, among the many voices. And then earnings do continue. We did just get Blackstone, which was a beat. We'll go into that later. Freeport-McMoRan coming out as well. American Airlines, Snap, and Whirlpool all after the bell. Snap and Whirlpool in particular. How much do we get a feeling as 20% of the S&P has reported that we are in a good phase? Because right now, if you take a look at Alcoa, those shares down almost 11% on the heels of a disappointment, a bellwether potentially of the metal industry.
Am I right that it's each company is a different story? I don't see a holistic thing here right now.
The pressures are holistic. FX pressures first and foremost among them, but how they cope with them and their pricing power is different depending on who their customer is and depending on how essential their goods are to what people do with their lives.
Let's do what you need, which is recalibration of the equity markets here at 37.19 on the Standard & Poor's 500. Christopher Harvey joins us, head of equity strategy at Wells Fargo. Chris, let's get to your breaking news from Wells Fargo, and that's simply you go a little bit tepid on the banks. What did Mr. Diamond get wrong?
He didn't get anything wrong. We've been thinking about downgrading the banks from overweight for some time. It just doesn't fit with our secular themes. We really want to reduce our exposure to cyclicality. We really want to barbell more defensive assets with GARPy type assets, and banks just didn't fit in there. It's more of a macro issue than anything else. And if you look at how banks report and look at the numbers, they popped, they're performing in line with the market. And we thought this was a good time just to step off this trade. Nothing that we really don't like about the banks, but we do think it's just more of a market perform. As we think about things too, sentiment or the macro sentiment's going to be an overhang, and we just don't want to fight that. We think there are better opportunities out there for us.
Chris, does this earnings season matter? Is it giving us any forward look at what's going to happen, or is this basically going to create a revaluation that can make you double down more effectively on your theses?
When you say does it matter, absolutely it matters. What are we looking for? We're looking for forward guidance. We're looking for how the consumer is holding up. We're looking for margins. And for the most part, what we're seeing is the consumer's okay, right? There's a lot of fear about the consumer, what we think the consumer is doing and what's happening with the consumer. They're being pulled further and further out on the ledge, but they're not there just yet. Margins have come under pressure. They continue to come under pressure, but they haven't cracked the way a lot of people have thought. And the issue with forward guidance at this juncture is you're not going to get a ton of really far-looking forward guidance. I think that comes at the beginning of next year. So when a lot of people talk about numbers coming down, I think they're a little bit too early. You're not going to see those numbers come down if and when we go into recession, because that's a 2023 thing. You're not going to go out on a limb and start talking about very aggressively about 2023 right here, right now. And what we're hearing from companies is things are okay. As Tom pointed out, you're not being saved by the broader market, but if you have good underlying fundamentals, if you have good trends, you are being rewarded, and that's important.
Chris, we've been talking all morning about the yield lift that we've seen in the front end of the curve, how we're gaming out what a 5% two-year yield could potentially even look like. How closely are you as an equity investor watching the front end for some sort of sense of how much you need to bring down your valuations when CPIs around the world keep performing to the upside, continue to surprise to the upside?
Right. So So Lisa, when we look at the yield curve, we'll look at the front end for indications of where the Fed's going to go. Right, the front end has been a good indication of whether the Fed's going to get more hawkish. You see the front end pop up, Fed's going to be more hawkish. When we look at the middle part of the curve, the 10-year, that's really more about valuation. So if you continue to see the front end rise, that just means the Fed's not ready to stop, or the Fed won't stop because they're following what the front end is doing. But the valuation is really more about the 10-year at this point in time, and the 10-year is really caught up with what's happening over in Europe and the gravity European rates have on the 10-year.
Chris, I want to talk about a factor nobody ever talks about, and I give a nod to the Meghdon Desai, who owns this at the London School of Economics, and that is a factor called profitability. Out 18 months, out 12 months, will there be a partition between evidently profitable companies and those non-profitable?
So Tom, when we think about profitability, when we think about quality, we think about balance sheets, we think about ROE, ROIC, we think about profitability, and we think about net profit margins. And so it's very important for our quality factors and the way we characterize quality stocks. And so is it going to be important? Absolutely, it's going to be important. We think we're going into a higher quality environment. And so those companies that are more profitable should be better, more rewarded by the marketplace. And we've seen that year to date. There's also a bit of a duration component to some of these things, but absolutely we look at profitability, and we do think it's going to be very influential on stock pricing. It's something that we're placing a lot of focus on.
Your SPX target here, out 12 months. You've done a year-end target, 12/31/2023. Help me.
We haven't. What we're saying about 2023 is we think the first half is going to be really sloppy. That's when we think numbers come down. That's when we think we're going to be dealing with a recession. And what we want clients to do is on these rallies, we want them to reposition. We want them to get longer, quote unquote, momentum, because that actually is a more defensive strategy. We want them to barbell momentum or low vol with some of the GARP type names. We've seen some good reports from some of these GARP names or some re-rated stocks, but we haven't put a 12/23 number out just yet.
Chris Harvey, thank you so much with Wells Fargo Securities. Any number of stories we're watching again in London. The travails of Prime Minister Truss. Peston over at ITV says Truss called for the meeting. I don't know what that means, but what we're really looking at is the follow-on to our conversation yesterday with Scott Kirby of United Airlines. And, you know, you look at American Airlines, and I really don't know the nuances. I mean, I don't know who's serving the best beverage of my choice. But what I see here is American Airlines telling me they're really back to 2019 business.
Again, this is yet another major U.S. airline coming out and beating expectations, the shares popping after they came out. But really, this highlights how much people are willing to pay for tickets. People are wanting to travel regardless of how much you've seen the inflation really increase the cost of that. Also notable that American Airlines is on track to reduce debt levels by $15 billion by 2025. And this really feeds into a theme of a Bank of America fund manager survey where the highest proportion of investors surveyed said they would like companies to use their cash to reduce debt than invest in CapEx or buy back their shares. The fiscal discipline is something that we're seeing not only for governments, but also for corporations.
And now, folks, we go to what matters. Angeline Rascoe reporting off our London desk in Paris on a small stock called Hermes. And they have, Lisa, the Birkin 25 bag in Togo leather, costing $7,242. In Hermes reporting, you can nudge that puppy up over $8,000 here with price increases.
My favorite thing is that you look at me with a handbag, but it's you who's more interested in a Hermes handbag than me. And I will just say this, that with respect to all of these pricing, it goes back to luxury goods.
You mentioned LVMH.
Being able to continue to up their prices and sell just as much because you are seeing a real divergence, an even bigger divergence between the upper and the lower income households. You can see that with Hermes.
Hermes opening on Madison Avenue in New York, and they announced today they will open a new store in Shanghai.
Interesting.
As they look forward to Asia opening up. So there's just too much optimism. Come back. This is Bloomberg.
$8,000 for a handbag. what are we coming to? Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukrainians are being warned of rolling blackouts because of damage to the country's power infrastructure from Russian missile attacks, with President Volodymyr Zelensky urging people to use as little electricity as possible. Zelensky has said about 30% of Ukrainian power stations have been destroyed since October 10th. And Italy's Silvio Berlusconi has told lawmakers that President Zelensky forced Russian President Vladimir Putin into an endless war. That's according to audio obtained by an Italian newswire. That recording reveals the existing pressure on the right-wing coalition that won elections last month to soften Italy's stance toward Russia. Liz Truss's premiership is looking increasingly fragile after a day of drama at Westminster. The British leader fired one minister over a security breach, and two others were heard resigning amid the fallout from a chaotic Commons vote before agreeing to stay in their posts. Many Conservative lawmakers now want Truss to resign immediately. Australian employment unexpectedly stalled in September, while the jobless rate held steady, a result that reinforces the Reserve Bank's decision to slow pace of policy tightening. Employment advanced by just 900 people from August, well shy of the 25,000 gain forecast by economists. Unemployment held at 3.5%. Cargo volumes at the Port of Los Angeles fell for a second month in September. The number of containers handled in a historically peak season were down 22% from a year ago, the lowest amount for September in 7 years. The head of the nation's busiest container port says the outlook remains soft for the rest of 2022. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Duda 初ハイクラス転職サービス Duda X 始まる。
We did not have a full briefing of the package the night before. To be fair, we had some briefing from them ex ante on the fiscal event, on the things they thought it would be in, but we did not get the normal briefing that we would get for a budget.
Quoting the Latin, the Bank of England Deputy Governor, John Cunliffe's a really interesting guy teaching at the University of Western Ontario years ago, a hugely prestigious school in the Western Hemisphere, and of course doing duties for a Bank of England. We've got all sorts of different news flow this morning. Futures now go green, up 16, Dow futures up 184. The VIX has been static for 6 weeks, 30.79. It ought to be 29 or 28. It's not. We'll get to the yield story here in a moment. For those of you waking up in America, it is different in the United Kingdom than it was yesterday, and certainly within the chaos of 10 days ago. Our Guy Johnson is a student of this and joins us from London this morning. Guy, in your briefing to me this morning, you made clear something has changed in the economics and the politics of the chaos. What is it?
So I think what's happening here, Tom, and we'll wait to see exactly what is happening with Liz Truss. Looks like we might be entering the end game there. But what you're getting here is a divorce between the party pantomime that is taking place in Westminster right now and what is happening with the politics of whether or not Liz Truss survives and who will replace her and who will be the Chancellor, and what is happening in the City of London. The two feel like they're on very different pages now, Tom. You've got relative stability in the markets today, little pop in the pound over the last half hour or so, but I don't think it is substantial enough to really merit a raising of an eyebrow. So you've now got basically stability, macro stability, which allows maybe the end game of the politics to unfold. And what we saw last night, the chaos in Parliament, I think is now having the aftershock of that is now being felt. So Graham Brady is now inside 10 Downing Street. He is the guy that basically determines the kind of the rule book as to how leadership challenges are mounted or not mounted. And I think we're watching potentially the end game unfold here, Lisa.
How messy could this be? And what does that mean for markets? Because right now there's relative calm. Yields are lower across the board. You're seeing a little bit of stability in the pound. Yet if we start to get a general election, or if we start to get some sort of sense of Boris Johnson coming back, what does that do to that stability?
I think it's very hard to tell. I think the best case scenario here is that you either get Rishi Sunak taking over as Prime Minister, or you get Hunt taking over as Prime Minister. If Rishi takes over, Hunt remains as Chancellor. That is the kind of stability, certainly, I think the Conservative Party is craving after we saw what happened last night. Are they prepared to go back to Boris Johnson? Clearly, there are those within the party. I note the Doris tweet this morning who would like to see that happen. But I think it may be the moment for the grey men. We saw that a few days ago being talked about, and I think you're slowly seeing that becoming a reality here. They want stability. They crave stability. I'm not sure Boris Johnson would bring that back right now.
Okay.
We're still potentially 2.5 years away from a general election, Lisa.
How much does this actually change the whole landscape? If you're looking for a technocrat after a very emotionally driven debate over Brexit, after an emotionally driven debate around helping households, what does it look like in terms of the depth of a potential downturn in the face of energy prices, in the face of double-digit inflation, in the face of rates that are going to be higher and a pound that's going to be lower?
You're going to have a recession in this country. It is going to be probably a fairly deep one. It's going to be unpleasant. In some ways, maybe it is required as well that the UK now goes through this. I was joking with Marcus Ashworth upstairs a few minutes ago. We were talking about the moron tax that effectively the UK now is having to pay. You need to get through that. You need to calm the situation down. As you say, maybe a technocratic government is ultimately the way to achieve that. It's interesting that comparisons are being made with Italy right now.
Well, comparisons are made with Italy, and Maria Taddeo sent me a note this morning on the interesting Italian politics, again, of Berlusconi being visible and coming back. What is Boris Johnson doing right now? I mean, Guy, my knowledge on this is The Crown and Anthony Eden, and I'm not that very good at it. What is Johnson part of the dialogue of Tories in the 1922 committee?
I think, Tom, as I say, there are some that would maybe like to see him back. There would maybe some that would like to see his sort of cakeism return, that sort of boosterism, that positivity. But in some ways, it comes with instability, and that's the challenge at the moment. The Tory party has experienced much volatility, continues to experience much volatility. I suspect that they would want that volatility to stop. Right. I'm not sure that they would get that with Boris Johnson. I don't know where Boris Johnson is. I've seen tweets of him on a Caribbean beach. I can no longer guarantee that that's where he is.
Eating lettuce.
I don't know, Tom. I don't know where he is. I'm sure he's watching with great interest.
Guy, help.
But he has a bank balance to fill.
Guy, help our American audience here at 7:23 a.m. New York time. What happens today? What's your best guess?
To be honest, Tom, I think it is very unclear. I think the fact that Sir Graham Brady is inside 10 Downing Street speaks volumes. I don't think it was the resignation of Braverman last night that has been the catalyst for this. I think it was the chaotic scenes in the House of Commons. Liz Truss clearly has no authority. You need somebody to run this government. In theory, it should not be the Chancellor of the Exchequer, but at the moment it looks like it is. So she completely lacks authority. You've had ministers quitting last night. I think more importantly, you had the Chief Whip and the Deputy Chief Whip appear to resign and then unresign. It was just chaos, Tom. And enough is enough, I think, for many people within the Conservative Party this morning. They want change now. They'd hope that they could get to the end of the month. Doesn't look like that maybe is going to happen.
Just a terrific and knowledgeable brief. Guy Johnson there from our studios at Queen Victoria Street this morning. We're going to try to get back to economics, finance, and investment with Bremo. We can do this on yield. Am I right, Lisa, that over the last couple of days we've seen a shift in yields up, not so much dynamics in yields?
Exactly, and across the entire curve. So not only are you seeing it on the 2-year, but also the 10-year yield. Basically, people are seeing the likelihood of inflation remaining high for a longer period of time. I keep going back to this. Right now, markets are pricing in a 5% Fed funds rate for
really,
the first
you can
half.
Say that 5.00?
Yes, for the first half of next year. We are now pricing that in as a base case. How much has that really been adapted into the broader market, especially considering that after that, there still are cuts priced in, that the Fed's going to have to back away, even though they're saying we're going to hold it there for a while.
On the Bloomberg 7.20%, 30-year bank rate mortgage. Please stay with us. This is Bloomberg.
ネット保険に新しい選択肢。花咲生命を検索してくれましたね。
沢村一樹？
沢村一気に見積もりです。生年月日、性別を入れるだけで一気に見積もりドン。
あ、簡単。
30歳女性の場合、医療保険が月々なんと
1624円。
花咲の見積もりって簡単だね。さああなたも一気に見積もり。
スマホでサクサク花咲生命。今すぐ花咲生命で検索。日本生命グループの花咲生命。
Thursday, Bloomberg surveillance in 1 hour, claims which seem so secondary to all that's going on today. Red and green on the screen, futures up 9, and futures have been all over the place. I'm not going to give you a vector on the equity market this morning. Yields more exciting early on. They've come back a little bit. 2-year yield, I'm still not used to this, 4.57%. Oil gives me a $1 lift, $94 on Brent crude. Pay attention to that, particularly with what we hear from the White House. And in the currency space, a churn now after the drama of week yen this morning, 150. In the equity markets, it's about earnings. Lisa, what do we have?
Well, yeah, about 20% of the S&P has reported. And what's catching my eye, first of all, Alcoa, and I mentioned this earlier, but this is the aluminum producer that signaled an actual loss in this quarter. They actually posted a loss, and they highlighted that higher costs are facing, are really crimping their margins and falling prices. This is the problem with a time of inflation, but also quickly deteriorating demand. And you're seeing that in China. You're seeing that around the world for particular, computer devices. So at what point does this act as a bellwether at a time where we see strength in other areas?
American Airlines, completely different story.
Well, this is the travel story, right? People aren't buying goods as much. They're still traveling. Those shares up ahead of the market, nearly 3% after reporting better than expected earnings, increasing their full year forecast. They can charge more, and people keep coming. We saw this from United. We saw this from Delta. So even as Alcoa is flat on its back with an 11% decline, you still see that gain in American Airlines. And Tesla shares are lower by more than 5%. After shipments were lower than expected. Well, Elon Musk talking about a recession or some sort of downturn, economic downturn in China, talked about a lack of demand there. He talked about different supply chain kinks that were difficult for him.
Yeah.
He also talked about Twitter and how he knew he was overpaying for it, but he was going to do stock buybacks. He was all over the place. But right now, the takeaway is they missed and they're being punished.
A mixed sell side. I read Ite Macaulay's note at Citigroup very, very carefully on Tesla, talking about a little bit of margin erosion there. But I honestly don't know what to make of it. Other than when I watch the baseball playoffs, everybody's selling EVs.
Yeah.
I mean, that's what they're doing.
Well, but the competition, that's exactly the point. And so some of the subsidies are affecting their competition and supporting them.
Yeah.
But honestly, all of these earnings, you really nailed it, Tom. They are not the same story. So what is the cohesive narrative emerging at a time of incredible flux?
We'll turn to Wall Street for that analysis, and of course, Bloomberg Intelligence and Gina Martin Adams and her team through the coming weeks. Again, red and green on the screen. And right now, we're going to digress here. We're still watching the United Kingdom. Guy Johnson and Lizzie Burden helping us out this morning. But for global Wall Street, it's about good, ample liquidity. Deborah Cunningham has been with us often. She's Global Liquidity's Market Chief Investment Officer at Federated Hermes. We're thrilled that she could join this morning. Deborah, instead of me asking some question I sort of kind of know about, when you go into a meeting at 10:30 this morning, what is your first statement to your team on the liquidity of the market?
Well, the liquidity of the market remains good. It's one of those things that it's not being tried or tested right now. There is a lot of cash on the front end, despite the fact that U.S. savings are down, from their high points. They're up a little bit month over month, and people continue to have a pretty high cash coffer. In addition to retail, you've also got industrial firms with a lot of cash in the front end of the market. And then from an investment perspective, certainly a lot of people have moved out of the long end of the bond market. A lot of people have moved out of the equity market, and they moved into liquidity products. So because there is a lot of cash in this market, Tom, you've got ample liquidity. There's no real issue there.
Deborah, where is it coming from? The flows into the United States, are they all domestic? How much is coming from overseas, taking advantage of both the dollar and rates?
Well, we are being impacted to some degree from some of the slower markets in, the global economy. But a lot of our strength, if you will, and the liquidity in the marketplace is coming right here. It's homegrown. Some of I heard you talking about the UK issues and some of the things that are happening in Europe from a heating perspective. And although those are huge issues and problems causing a lot of volatility in the global markets, in the U.S. it hasn't come through as much. Earnings, despite the fact that Alcoa is down, you've got a lot of other companies. 2/3 of the earnings that have come in for the third quarter have come in beating estimates, not beating by very much, but beating estimates. So there's cash on a homegrown basis to be used and to keep the market very highly liquid at this point. We still ask every day, when is it time to extend? The yield curve is higher, it's steeper, and it's expected to remain that way for longer. But we still have to ask every single day, when is the time to extend? When is that, trend that we've been in going to stop?
Do you see any sign of it anytime soon?
Not really. I mean, it's obviously being driven by inflation. And, with very sticky types of inflation, like wage inflation, like goods inflation, like supply chain disruption and parts inflation, we don't see that changing in a very short fashion. The Fed is, on a path that's going to continue into 2023 and then probably doesn't start the downward turn until 2024.
Should our listeners and viewers, Deborah, consider the path of the 2-year yield to be smooth, quiet, linear, or does it get lumpy and ugly and nonlinear as you migrate to 5%?
I think lumpy and choppy is a good way to describe it. Right now, you have basically 1 year, 2 year, and 3 year all right on top of each other. And that's kind of an anomaly. I don't know that stays that way for a long period of time. As we move towards higher rates, 4.5%, 5%, you're going to see some choppiness and some lumpiness in your terms in that 2-year sector of the curve.
On single point duration, what are you doing? As Federated Hermes, are you coming in on duration? Are you extending out to pick up that yield?
We're actually not extending yet, but we are way off of our lows from a duration standpoint. So, we're basically median at this point.
Real quick here, Deborah, I'm curious from your perspective. We heard about the Treasury potentially, or the Federal Reserve, buying back certain treasuries at discounted prices to help with some of the functioning of the liquidity in this market. Do you think that this would help? Would this actually serve as some sort of ballast for yields, at least creating a bit of a ceiling in the near term?
I think the longer end of the market beyond, 2 years has been saturated to some degree with supply, while the short end of the Treasury marketplace, 2 years and under, and particularly 1 year and under where money market funds can buy, has, had extra low supply with a huge amount of demand. So to me, it would not necessarily be changing the amount of Treasury securities that are in the market and depleting it, but rather having more supply on the front end where a lot of the cash continues to reside.
Deborah, thank you so much. Deborah Cunningham with us with Federated Hermes this morning here on liquidity and on the yields as well. The 2-year yield we mentioned, 4.57%. Okay, it's distant from 5%, but I'm sorry, folks, it's still a shock to say that to you. The short term used to be LIBOR OIS, and now there's all this other stuff that Ira Jersey explains to me, and it goes in this year and
I can tell.
Comes out this year.
With your nap that happens with the auctions. Right now I am looking also at oil prices, and we talked a lot about this yesterday. How many people have come on this show and said that they're very concerned heading into this winter with where we're going with stockpiles, with where the SPR has been drawn down to the lowest levels going back to the early 1980s. There isn't the same kind of lever that can be pulled. What does that mean in terms of the inflationary push heading into year end?
The perverseness, and I'm not predicting this, folks, in any way, and I don't mean to be political in any way, but with what we heard from Brian Deese yesterday and Amos Hochstein about gaming whatever the strategic political reserve is, that on election day, Brent crude is at 100.
Well, I mean, this is, but how much control do they actually have over it?
They don't.
And it's not just the
don't.
crude, it's also the distillate market. And I keep talking about diesel because if you look at diesel prices, they've gone up pretty significantly. And this is what people need for all of the trucking of all of the goods and heating homes, because a lot of them are fueled by diesel-generated engines. So how much do you really end up in a sort of tenuous situation, which we heard about from Kevin Book?
You were beating Brian Deese to a pulp yesterday, and all I could think about is they need a cup of coffee with Steve Schork of the Schork Report. We'll explain to the president, I'm sorry, sir, there's 3 major airports and 20 million people, and they heat with heating oil and focus on New York
They
Harbor.
know this. The problem is that they don't really have the tools to really deal with it. And so how do you
Why
deal
do we
with a
expect
political...
that they would have the tools to deal with it?
Right? So why is that the political expectation? And yet here we are, the litmus test of inflation very much heading up on the gasoline stations that you see around the country.
How quaint. Let's look at predicted news here on Pivot Thursday, where there's any number of stories that are dynamic and moving. We have yet to speak of claims. It's weekly data. It's been a little elevated, but not that elevated. Is that the right analysis?
We haven't
here,
really
50
seen,
minutes away?
we haven't really seen true weakness, and it's not expected to come out. I was looking at one
a higher
before.
number is true weakness.
Higher number is better for the Fed, worse for the economy, ostensibly in terms of people perhaps losing their jobs. I saw a report yesterday. There are a significant number of people in the United States that are working several jobs in order to pay for inflation. How does this data capture that? How do you capture a very bifurcated workforce that has changed and changed significantly? This is one of the things that I keep reading about. What are we actually seeing? Is there actually more weakness in the market than we're actually observing?
And look at housing coming out later. Lisa, let's, I get it. We talk about New York too much. Cleveland, Ohio. Thank you, Cleveland.com. Up 8.5% in Ohio from a year prior.
You mean in terms
home
of
prices.
home prices? Yeah, they're not going down. But this is what we heard earlier.
That's a
There's
big
just
number
lack
on
of
your.
supply. And even though the mortgage rates the highest since 1990. At least
Housing data 10 a.m. We'll have it for you as well. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Officials in China are said to be debating whether to reduce the amount of time people entering the country must spend in quarantine. They're considering setting the period to 2 days in a hotel and then 5 days at home versus the current 7 days in a hotel and 3 at home. The country's COVID-0 policy is leaving it increasingly isolated from the rest of the world. Hong Kong is reportedly looking to allow VIP bankers who test positive for COVID-19 during a gathering next month leave the city via private jet. About 200 people from global firms, including banks, security companies, and asset managers, are set to attend the 2-day HKMA summit. Infected guests without their own planes may be allowed to isolate in their hotel rooms. Malaysia will hold its general election on November 19th, with the Prime Minister's party looking to capitalize on a string of victories from local polls. The Southeast Asian country's election commission says a total of 222 parliament seats will be contested. Aluminum giant Alcoa is adding to the worries over the world economy. The company posted an adjusted loss of $60 million for what it called a challenging quarter, with significantly lower prices and higher costs for energy and raw materials. Aluminum has fallen by nearly half since reaching a record in March. And Hermes sales have surged as luxury shoppers in China return to stores after pandemic restrictions eased, snapping up those Birkin and Kelly handbags. Third quarter revenue rose 24%, excluding currency swings, topping analyst estimates. The results are more evidence that producers of luxury goods remain largely immune to the wider squeeze on spending. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
I think we're predicting, or at least the dot plot is predicting, that inflation will come down. It will be a disinflationary year in 2023. The median dots do call for further moves in 2023. So if you take that as the committee sentiment, there could be a decision to move that into 2022 at the December meetings.
I will not mince words. The doctorate from Indiana University has led an informative debate on a new Federal Reserve over his career at the St. Louis Fed. Bullard has talked about front-loading. He's talked about regime change and the rest. And you look where rates have gone, and Lisa, you've got to look back and say, what did Bullard get wrong? And the answer's not much.
Yeah, he has been on top of this, which is the reason why the front loading really is gaining some traction. I'm watching a clock right now. 18 days, 16 hours, 11 minutes, and 27 seconds. It's counting down. Election day in the U.S. And we haven't talked enough about this.
We have not.
But this is really,
we're doing the London idiocy.
Yeah, fewer than 3
correct.
weeks left at a time when the polls are moving so quickly against the Democrats in the face of some of the inflation. There was a quick pop, and then it seems to be evaporating. And Greg Valliere has been tracking all of this, Chief U.S. Policy Strategist at AGF Investments. He joins us now. Greg, thank you for making me take a look at this clock. 18 days, 16 hours, 10 minutes, and 56 seconds. How quickly are these polls moving against the Democrats?
It's really quite a story, Lisa. In the last couple of weeks, there's been a shift of Hispanic voters to Republicans. There's been a shift in the polls showing crime is a much bigger issue, and a surprising shift showing that abortion is in the middle of the pack. It's not a big issue. These are dramatic changes, and you have to conclude that a landslide is likely in the House.
Greg, I have been dying to talk to you. I am suggesting that the gentlelady from Hawaii, Gabbard, exiting the Democratic Party is a huge deal. Forget about the libertarian angle. Are moderate Democrats going to exit the progressive Democratic Party here post-election?
They have a huge identity crisis. You've got Bernie Sanders, who's 81, who's itching to run again. We'll see about Elizabeth Warren. She has to win her Senate seat in Massachusetts. But there's a place for moderates in the party, but there's going to be a brutal post-mortem. Why did we lose? What didn't we emphasize enough? And the biggest question of all, Tom, is what about Joe Biden? Does he announce?
Okay. But come on, Greg, give the Republicans some credit here. What did they get right in the last 4, 5, 6 weeks?
Well, inflation, I mean, I don't know if they got that right, but they certainly emphasized it. And in the final analysis, that will be the big issue. The fact that Joe Biden is perceived by the public as not doing much.
Greg, I'm gonna step on you here. I think this is really important. Tulsi Gabbard's comments were stunning. I mean, is woke dead for the Democrats?
It should be, and I'll tell you who else hinted at that, and that was Barack Obama a few days ago. He said we've gotten too infatuated with all of these, niceties and what we can say and what we can't say. So it's not just her. There are a lot of Democrats who feel the party has veered off a cliff.
Well, and this actually speaks to the shift that we've heard in tone in terms of exports to the European Union, in terms of support for Ukraine. There has been a subtle shift heading into the winter during a perilous time for the European Union, where the U.S. is saying we want to protect ourselves. How much is that going to really feature not only in the election, but in the political zeitgeist after?
This is a story to watch, especially for Western Europe. Could it be that the resolve in the U.S. could fade a bit? I don't see us being there yet, but many Trump Republicans running for the Senate are now openly saying, we don't want to give any more aid to Ukraine. It's not a majority, but if this starts to catch on, that could send a signal to Vladimir Putin that if he just waits long enough, he might get what he wants.
But it's not just the Republicans. I mean, even the Democrats. Yesterday, we heard from the White House that they may be considering restricting exports of diesel to Europe, or restricting exports of natural gas because of what the U.S. is facing itself, to lower prices for consumers. I mean, how much is becoming an increasing bipartisan pressure in the face of inflation?
Yeah, and you also see protests in Paris and elsewhere. So is the Western resolve starting to falter? I would quote Margaret Thatcher, her wonderful quote when she said, this is no time to go wobbly. The Ukrainian army is still advancing. But this issue is going to be a big one in Washington after the first of the year.
Greg, I think our global audience would ask, the tradition here of a beleaguered president is to turn to the vice president. I basically hear within your world radio silence on the vice president. Give us an update.
I have to say, in both parties, there's a consensus that Kamala Harris has been a disappointment. So if Joe Biden does announce he's not seeking another term, there's a vacuum. Who fills it? Gavin Newsom? He's got his problems in LA and San Francisco. There's going to be a real vacuum, I fear, for the Democrats.
Greg, save me some time. I'm watching too much baseball and not enough politics. Which Senate race is Greg Valier focused on?
Well, Ohio's fun to watch. Pennsylvania's fun to watch. But I'll give you a sleeper. That's Nevada, where a Democratic senator is in real trouble. And if she loses, that makes it really tough for the Democrats to have any chance of taking the Senate. They might lose the Senate by a seat.
Greg, don't move. Lisa, you still got the clock up here on the election. Give me the clock here on the election.
Hold on a second. It's 18 days.
18 days, whatever. We got to talk to Greg Valier 3 times within the countdown clock. We're going to have the Valier countdown clock as well.
It's amazing.
He's with AGF Investments Toronto and with a brilliant morning note. Get that through AGF Investments. I read it every morning. Greg Valier, thank you so much. Folks, we're looking here at the Bloomberg screen. We've got 3 or 4 major stories this morning to get you through the Bloomberg morning. And Lisa, I'm going to go to where I've always gone, which is to see the 10-year real yield, 1.70%.
Wow, really?
It was there for a cup of coffee. Valier was talking about Nevada. There it is. It's 1.70%.
Wow, look at that.
And the 10-year real yield, it's not up through new highs, but still, that dominates everything. And frankly, for Liz Truss as well.
Hold on a second. That is the highest, if it stays, since 2009. So we keep creeping to new post-2009 highs at a time when people just a couple months ago were saying 1.5% on the real yield was enough to torpedo stocks. We have seen a somewhat of a rally, although it's really kind of tepid. How much does that become a game changer over the long term? When do you start to reset? What do you call it? Zombie roll-ups?
Zombie roll-ups is my phrase for next year. If I was to write, I think you're going to see with a risk-free rate coming back, and that folds into the 10-year real yield. Bramo is correcting me on air. You're right. On a daily basis, a 1.7012 is a new high for that real yield. But with this new math, which is the old math of my ute, that's where the zombies disappear.
Well, and this is something that we have seen in certain pockets of the equity market. You haven't seen it in credit. You haven't seen it in the high yield space.
Tell me about high yield right now.
Right now, you are not seeing the same kind of spread widening that you're seeing in other places.
Credit deterioration.
Credit deterioration. There isn't the expectation for some sort of massive default cycle. Does that start to change? You're starting to see investment grade yields actually completely underperform because of the rate component. I don't know.
My number I'm looking at, it's an amateur take, folks, just an opinion, 2.05% on the 10-year real yield. We're not near it, but we're moving there quickly. Futures up 8. The VIX still above 30, 30.73. We are watching London with Guy Johnson and Lizzie Bird, and this is Bloomberg.
The U.S. economy still looks somewhat overheated.
For the moment, I haven't seen enough evidence that there's been any sort of break in the way things function.
I think there's going to be this big drag on the economy.
The consumer, as we all know, is the workhorse of the U.S. economy, and I think we've got to watch some deterioration there.
The U.S. will join this recessionary crowd in the early part of 2023. I think it's just a matter of time that we start to see consumer spending come down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
ジャルジャルゲリラバイト募集中。応募待ってるで。
The U.S. economy still looks somewhat overheated.
For the moment, I haven't seen enough evidence that there's been any sort of break in the way things function.
I think there's going to be this big drag on the economy.
The consumer, as we all know, is the workhorse of the U.S. economy, and I think we've got to watch some deterioration there.
The U.S. will join this recessionary crowd in the early part of 2023. I think it's just a matter of time that we start to see consumer spending come down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Welcome back. Watching rising global yields, watching earnings, watching ahead of lettuce in London. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. John is out on a well-deserved day off. He is not writing about playing footsie with the Dow. Tom, political turmoil in the face of market regime really is the mood of the morning.
Sterling 112.53 rebounds here off of what we've heard from Guy Johnson and Lizzie Burton. I think it's a distraction to the markets, but as Guy said, it is, again, within my exhaustion of watching the soap opera, new political theater for the United Kingdom.
It's new political theater on the heels of market regime change, and it comes with the yield story that we've been talking about for months that seems to only be accelerating with yields going up. CPI surprising to the upside in the U.S., in the UK, and Canada, and his response in markets.
And the other thing is to look forward. I believe you said 18 days to the election, and Greg Valliere saying we're going to see the same turmoil in America. He's seeing a massive shift towards the Democrats.
And you're hearing a shift toward the Republicans away from the Democrats, and also really concerned about inflation, talking about fiscal discipline, and we're hearing about that again and again. At what point do we see some sort of peak hawkishness, peak yields? We already have talked about that and then blown through it. 5% now, baked into market expectations for Fed funds rates in the first half of next year.
And the housing statistics, which we really haven't talked about much this morning, housing data here at the 10 o'clock hour, and with a mortgage rate 7-ish, let's call it, who's counting, it is a changed world. I'm going to go back to the boring data point, Lisa. The 10-year yield, 1.70%. The real yield, rather, is extraordinary.
1.7%, you highlighted this before, which is the highest level going back to 2009. And this is the reset. This is the great reset that people have been talking about. Dollar strength, although a little bit is moving away today, given some of the developments, the stabilizing developments in the UK, as well as what's going on in Europe, the Euro 98.14.
Dean Kernot publishing moments ago, yields are breaking out. He continues to see the same trend that Jim Bianco will tell us about here in moments.
Yeah, exactly, which is really the reason why people are completely resetting their expectations. I wonder how crude folds into this. We were talking a lot about oil yesterday.
Yes.
We did see a decline in gasoline prices. This pulled back some of the expectations for inflation, then a stabilization, then an increase, an attempt at an administration response, but crude right now higher, right? $87.33 WTI. You're not impressed. However, we're a far cry from the $67 to $71 or $72 where the trader that is the U.S. government's going to step in.
Well, or the Biden administration. I'm not going to pin that on the Department of Energy. I'm looking. This chart's too fancy for TV. Everybody will turn the channel, and the radio they'll drive off the road. I can't give you a technical path to 100 on Brent.
Yeah.
My problem is nobody's looking at that. They're all looking the other way.
But there is this great reset, and I'm really glad that we do have Jim Bianco on as we really not only look to earnings, but what this great reset in the yield space means for the broader economy. And Jim Bianco joins us now. He's president of Bianco Research. Jim, how much do you start to look at a 5% Fed funds rate next year and say, maybe that's not even enough?
Oh, I think that could very well be the case. First of all, as historical example is the 2-year yield always peaks above whatever the terminal rate is. So if the terminal rate's 5%, it should, before the cycle's over, go above that. And if the terminal yield keeps going higher, you keep resetting the 2-year yield higher. But it really comes down to inflation. Is it persistent? And let me be clear on persistent. Yes, there's signs it's peaked. And yes, there's signs that inflation is coming down. But if it stalls out around 3.5%, 4%, then these yields are appropriate. If it's on its way back to 2%, then these yields are too high. I do fall in the camp that we're probably going to see persistent inflation and that these yields are not all overdone, at least not yet.
Jim Bianco, all of us have lived the John Taylor Great Moderation. It's been decades. You and I remember 14% annuities, 10% double-digit yields, on and on and on. We don't have a collective experience of going the other way. What do corporate profits do if we move the other way to a higher yield regime?
Well, not only don't we have any experience going the other way, we have pretty much structured a lot of the financial market on the assumption that we were going to stay with low stable rates, a great moderation economy, and no inflation. Liability-driven investing in the UK being the headline child right now, and there's probably more to come. I think that as we move forward, we're going to find that this is going to be an even tougher environment than people think. And I've been advocating something I've been advocated for a long time. This might be the return, to use the Wall Street term, alpha. This might be the return of stock pickers and bond pickers, as opposed to just buy an index and wait for it to go up. You have to pick individual companies that can survive this environment, because not all energy companies will do well, others will. And no one's really ready for that kind of environment because it's been so long since we've had to do
and
it.
Jim, you were 15 years old when you were at First Boston. I mean, it was a few years ago, to say the least. But the bottom line here is the overlay on that is transactions and combinations. I would suggest merger 2023 may be the headline.
It could very well be, because with this new environment, there's going to be opportunities for companies to pick up other companies that are not positioned for it, and companies that will strengthen. You know, another Wall Street term is we're going to see the dispersion of returns be much wider than we've seen in the past. So it's not going to be enough to, just like I said, buy industrials. You got to figure out which industrials to buy. This is a big change from the last 20 years.
I understand that there is this sort of bond stock picker bias right now because of the new regime change in both yields as well as just a broader economic shift. However, I've been really struck by what's going on in the high yield bond space. It has been so resilient. People seem to be saying companies are just doing fine. They have a lot of cash. This credit cycle is going to be a lot different and a lot less dramatic than previous ones. Do you agree?
Well, I agree to some extent, because first of all, remember, the high yield space is largely a space of industrial companies, manufacturing companies, energy companies. Those are the companies that are doing well, where the stock market's more of a space of growth companies like technology companies. And when you get into the NASDAQ, unprofitable technology companies, those are the companies that are struggling. So that's definitely helping the high yield space. And the other thing is large nominal growth. When you have high inflation, these companies will see their bottom lines go up. Whether they can beat the inflation rates, another question, but at least their growth rates will continue higher.
Nice analysis, Jim, but what does that mean for bonds? If I'm a bond person clipping coupons, folks, for those of you younger, scissors, Bianco sitting there with, you know, the electric company of Chicago clipping a coupon, bond people don't have that advantage of the bright lights of nominal growth that corporations have.
Well, that's right. For a bond investor, it's all going to be about rates, and it's all going to be about moving yields higher. Or, you know, this is something new. We've got yields that we've not seen before, and I think we're going to continue to see it. And that should be the focus. And I think that's where the focus is on higher rates. Yes?
Well, no, but Jim, before we let you go, I'm curious about whether we see a lost decade in this kind of regime. I understand what you're talking about with respect to specific bonds or stocks doing well, but on an index level, are we going to see meandering returns for equities because of this fiscal discipline and higher rates that completely change the value proposition?
Yes, that's my fear, is that it's a post-pandemic economy that needs to change for the new world. You know, it's a work from home world. The supply chain still needs to have some work. We still need to figure out what we're going to do with China. And for the next several years, it's going to be a complete restructuring of what we've seen. That means indexes sideways. That means yields higher. That means great opportunity within stocks and within bonds. That, like I'm going to emphasize, that's not what it was in 2010 to 2019. So yes, index is sideways, but there will be opportunities within it.
Jim Bianco of Bianco Research, thank you so much. And I kind of want you to stay here for what's coming, because I can just feel Tom Keen's energy and the vortex of my gloom is getting him to throw his tang at me. I mean, honestly.
You got to be kidding me, Lisa.
What?
This is the greatest, you know, to the bulls out there, when they hear people talk about the coming lost decade, that's the precursor to the reformation of a new bull market. I mean, the toxic brew of a lost decade. I mean, you got to be kidding me.
Okay, look, you can say that this is just gloomy, but you could also say that when you take a look at tech valuations and where they reset to based on where the nominal and the real yield are currently, if we're in an inflationary regime, it's hard to see the index level case in the same kind of way as specific names, which is the whole point.
I'm going to go to what the major insight there from Jim Bianco, folks, which is you go back to stock picking where alpha matters. And you and I see that in the earnings where, you know, I get it, it's volatile, but United Airlines launching on all cylinders, and Alcoa's out there going, maybe not.
Right, and this is the reason why people are saying stock or bond picking. Getting it right, though, has always been challenging, and people have been saying this for the past 10 years, and every time the index seems to outperform if you strip out fees on an average level. Is this really going to be different? And if it is, what happens to ETFs? Right. What happens to passive investing? What happens to the entire thesis that's transformed the investment management model?
Into claims in 19 minutes. We're going to come back and look at the toxic brew of a lost decade.
Okay, you know, am I going to be dealing with this all morning?
Toxic brew of claims.
I'm watching lettuce.
Claims, I don't know which way they go. They may show you tilting towards a toxic brew of a lost
If you keep this up, then I'm going to start talking about bad
news
being good news. I'm going to give my paper, dissertation.
I'm going to be here doing a monologue. People will drive off the road on Bloomberg Radio.
Dissertation on toxic
Futures up
brew.
6, Dow futures up 114. The VIX a rock solid above 30. Stay with us from New York. And Lizzie Burden in London, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Liz Truss invited key Conservative Party lawmaker Graham Brady for talks at 10 Downing Street, fueling the sense that her premiership is near collapse. Deputy Prime Minister Theresa Coffey and Party Chairman Jake Berry were also at the residence. Yesterday, Truss fired one minister over a security breach, and 2 others were heard resigning amid a fallout from a Commons vote before agreeing to stay on. Chinese chip makers extended gains today after Bloomberg reported the country's top technology overseer convened a series of emergency meetings this past week with leading semiconductor companies. The talks were said to be for assessing the damage from the Biden administration's sweeping chip restrictions. French President Emmanuel Macron has used a fast-track decree to push through his budget. The action came after the bill was debated in France's National Assembly for several days, during which it became clear it wouldn't secure enough votes to pass. Macron's centrist grouping is nearly 40 seats short after losing its majority earlier this year. And your morning caffeine kick may soon cost less. Vietnam, the world's biggest grower of the Robusta variety of coffee used in instant coffee and espresso, reports there will be a larger crop this season, adding to the global supply. Generally favorable weather and the replanting of old trees have boosted those yields. And Netflix top executives continue to battle it out over releasing more of its original movies in theaters. The Wall Street Journal reports some argue Netflix is leaving hundreds of millions in box office receipts on the table by showing select movies in a few theaters for a few weeks, while others feel theater showings create buzz for the streaming service. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
Wages are going up, and that's not a bad thing. But if it gets caught up in cost price spiral, that would be bad. And so making sure that we've got monetary policy at a sufficiently restrictive stance so that we're not inducing inflation, we're trying to get it down.
Charlie Evans there, Chicago Fed president, speaking among the role of Fed speak that we've been hearing. I do want to bring this to you. Sky reporting that there will be some sort of statement from Downing Street at 1:30 p.m. London time. That would be in about 10 minutes plus or minus over here in New York. And how much is this going to be what Jim Bianco said, where he's long lettuce, not Truss?
Well, I look at this and I go back with my faulty memory. It's unfortunate John's not here, but to Mr. Cameron coming out on short notice. And my basic take, Lisa, is the British are way more abrupt about this than the Americans. Things happen faster over there than they do in a media-managed Washington.
UK, US, faster. Either way, this has been warp speed, even at a faster pace. Yeah. I mean, this has been absolutely revolutionary in terms of its speed, as well as the fact that it's really come on the heels of market movements. I mean, that to me also, the market has just disciplined the political regime in a way that we've not seen.
On television, give me an intraday on sterling as you can as well. And what you see is sterling is not launched. That's not the right idea, but we've moved from sterling weakness up to some real sterling strength, getting out well above recent resistance. 112.70, a 113 print there would be something about this announcement. At 18:19 Wall Street time, good morning on Bloomberg Radio and Bloomberg Television. We're going to double barrel this as we look to the United Kingdom. Lizzie Burton is at 10 Downing Street, but also in 10 minutes, we have claims in America. Kathleen Bostjancic is going to join us now, Chief U.S. Financial Economist at Oxford Economics. And what we're going to do is keep Kathy here on claims, go through claims. McKee's down in Houston watching a baseball game. Hope that works out for him as well. Guy's in place as well. Guy Johnson in London. Kathy Bostjancic, I need a clinic on claims. What is your statistic to say claims have shifted? Is it 230? Is it 220? Dare I say 250? A higher number is a grimmer number. What number matters to you?
Good morning, Tom. Happy to be with you and Lisa. It's not so much the level, but the change in claims that we'll be looking at. Certainly if we get a large increase this morning, that somewhat could be reflected of the hurricane in Florida, so we'll have to dig through and look at the state data, although there's some delay in that reporting. But as we go forward, we would anticipate that claims are actually going to just gradually increase, even if we do head into recession, which is what we expect, just because employers have had such a hard time finding skilled and appropriate workers. They're not going to immediately start to let them go. What they'll probably do is just pull back on new hires, and that alone will start to make net payroll gains slow.
Does this mean that the initial jobless claims no longer matter, Kathy?
They certainly do matter. It's just our expectation is that we're not going to see a large run-up as maybe you would see in previous recessions. In other words, maybe this claims, which is typically a leading indicator, maybe it becomes more coincident and lagging. Now, we'll have to see how that plays out, but that is sort of, I think, the thinking right now.
Right now, we want to show you some film here. We've got 10 Downing Street. They're putting the podium out. The two guys just brought it out. They bring it out on a board and rollers, and there it is, and it is always a sign of change within the United Kingdom government. We'll have more on that with Guy Johnson here in a bit. Back to Kathleen Bostjancic on the change in the American labor economy. Kathy, how does this dovetail into that jobs report early November?
Yeah, I think we're going to see net job creation continue to slow. I think there's enough uncertainty with corporate America of what's coming that they're going to hesitate and be more cautious. And I also, let's be realistic, the pace of job gains that we saw right after kind of the end of the COVID recession weren't sustainable, right? That was catching up and filling in the gap, the large gap that we saw during the COVID downturn. But going forward, I think it's this uncertainty that weighs on corporate leaders is going to get them to pause a little bit. And we'll also see those job opening numbers start to recede as well.
Given the pace of how quickly the market narrative is moving, is there anything in the underlying economy that gives you a feeling that we could be in recession now or headed to a rather deep one based on some of the pricing of certain stocks and some of the guidance that you're hearing out of Wall Street analysts?
Well, certainly the equity market is also a leading indicator, and we do need to respect that along with the yield curve. With that inverting, traditionally that has been a sign of recession. It doesn't tell you much about the depth, though. So that's even if the yield curve inverts further, it doesn't tell you that we're going to maybe contract 2% instead of 1%. Our own view is that we have somewhat of a mild, moderate downturn, peak to trough about 1%. If you exclude the great financial crisis and the COVID downturn, the average post-World War II downturn was 2%. Right. So it's about half of that.
Kathy Bostjancic of Oxford Economics, you're going to be sticking with us through the jobs claims. We do want to get a sense of what's going on over at London right now, where they are setting up the stand and the microphones, the podium, as you pointed out, preparing for that statement.
Yeah, they are. They're setting it up with the usual thing. This is not Liz Truss, if we can go to that right now, but we make jokes about it, but this is really serious for this nation, and of course we have seen this. I'm going to go back past Theresa May to David Cameron. I'm sure John Farrow could go back much longer, but I'm exhausted by this. Can you imagine the cross-section of people of the United Kingdom just
I mean,
it's like Nixon for 4 years is sort of,
been consolidated into 3 days.
Yeah.
I mean, this whole idea of how quickly she proposed a plan, she got a slap down by the markets, she got a slap down by her fellow Tory members, and now a lot of people are expecting her to resign. What comes next? This isn't the end of the turmoil. What comes next, and what kind of fiscal leeway do they have, given where we are with respect to borrowing costs and where we are with respect to inflation?
Guy Johnson has given us a sense of that, and his theme is that we have separated much of the economic battle from the political battle, and I see it with Sterling 112.79. We're not going to give you, we're going to move the podium here. Speech over. I'm kidding, folks. On radio, they're now out tweaking the podium
Melissa McCarthy's
to line
turning.
it up to a 16th. Yeah, it's a Melissa McCarthy act. They're going to line up the podium to a 16th of an act. We're going to have this in serious conversation with Guy Johnson about a moment in the history of Britain. On Sterling 112.80, Lisa, 112.80 is not where we were earlier this morning.
There was talk of parity, and now we're further away from that at a time of a little bit of stability. 10-year yields, 4.1%. This is Bloomberg. This is Bloomberg Surveillance. We are awaiting U.S. data, but we are more awaiting what is happening in 10 Downing Street, where we are awaiting for some sort of statement. Potentially Liz Truss stepping down. We, Tom, are getting all sorts of messages about perhaps the lettuce one.
Well, there's a zeitgeist that's on there. Guy Johnson standing by as well as we wait for this moment in British history, but with claims out with an extremely good number, 214,000. That's a constructive number from 228. I don't have the revision yet.
Yeah.
Down to 214 is a number that I'm going to call that not Jerome Powell friendly. We're going to stay away from that right now. Equity futures lift on that. In yields here, I'm going to call it churny. Maybe yields pull back a little bit, 4.56 in the 2-year and the 10-year, 4.11%. I'm trying to squeeze this in before we go to the moment in history. Lisa, let us regroup here, and I will go to the day. John Farrow did 9 hours on TV on Brexit, and as somebody emailed into me, how much of this moment and the moment of Theresa May redounds back to this arch debate of England, the United Kingdom, extracting themselves from Europe. How much is that really what we're talking about today?
The post-Brexit turmoil, I'm sure, will be a discussion for the history books. Also, the post-pandemic playbook at a time when inflation is one of the most important problems pressing a nation. Really, her agenda was to cut costs and to cut taxes, or not cut costs, increase costs and cut taxes. It failed, at least with the market size.
On radio, on television, we show that Beth Rigby, always informed, says the Prime Minister, quote, is about to resign. That according to Sky Television. Guy Johnson is in London. Guy, we're going to stay on 10 Downing Street on TV with a podium set up a good 25 feet from that acclaimed black door. Guy Johnson, if the Prime Minister resigns, what happens next?
That we don't know, Tom. How is this process going to unfold? I think it's probably just been decided inside Downing Street. We've had this meeting taking place. You've had the chair of the Conservative Party in there. You've had the Deputy Prime Minister, Kofi, in there. You've had the chair of the 1922 committee, Mr. Brady, in there, Sir Graham Brady, in there. And I suspect they've been working out how this process is going to unfold. It's not just the 22 rules that need to be changed, the 1922 committee rules to be changed. Other rules need to be potentially altered here as well. I don't know what the process is going to look like, Tom, but what is clear, judging by the shot we have up on the screen in front of us, is that something is about to change.
We welcome all of you on Bloomberg Radio and Bloomberg Television to this historic moment for the United Kingdom. Guy Johnson in London with our government team as they report this story. Lisa Bramwitz and Tom Keene. Tragically, I'm not kidding here, folks. We make a lot of jokes. We have a lot of fun, but just too bad. John Farrow is off today. We look forward to his perspective in the coming days. Lisa, I look off claims at a higher real yield out to 1.71%. But separate from that is the economics here of stronger sterling and more stability for the next United Kingdom government?
Well, more stability for now, which goes to the question which you rightly asked, Guy, what comes next? For all intents and purposes, over the next 2 weeks, 3 weeks, 4 weeks, is the United Kingdom going to be run by a technician, by Jeremy Hunt, who has taken over as the Chancellor?
Now we're going to have to see here. And here we go. And now the door opening at 10 Downing Street, and the Prime Minister walks to the podium in silence. Let us listen.
I came into office at a time of great economic and international instability. Families and businesses were worried about how to pay their bills. Putin's illegal war in Ukraine threatens the security of our whole continent. And our country has been held back for too long by low economic growth. I was elected by the Conservative Party with a mandate to change this. We delivered on energy bills and on cutting national insurance. And we set out a vision for a low-tax, high-growth economy that would take advantage of the freedoms of Brexit. I recognise, though, given the situation, I cannot deliver the mandate on which I was elected by the Conservative Party. I have therefore spoken to His Majesty the King to notify him that I am resigning as leader of the Conservative Party. This morning I met the chairman of the 1922 committee, Sir Graham Brady. We've agreed that there will be a leadership election to be completed within the next week. This will ensure that we remain on a path to deliver our fiscal plans and maintain our country's economic stability and national security. I will remain as Prime Minister until a successor has been chosen. Thank you.
Liz Truss turning to 10 Downing Street in the door and returning in to piece together a fractured government. Our Guy Johnson in London. We're waiting for John Micklethwaite to join us as well, our editor-in-chief, with all of his experience of the politics of London. Lisa, your thoughts of this moment?
Well, Liz Truss is about to become the shortest ever serving prime minister. She is stepping down. We were talking about this earlier at a time of incredible turmoil. She accepted the prime ministership from the Queen and handed in her resignation to the King.
To make a real impact, we need to go from 25% renewables to 70 to 85%. Digitization and decarbonization go hand in hand. 5G will really pioneer a much more sustainable future.
We welcome all of you worldwide. An extended edition of Bloomberg Surveillance. We're going to move through the morning here with the tumult of the British government. And of course, on the Bloomberg, what we do is look at sterling 112.72 after the announcement, I believe with a move up to 113. Guy Johnson is here, and Guy, for Americans, it is so much formed by the movies and not The Crown and the rest of it. But I'm going to go back to every movie Judi Dench has ever been in, which goes back to Disraeli and Gladstone. And we really, Guy, almost have to go back to the 1820s and 1830s for a moment. Is that the historical perspective Britain has? Or are Tories and Labour saying, enough, let's move on now in the present?
Well, I think the Tory party would desperately like to move on. I think that is certainly true. I think Theresa May has just set a record that was set by Prime Minister Canning previously. So there's some historical perspective here, Tom, as you take us back that far. I don't know what the rules are going to be governing this process. It's not just the 22 committee rules that need to be changed here. There's a bunch of other rules that need to be changed here as well. What process is going to unfold here, I think, is critical. Is this going to be decided within the parliamentary party of the Conservative Party?
Right.
Will they select their new leader, or will this ultimately have to go back to the grassroots? If that is the case, that could be an elongated period in which that process unfolds. And in theory, during that process, Liz Truss will remain Prime Minister. We don't know yet. I suspect that policy is being made on the hoof, rules potentially being changed on the hoof as well, Tom.
How much, to Tom's question earlier, Guy, how much is this really being driven by the tumult of a post-Brexit United Kingdom?
I think it's being driven by that. Ultimately, Brexit was meant to resolve a number of issues within the Conservative Party. I think we can clearly now make the decision that that has not been the case. The pandemic obviously has had a huge impact as well, not just in the UK. It has taken the UK to a fiscal position that was very different to the one we enjoyed in 2018 and 2019. So a number of things have changed here, and I think what is clear as a result of the pandemic is, and the inflation that has subsequently been generated post that pandemic, is that the market tolerance for a big shift in policy is relatively limited.
Guy, I want to go back to what Prime Minister Truss talked about, which is this distinction of members of Parliament of her party and the people of the Conservative Party. How far apart are they? In America, we have liberals and conservatives far apart from their elected officials. But how big is that canyon between the MPs and the people?
Right now, I don't know, but let's put it this way. The parliamentary party, the MPs, did not vote for Liz Truss. The Conservative Party, the grassroots, voted for Liz Truss. So it's my understanding is that the parliamentary party would like to keep this within the parliamentary party in terms of making the decision, and there's some reasons for that. You could certainly get a more expedited decision on who will ultimately be the next prime minister as a result of that.
So we are just getting a headline from the Telegraph's hope that 1922 officers are meeting at 3 p.m. in Parliament, their time, so 10 a.m. Eastern. How much is this setting up for a general election? And can you give us historical perspective on the last time that there was this kind of electorate outcome?
The Conservative Party, the parliamentary party, will not want a general election. They have 2.5 years. The polling is abysmal right now. You would see a wipeout, almost a complete wipeout of the Conservative Party in Parliament were you to see that happen, judging by the current polling. So they are going to be playing for time here. They are not going to want to have that happen. They are going to want to put in, technocratic may be the wrong word, but that kind of government here. They are looking for stability. They are looking for a period of time in which the pantomime of what we've seen over the last few days can be forgotten.
Guy, what is the percentage of people, either MPs or the party, saying Boris to the rescue? I mean, it just seems so painfully, I don't mean painfully because I'm editorializing, but it just seems so apparent that's one solution.
Well, within the parliamentary party, I would have thought that number is relatively small. I've seen a tweet from Nadine Dorries this morning suggesting that. I haven't seen many others. Within the Conservative Party grassroots, I would have thought that arithmetic is slightly different, though, Tom. But within the Conservative Party that is represented in Parliament, I don't think that number is high. I come back to the point, they are looking for stability. I'm not sure the Boris Johnson administration really was emblematic of stability.
Guy Johnson with us. If you're just joining us on Bloomberg Radio and Bloomberg Television, a special edition of Bloomberg Surveillance. Lisa Abramowitz and Tom Keene in New York. John Farrow, regrettably off today here. His history is made in the United Kingdom. Joining us now, John Micklethwaite. He's editor-in-chief of Bloomberg News and, of course, a student of this with his many years at The Economist. And, John, I'm going to go to a single sentence from your colleague in crime, Adrian Wooldridge. You've written so many books with Adrian, steeped in history. Wooldridge, there are no parallels in British history. What is the Micklethwaite parallel this morning?
Well, unusual for me to agree with Adrian, but yes, I think he's completely right. There are no parallels, and indeed you begin to have to look to places like Italy and the fast turnover of prime ministers there. And it's one of those moments where basically it's possible to feel quite sorry for Liz Truss, but slightly, as Guy pointed out, that everyone else has probably lost even more. The Conservative Party had lost a great deal. British people have lost a great deal in terms of much higher mortgage rates. You could even argue that the Labour Party, their inheritance, if they are eventually going to take over, has got immensely more difficult because there is just less room for things. Britain is now, we went over the edge. And when you go over the edge with the markets, it takes a long, long time for the markets to forgive you. And you can already see the Tories have rowed back on quite a lot of the more extravagant promises they made. But the markets still don't trust them that much, as we can see in the yields. So I think in general, yes, it is. Technically, I think she's the shortest since Canning. But by any measure, you're not really looking at modern British political history. You're looking at places which, rightly or wrongly, have sometimes been perceived with more rapid turnover
John,
of leaders.
You're saying the UK has gone over the edge with markets, which is a pretty dire tone, and understandably so because of what we're seeing in markets. Is a general election enough to begin to restore some of the credibility, some of the stability? Is Jeremy Hunt, a technocrat, the person to do it, or is this something that cannot be righted for months and potentially years to come?
Several things in that. Number one, Guy Johnson's completely correct. Nobody in the Conservative Party wants an election because it's like a football match that you're losing 5-0 at half-time. You're generally going to want to play the second half, if only to see if you can recover a bit. At the moment, they would get trounced, and so it would be like turkeys voting for Christmas. So that's really being parked in one area. I think that so unless the Conservative Party pulls itself apart so much that some rebels begin to say, look, we'd be better having an election, I don't think that's going to happen. I think in terms of what the markets are going to do and what the way in which Britain is perceived in the world, I think you did see, notwithstanding my earlier comments, you did see a fairly robust reaction to Jeremy Hunt coming in and taking a more grown-up approach to what things do, what things could do. But as you pointed out, and as I was saying earlier, it's very difficult once you've lost that basic sort of trust to get it back. If you look what Jeremy Hunt did, he actually renounced not just the stuff that the markets really hated, the kind of top-rate tax cuts and other things like that took it into much heavier territory. He also renounced a degree of the energy price cap, which the markets had sort of forgiven Britain for earlier. But once you lose that trust, you lose that ability. So the Tories are almost back in an earlier position. So I think it will take a degree of time. And one very interesting thing is it's very hard for any government now to do much outside of fairly wide parameters. If you look at what Labour wants to do, look what the Tories probably will do over the next couple of years, it's probably quite similar.
Right now, we have a headline. I feel like this is something out of a Hilary Mantel novel. The leadership of France saying, quote, Mr. Macron hopes the United Kingdom can regain stability as soon as possible. Our executive editor in terms of Brexit non-stability is David Merritt. He joins us today from Washington here in our special coverage of the resignation of the Prime Minister. David, thrilled to have you with us as you are steeped in our coverage of Brexit. How much is this resignation of the Prime Minister linked to that day when Brexit occurred?
Thanks, Tom. Yes, well, a lot of commentators are looking back in history to that moment in 2016 when the chaos really started to set in, and we've seen since that vote, David Cameron of course resigned the morning after that vote in 2016, and we've had now 3 other prime ministers forced out of office, and it's great to hear that bit of sledging there from the French president talking about the need for stability. But it's been a sort of accelerating process, and Brexit. We all lived and breathed, didn't we, Tom? The turmoil, the twists and turns. Boris Johnson claimed that he got Brexit done, but obviously the after effects are still being felt. Many commentators talked about the extremities of the moves in UK markets of recent weeks being also linked to the fact that Britain was untethered, as it were, from the European Union, made it more exposed to some of these effects around inflation and the like that are going around the world. That is one lens on it, of course. The Remainer voters still have a large voice in Britain. It will be fascinating to see, though, now who emerges from this leadership contest. Are we going to see somebody who wants to start to reforge some connections back with the European Union, if they can actually try to kind of end the infighting in the Conservative Party? Brexit has not gone away. Boris Johnson did not get it done. It remains an open argument in Britain, and you're seeing the effects of that still.
David, to that exact point, you're asking about who the leadership will be. Well, one just removed his name from the running. UK Chancellor Jeremy Hunt will not stand for Tory leader. That, according to the spokesman from his office. How much are we looking at something that is a UK story, David, and how much is this, as we were just hearing from John Micklethwaite, does this represent a sea change where governments cannot get away with certain policies that they could in the past because of the interest rate regime, because of the bond vigilantes coming back?
Absolutely. You know, the theory in the Truss camp of the campaign was always that Britain has such a large and stable economy that the bond market will readily absorb all this extra debt to pay for, you know, they got away with it with the furlough scheme in COVID. They probably would have got away with it with this massive amount of spending to supplement energy bills, but they tipped it over the edge to borrow extra money just to cut taxes. And that argument seems to have now been settled, I think, probably for many decades to come. If anyone thinks in any G7 country, perhaps excluding the United States, that they can borrow to that level and the market will take it, I think Britain is now going to be the example why they can't.
On radio and television, our extended coverage of the resignation of the Prime Minister, Liz Truss. We welcome all of you worldwide. We'll continue to give you market data with sterling now 112.63. I'm going to call that a volatility and a little bit weaker here in the last number of minutes. Guy Johnson is with us. David Merritt is well with their wonderful experience on the British system. And, of course, John Micklethwaite with us, our editor-in-chief today. John, I want to speak to the middle ground. This ugly American says that means the Liberal Democrats. Is there a middle ground in British politics?
I think the middle ground is currently occupied by a mixture out of Jeremy Hunt and Keir Starmer. And what's quite very interesting is the idea that Hunt, who in many ways seemed to be the most likely compromise candidate. I went down to the House of Parliament last night. You talked to people. He seemed to be the person who, rather weirdly, the right of the Tory party had forgiven for opposing Boris Johnson in his leadership election, but he hadn't been obviously disloyal, and they seem more angry with Rishi Sunak. And the trick really over the next few days is going to be to get somebody who most of the parliamentary party can unite behind. But I think at the moment, the middle of the British politics is sort of occupied by Jeremy Hunt on the left of the Tories, and Keir Starmer, he has not done as much to detoxify the Labour brand as people like me thought he needed to do. I mean, he renounced anti-Semitism, he's got rid of those sort of things, but he has not really moved the party substantially to the middle, although he has talked about accepting some of the Tories' tax cuts. But at the moment, I don't see that the Liberals don't seem to be part of the picture at the moment.
John, what is so important here within, the way I report this from New York is Mr. Sunak is a financial guy. Does the United Kingdom want a Draghi-esque financial guy to run the show to help get us out of the chaos?
They want somebody who's competent. And at the moment, the sort of list of competent people seems to involve Jeremy Hunt, Sunak, who I think more than any other person in recent British political history can justifiably say, I told you so, because what he said would happen during the leadership election to those aforementioned Tory members who Guy was describing. He did actually tell them that if they elected Liz Truss, this is what would happen, and it has happened. But often in politics, the rewards don't go to the person who says, I told you so, even if he tries very hard not to say that. So there's I think him, I think Jeremy Hunt, I think there are some other people who they can bring forward. Grant Shapps, who they brought back in, is one such person. But there's not a lot of people who people would immediately turn to. I went to the Tory party conference 2 weeks ago, and it did feel a bit like the end of the second term of a two-term American president visiting the White House then. The Tories have been in government for a long time. A lot of the people who got them into government in the first place, people like George Osborne and things like that, who most people would say was very talented, they have all left. And that there is not as much talent now. It is very like the end of a second term White House.
John Micklethwaite joining us, David Merritt as well, of the executive leadership of Bloomberg, about what just happened. Liz Truss saying, I cannot deliver on the mandate on which I was elected by the Conservative Party, resigning. Guy Johnson in London parsing through all of the reaction, all of the headlines, who's in, who's out. Jeremy Hunt not in the running. Guy, what's the latest?
You do wonder whether Hunt could be persuaded. He has ruled himself out, but you do wonder whether, were the situation to develop, he may still be persuaded to occupy that role. I think that would be an interesting development here. I couldn't possibly stand. I'm not going to stand. Well, we'll see ultimately what happens here. As John says, the bench is not particularly deep at this point. They don't have in the Conservative Party the talent that some would argue they once enjoyed. But whoever it is, Lisa, they enjoy, I think, very limited room for manoeuvre. As John said, you are now, from an economic point of view, tinkering. You can't make big, bold moves. you can't make the kinds of changes that Liz Truss tried to do because you have been clearly warned off such moves by the markets. So whoever comes in, be it the next incarnation from the Tory party or the Labour Party, their room for manoeuvre is incredibly limited unless they start thinking about pulling bigger levers. Immigration, how would that change the UK economy? Rejoining the single market, how would that change the UK economy? Those are the only levers that are left, right. But recent history would dictate that those are very difficult and dangerous levers to pull.
David Merritt, a guy, he was mayor for 8 years, and then he was Secretary of State for Foreign and Commonwealth Affairs, leader of the Conservative Party, and then Prime Minister with, I believe, a ginormous electoral victory. I am thunderstruck we haven't heard from Boris Johnson, even if it's a fatherly word in time of crisis. Where is he, and can you get him on the phone, David Merritt?
That is a very good question, Tom. And rest assured, our reporters are definitely trying to track him down. There was some word that he might be in the Caribbean, I think, actually. Probably.
I'll get on that right away, David. Don't tell Mick.
A pina colada in hand, watching all this unfold. But look, he's made no secret, or his associates have made no secret of the fact he'd love to make a comeback, right? And the implosion of the Truss project so soon, we've had some of his former ministers coming out and saying, look, there's only one person in the Tory party who has a mandate from the British public, and that person is Boris Johnson. He won that stonking majority just in 2019. He should be brought back to steady the ship. Stranger things have
hold on a
happened,
second.
so we'll have to see what he says.
David, is there really that much support for that? I mean, he says he'd be happy to step in and come back. I mean, are people really doing this at a time when people are seeking stability? I did point out the poetry of Liz Truss accepting the prime ministership from the Queen and then putting her resignation in to the King just days later. How much are people seeking stability, even if it comes in the form of Boris Johnson?
I mean, I think definitely people are seeking stability, no doubt about it. You know, the death of the Queen was a huge watershed moment for Britain as well. So, yes, some people are clinging to this idea that maybe Boris Johnson could provide that. Remember, he was the person who persuaded people across Britain to vote Conservative for the very first time. And yes, you know, through to a series of missteps, he was forced out of office. But he still does command huge loyalty from a big faction of the party. That's one of the reasons why Rishi Sunak is struggling so much. Now, I don't think it's yet broad enough, probably, to bring him back. But, you know, people are grasping around here at the moment for an answer to this problem of how do you govern an ungovernable Conservative Party at the moment.
John Micklethwaite, let's look at the wake-up call here for the Conservative Party, playing off your wonderful, highly readable monograph of a number of months ago. You know, I look, John, at the wake-up call that is ensuing right now. Lessons learned from Cameron, lessons learned from Theresa May, maybe from Prime Minister Johnson, certainly lessons learned from Truss. Is this the wake-up call for the Conservative Party?
There is. It really goes back to what David Merritt was saying. What you said is completely correct. You know, Johnson is a big beast in this. The one thing nobody has ever associated Johnson with his entire life, in this case I'm talking about Boris Johnson, not Guy Johnson, is stability. It's not what he does. But he did do one thing uniquely well, is he managed to knit together both a kind of working class, somewhat socially conservative vote, you might describe it, pro-Brexit, with the more traditional kind of free market southern votes of the Tory vote. So he did have that ability to do it. But the fact is those two are largely in conflict quite a lot of the time. And so the Conservative Party, you're right, I think they are reaching a period where they need to refresh. There is a reason why the Conservative Party is, I think, still the most electorally successful party in the Western world, depending on how you measure the Japanese achievement. They are very, very good at rebranding themselves. They were the kind of party of rather posh conservatism under Harold Macmillan. Under Margaret Thatcher, they became radical free marketeers. Then Cameron was a turn back to managerial conservatism, and he did pretty well until he didn't do well on Brexit. And then since then, they've been trying to mend these breaches. There has been this war within them over Brexit, and that could come out again in this. And I agree very much with Guy Johnson, is that actually if Jeremy Hunt does want to be leader, the solution of coming out saying he doesn't want to be it could be the cleverest thing that he's done so far.
As we try to understand where the trust lies or how to regain the trust, there's the divergence between what's happening on 10 Downing Street and how to regain trust in the city. David, I'd love your thoughts on how what the tumult is like among the financial players, among such concern about the pound, among such concern about borrowing costs, and whether there is a feeling that there can be a retention of some of these financial firms that were threatening to leave post-Brexit.
Absolutely, and I think the turmoil that I think the city has looked on in horror at the last couple of weeks. There was a feeling in the leadership campaign that maybe Truss was pro-business, was going to listen to the City of London and their concerns. They had this big plan they were calling Big Bang 2.0 to kind of turbocharge the City of London post-Brexit. All of that is now in tatters. We've got a premium on UK government debt. Yes, it's come down a little bit, but it's still there. And the reputation for Britain as a financial destination, a stable destination for investors, has been shredded. And I think it's going to take a very long time for that to come back. And conversations we've been having and our reports have been having with banks and investors in London, in the city, they are white with rage about the chaos that has ensued from this government. And investors around the world, we've spoken to people who've called the UK uninvestable, and this is a direct fallout of a Conservative government. It's going to take a very long time, I think, for that reputation to be healed.
We welcome all of you worldwide on Bloomberg Radio and Bloomberg Television. I would direct your attention to Bloomberg.com UK with wonderful coverage. Joe Mays and the team there really on top of this story, the resignation of the Prime Minister of the United Kingdom. It seems we've said that too often here in the recent years. It is truly, and I don't editorialize here, chaos in Britain. Guy Johnson joins us this morning from Queen Victoria Street with our editor-in-chief, John Micklethwaite, and also David Merritt joins from Washington with his extensive leadership of our Brexit coverage. We do this with equities vacillating in the United States. Yields move higher. I've been watching the real yield now, a stunning 1.72%, but everything today talking towards yen at 150, and of course sterling we're watching was a little bit of weakness here, 112.56. John Farrell off today, but Lisa Abramowitz is here, and we bring back the gentleman from the Dartmouth bubble.
Yeah, how much are we looking at a reset driven by market action, which Danny Blanchflower has been talking about and watching? We pledged that we would get him back if anything developed. Something developed, but Danny Blanchflower, Dartmouth professor, joining us now. He is also a former member of the Bank of England Monetary Policy Committee. The key question, what does the United Kingdom need to do, both from a fiscal and a monetary standpoint, to regain market trust?
Well, obviously, I think a period of calm is completely important. I mean, you used the word chaos. I mean, we spoke 3 hours ago about what potentially was coming. I think there's another party and group here we haven't really talked about, which is the general public, who are going to be hurting. And if we look back in the poll tax, it was actually dissent from the public. They refused to pay the bills of the poll tax. There were demonstrations. So I think everyone's correct about financial markets being important, but in a way, when a government is so far behind in the polls, there's been no mandate from the people. Their credibility, both in financial terms, but actually political and real living day terms, if you like. The woman on the Mile End Road omnibus is going to say, what's in this for me? So I think any government is going to have to calm that, and it's pretty hard to see without a general election how that would happen. So I think calmness is important, but it's hard to see how that's going to come. I mean, we're going to have a week when we don't know whether there's a leader there. How long is that leader going to be there? What support will there be within the Tory party? But in the end, it's going to come down to what support is there from the people. And I suspect when this government is 35 points behind in the polls, if you had an election today, they'd go from something like 350 seats to 4. So this baby isn't over. Even when you bring in a new prime minister, you bring in a new chancellor, you try and calm the City of London, and in the end, the people will speak.
David, what I'm going to do is watch Kate Blanchett tonight and Elizabeth so I can get up to speed on this as well. What we need to do is revisit the comments of Prime Minister Truss. Here is the Prime Minister before her resignation.
We set out a vision for a low-tax, high-growth economy that would take advantage of the freedoms of Brexit. I recognise, though, Given the situation, I cannot deliver the mandate on which I was elected by the Conservative Party. I have therefore spoken to His Majesty the King to notify him that I am resigning as leader of the Conservative Party.
Liz Truss at the podium outside of 10 Downing Street this morning. John Micklethwaite, Professor Blanche Flower alluded to this, and we speak from the distance of the colonies, but there seems to be a system, a process of parliamentary process, I guess is what I would call it, in the United Kingdom. Do you see any groundswell by the people that David Blanche Flower speaks of for constitutional or process reform in a fractured British system?
I don't think I see much sign yet of demands for constitutional reform. I think a lot of people are very fed up and annoyed with the Conservatives. You can go to dinners in London and people will say, how on earth did this group of people get to elect this person who the MPs didn't want in the first place? And the answer is that it's slightly the same. It's not a popular comment to make in America, but it's not dissimilar to the way that Americans choose your leader. Party members vote in primaries. Well, that's what we had, a primary, and we ended up with Liz Truss. And I think what's happened is the people in our equivalent of Congress are now trying to re-elect somebody. It is a parliamentary system, and you get elected for a term, and so the Conservatives will try and stick it out. And sometimes you stick it out and you lose at the end. That's what happened to John Major. But at the current moment, there is a faint hope, and I would not put it as very high, but this is a very febrile atmosphere. There was a time barely, a year and a half ago that Boris Johnson looked completely indomitable, swept to one of the biggest election victories. He was out really quickly. Things are changing one way and the other. Labour is still unproven. That is the kind of faint hope that Conservatives, again, I was in the House of Commons last night, that's the sort of thing they're clinging to. I think they think that even if the polls come down to a mere kind of 10% Labour lead, that will be something where most of the people who are currently making the decision about which person will lead them now, that will make a big difference to a lot of them about whether they can hang on to their seats. But the key point is this is a parliamentary system. Parliamentary systems, in the end, it's about whether you have enough MPs to support the current government, and the only way in which this government will go is if some members of the existing government party start voting with the opposition on no confidence votes. Because at the moment, whoever's Prime Minister is not going to call an election rapidly.
Meanwhile, we are feeling the gallows humor of Great Britain right now. If you look at Twitter, it's lighting up with the lettuce one, the Daily Star coming out. The lettuce officially has outlasted Liz Truss and won. Guy Johnson still with us from Queen Victoria Street. And how much are we looking at a scenario where there is this deep feeling of sadness in the public that's represented by some of these humorous memes, etc., but a feeling of chaos and anger?
Frustration, I think, is probably the word that I would use, Lisa. The British public is clearly frustrated with what they've seen over the last few days because it impacts their lives. Mortgage rates have gone up and gone up sharply as a result of this. You take a look at the latest inflation data, it is impacted by what is unfolding politically. So this is not something that is kind of distant to them in some ways. It is real and will impact the family finances on a daily and weekly basis. And I think that's where the difference between this crisis and other crises maybe is. It has had an immediate effect on so many people, and I think that they will be feeling that right now. They will be wanting stability. They will be wanting mortgage rates to come back down. They will be wanting a sense of stability in their own lives.
Joining us right now is Lizzie Burden from 10 Downing Street as we try to parse through the rapidly moving backdrop of events. Lizzie, what is the latest in terms of who's lined up to succeed Liz Truss? What will happen in the time when she will remain Prime Minister until her successor is named?
Well, Lisa, we know that Liz Truss invited Graham Brady to Downing Street today. It's not clear whether he told her that it was time to go, or whether she felt like the stack of letters of no confidence was going to get so high it would be a humiliation and she's gone. But what we do know is that it's going to be a week-long leadership election, by the end of which we'll have a new Prime Minister. And the names, well, the favourite right now is Rishi Sunak, the former Chancellor, who of course ran against Liz Truss over the summer and was the MP's favourite. But there is, well, of course they are. Boris Johnson's allies are arguing that he's got the biggest mandate because he was actually chosen by the general public in 2019, but whether the public's forgiven him for all the scandals when he was in number 10 is another question. And I would just add, where Guy is saying that, you know, real people they care about their mortgages, they've not just had the chaos of the Truss government, they've also had the chaos of the Johnson government throughout the pandemic and in the months leading up to his downfall. Other names on the list, Penny Mordaunt, she's been pretty much auditioning in the Commons, but Jeremy Hunt, who seems to be in charge here, has ruled himself out.
Lizzie Burden, thank you so much. Again, we welcome all of you on Bloomberg Radio and Bloomberg Television. We're going to say goodbye to our editor-in-chief, John Micklethwaite, for his perspective. John, thank you for joining us here out of your meetings this morning in London. And we continue with Guy Johnson, Professor Blanchflower at Dartmouth College. We'll get to here in a moment. And I do want to continue to David Merritt right now. David, you live this. You led all of our coverage here forward out of Brexit. And I want to link in here, David, that I will attend at the Metropolitan Museum of Art today their magnificent new show, The Tudors, Art and Majesty in Renaissance England. A newly minted King Charles is very much aware of that. And his first order of business, David Merritt, was to visit repeatedly Scotland, Wales, and indeed Northern Ireland. How will the boroughs of England take to this resignation? What does it mean, for example, for David Blanchflower's Wales?
Well, yes, you know, the question of the unity of the United Kingdom has been under much debate in recent years, ever since, and aggravated since Brexit, of course. We had Mark Drakeford, the Labour leader of Wales, losing his temper in the Welsh Assembly this week over the behaviour of the politicians in Westminster. We've had Nicola Sturgeon saying, look, this is just another example of why the UK government is dysfunctional and Scotland needs a chance to go independent. So, of course, chaos in Westminster fueling Mark Drakeford in Wales, to be clear, is not calling for separation for the United Kingdom, but really fueling the chances of those national parties in the other parts of the United Kingdom. There is a case at the moment before the Supreme Court over whether Nicola Sturgeon, the Scottish leader, can hold a new independence referendum next year without the permission of the British government. That is not widely expected to succeed, but she's now saying the next general election will be a de facto referendum on Scottish independence, i.e. if the SNP win a majority in Scotland, she will be able to declare that Scotland is an independent nation. I mean, the chaos that would ensue from such a kind of unilateral move obviously would be immense. We've seen examples of this in recent years in Europe, in Spain, of course. So, you know, stability in Westminster really being craved for those who want to preserve the union as well as bring some sort of stability back to the economy.
David Merritt, thank you so much. And we know you are incredibly busy, so we'll let you get on with your day. David Merritt, thank you so much for your perspective, Senior Executive Editor for Bloomberg. Sticking with Wales, Danny Blanchflower, Dartmouth professor and former member of the Bank of England Monetary Policy Committee, still with us. Is this a concern for you, Danny, that there will be the beginning of, or an acceleration in the fraying of the Union in the United Kingdom?
Well, it certainly seems so. Obviously, the Scots did not vote to leave. Neither did the Northern Irish. And in fact, what's interesting, if we've been talking about Brexit, the one place that actually has been growing pretty strongly is Northern Ireland, which is more closely linked to the European Union. So certainly, I think that, I've spent a lot of time in Scotland. The Scots don't feel part of this English right-wing story of trickle-down economics. I think the answer is going to be over the next few months. What happens is this libertarian right lurch, has that now gone? Where do we go? I mean, the popularity of Brexit is declining even in England. And obviously, you were right. The First Minister of Wales this week, famously a quiet man, lost his temper with some of the comments that were being made. So I think there's a real issue here. The support for Brexit, I think, seems to be declining. But ultimately, we're going to have to try and get through this chaos. I think that's the first order story. I mean, let's just go back, in a sense, to all of this. All of this came because Truss didn't listen to comments of many people, including me. I said, Truss is going to have to go from Mrs. Stupid to Mrs. Sensible, given what she said as a campaigner. So she didn't do that. So we're in this position of chaos. Maybe this reordering will bring the country together. I doubt it, but it's hard to think, where does this go? I mean, this morning you didn't know where it was going to go. So where's it going to go in a month?
Okay.
I don't know.
David, I'm going to mention another David Stockman. What has absolutely stunned me in all of this, Professor Blanchflower, is we've been here before, and it's not a Daniel Yergin exercise in Commanding Heights. What it's about is Reaganomics 1 to Reaganomics 2. Now, within the American system, President Reagan didn't resign. From what you see here, and with the harsh financial ramifications that we've seen, including 7 standard deviation move and 30-year gilt, was this just Reaganomics 1 that couldn't get constitutionally to Reaganomics 2?
No, I mean, in a sense, I think that the big deal in many senses was that Reagan and Thatcher, whether you agreed with what they said, they had a political mandate. The people voted for it. So that was the first thing. Nobody voted for this. And in some sense, there was an economic credibility to what they did. I mean, what you saw Truss do, very much linked to what Quartain did, was to essentially try and blow up the markets. I mean, there was no possible way of having these enormous unfunded policies. The market simply couldn't sustain them. So I do think that the lack of mandate, the lack of sensible pricing and thinking about what the ramifications were. Yeah. So I don't really think there is much of an analogy. Ultimately, it comes down to they didn't have a mandate. They not only didn't have a mandate from the people, they actually didn't have a mandate from within their own party. So that's what we're seeing, this unscrambling. The party didn't vote for Truss. 81,000 people out there somewhere in the southeast of England voted for them. And so there was no political credibility and there was no economic credibility. So I don't really see that analogy. I mean, in a sense, I mean, I've never heard anything like it. The various economists, Chris Giles in the FT, Dario Perkins have said the cost of borrowing in the UK has gone up and now they're calling it the moron premium. I wouldn't argue that anything we ever saw in the past was as bad as that. I certainly wouldn't say that.
If you're just joining us right now, Liz Truss, the Prime Minister of the United Kingdom, stepping down, announcing her resignation. She will remain Prime Minister as the race to figure out who succeeds her takes place. We are seeing a bit of firming up in the pound. We're seeing yields in gilts come down. This is the stability people were looking for. On a broader level, there is an issue, Tom, with is this the beginning of a trend of basically bond vigilantes, of market participants controlling the political outcome at a time where there really isn't the same kind of appetite for fiscal spending that there was over the past 2 decades.
Well, we're going to have to see how that goes in the next coming days with Sterling 112.62, and we're watching, of course, the fixed income market in the United Kingdom with with lower yields. I guess vacillating yields here over the next number of last number of hours.
Yeah, although this really has been the theme of this morning, which is the reason why we've been really watching the yield story as a tea leaf 15 minutes here ahead of the U.S. Open. Kathy Jones of Charles Schwab joining us now. Kathy, how much do you really glean some sort of investment thesis from bond vigilantes rearing their heads and winning with political regime change?
Yeah, I think the story here is that as interest rates go up for most governments around the world, that the debt sustainability question comes back into play. Now, I think the UK is kind of a separate situation than most broader markets in the developed markets. But the story is now we have higher interest rates and higher debt levels, and it is going to be more difficult for governments to come in and use fiscal policy. They're going to likely be more constrained in this environment than they were over the last 10 or 15 years. And that's going to be a fact of life that will have to be dealt with.
What this comes down to, Kathy, and this is your wheelhouse, is we reinvent a risk-free rate. You're too young to remember this, but I remember when there was a normal risk-free rate with a 10-year real yield at 1.70, even printing 1.71 earlier, for all, including a beleaguered United Kingdom, I'm sorry, that completely changes the framework of fixed income, doesn't it?
Yeah, we're back to, and actually I do remember those days quite well. We're back to a different era, and I think that we will stay here. It doesn't mean that nominal yields have to keep going up, because if the Fed succeeds in bringing inflation down, that real yield can stay high with inflation coming down. But I do think we're in a positive real yield environment, unless or until we hit some sort of a crisis, and something breaks again, and the Fed has to be a lender of last resort. But I do think there has been regime change, and this is, and frankly, this is great for bond investors. Real yields are great.
Kathy Jones with us from Schwab, and we'll continue with this discussion on the markets. A headline just out from the gentleman leading the 1922 committee. Mr. Brady says there will be a new United Kingdom leader in place by a week and 1 day out to next Friday, October 28th, which is, of course, very different than what we saw with the transition from Johnson to Truss. We are hugely advantaged at Bloomberg and in London with, on Bloomberg Radio, Stephen Carroll keeps us moving forward. He is encyclopedic on something less spoken of, and that is Northern Ireland within the United Kingdom debate. Stephen, we were talking earlier about Scotland, about Wales with Professor Blanchflower, with our David Merritt. There was King Charles III visiting Northern Ireland. How engaged is Northern Ireland? How important is this resignation of the Prime Minister to the fractious Brexit debate of two Irelands?
Well, what's been considered or continued under Liz Truss as Prime Minister has been essentially the status quo in Northern Ireland. They still don't have an executive there. There have been high hopes from the unionist community that Liz Truss, as someone who had put a bill to Parliament which would have allowed the British government to override parts of their Brexit deal with the European Union, that they would find a deal that would allow the restoration of government in Northern Ireland. That hasn't happened, despite the meetings that have taken place, quite cordial ones, in fact, under the Northern Ireland Secretary, Chris Heaton-Harris, who met Ireland's Finance Minister only a couple of days ago. Ireland's Deputy Prime Minister was in London yesterday meeting with his counterpart, Therese Coffey. This is a series of relationship building which has now essentially gone out the window, because the efforts that had been made towards progress are now essentially stalled again as the UK goes back into another set of political turmoil. And there's a deadline in Northern Ireland. They must have a deal to restore power sharing by the end of next week, or another election has to be called for the Northern Irish Assembly. So people are watching this very closely, because it has a real impact on government in that part of the UK.
Stephen, my grandfather would say to me with great import that Dublin was closer to Wales than London was. And there's a whole geography question here, but the arch geography is the nation of Ireland. Do they tend to a unification now versus a few years ago?
Yes, much closer now than before the Brexit vote. That has been a massive change in Anglo-Irish relations, which had been largely improved after very fractious, as we all know, for many decades previously, since Ireland's independence in the past 100 years. But since 2016, things have taken a turn downwards. And now it's a question of whether or not the new Prime Minister can set things on a path which allow for good Anglo-Irish relations. We already had the Irish Finance Minister saying that they're looking for stability out of the Anglo-Irish relationship, because, of course, they want to resolve these problems. They want there to be good relations because of that open border on the island of Ireland between Ireland and Northern Ireland. We had that all-important demographic survey telling us that for the first time, Catholics in Northern Ireland, who traditionally identify as Irish, were in the majority for the first time since the creation of Northern Ireland. That was only a couple of weeks ago. We're probably many years away from the vote that is legally possible under the Northern Ireland peace deal, the Belfast Good Friday Agreement. That could happen, but that is in the gift of the Northern Ireland Secretary in London to give. So that will be something that certainly the nationalist side of the political divide in Northern Ireland will be watching very closely as the new government here is assembled. It's not a short-term issue. It's unlikely to arise during the lifetime of this government, but it is something certainly people are watching on for the medium to long term.
Meanwhile, we are looking at regime change in the United Kingdom, regime change in markets, regime change really spurred in part by inflation. And we have to keep going back to that as markets churn. We are seeing yields going higher as we try to figure out what this ends up as. And Kathy Jones of Charles Schwab is still with us at a time where, yes, the UK is a specific story, but we keep talking about how this is really spurred by a 10.1% CPI in the United Kingdom, the U.S. not far behind, Europe there as well. How much, Kathy, are we looking at a lack of willingness to really make the hard decisions to cause inflation to come down because of the political turmoil, also paired with the lack of perhaps the authority from certain central banking units?
Yeah, I think most central banks, led by the Fed, have made the decision that fighting inflation is their first and foremost goal, and so they've moved pretty aggressively, as have most other developed market countries. I think the problem going forward is that this focus is on current inflation, and they're not looking at future lack of inflation or disinflation or what comes after this, because they're so focused on achieving this goal in the short term. So it does set us up for a lot of volatility right now, and probably a great overshooting in terms of yields, because there's no confidence in the forecast coming from the central bank.
Lizzie, excuse me. Kathy, it speaks to the political instability of the moment. Now, we're not going to have resignations, I guess, on the first Tuesday of November in the United States. We've got central bank meetings coming up, the Fed, the Bank of England, ECB, I believe, on October 27th as well. Kathy Jones, you expect the same political turmoil, as Lisa mentions, to high inflation as we crash through the United States elections?
Well, I'm not a political analyst, and clearly inflation affects a lot of people.
Look, Kathy, today everyone's a political analyst. The Prime Minister just resigned.
I've never aspired to that. But obviously inflation, particularly gasoline prices, we know are highly correlated with consumer confidence and spending plans, and with political change. So that is clearly a big issue in the United States. I don't think it's at the acute level, however, that it was in the UK, simply because gas prices have come down a lot from the peak, and we have this rise in real interest rates already at work. And the unemployment rate is quite low. We don't have the energy shock going on that Europe has with the Russia-Ukraine war. So I think things are a little milder here. I think there are other issues on the table as well. But clearly inflation is going to be an important one.
Kathy Jones of Charles Schwab, thank you so much, and for putting on
the
political analyst.
Yeah,
exactly. Although, just to give you a sense, I mentioned the lettuce earlier. The political analysis of Twitter is ahead of lettuce that was put out by the tabloids. Who would last longer, the lettuce or Liz Truss? And it has been declared, and the victory of the lettuce this morning. How much does this really highlight the sort of dark humor to sort of deal with a moment where it's being taken to Greg's for potentially a sandwich?
John Farrow working an 18-hour day at Bloomberg, and I went out for dinner in Mayfair the evening after Brexit, and the numbness that I felt in the streets. I don't think that's anything compared to what we've seen over the last number of weeks.
It is sobering.
We will continue our coverage. We welcome all of you on radio and television, a special edition of Bloomberg Surveillance. Coming up, more, the resignation of the Prime Minister of the United Kingdom.
This is an extended version of Bloomberg Surveillance. Welcome on radio, on television. Tom Keene and Lisa Abramowitz. John Farrow is off today as we are seconds away from the opening bell. Lower, that is the direction of travel. Not much. This is an afterthought considering the political news of the morning. And that's, to me, really notable considering where yields are. We were talking about the shift upward. Lower, we could see right now the 10-year yield, 4.15%, almost 4.16%.
And to go off script here, in our special coverage, we forgot claims. It was right when the Prime Minister came out of the door of 10 Downing Street. Have we seen with Mr. Cameron and Ms. May and with Boris Johnson? And claims gave Jerome Powell a 75 basis point statistic.
Yeah, which is not exactly what he wants. And there is this conviction right now.
Number.
A good number. Good news is
terrible.
bad news. And that's what we're seeing on Wall Street, very much dominated right now by the United Kingdom. And Liz Truss stepping down, really highlighting, though, the tenuousness of an inflationary environment for political parties globally.
In our special coverage, we're on until Tottenham wins again, right?
So then we're going to be on to the day we die. Right now, we want to just get a sense, though, honestly. It is important to put this into perspective, and Michael Purvis can help us do that. Just briefly, before diving back into the political fray in the United Kingdom, Michael Purvis of Talbot Capital, as you've been parsing through all of the political discussion, how much of a message do you take back to markets, to this idea that they are in charge and they are imposing fiscal discipline?
Well, I think there's a really important overarching theme here that we can divine from this whole Truss episode here, which is that, look, the Fed has been on this sort of America First monetary policy that has been, of course, very hawkish as it needs to tamp down inflation here in the U.S. But when you have fiscal experiments overseas that are that Truss, put forward and that are not sensible policies, the what it means for global risk assets is really sort of magnified here. So you have a collision. What I'm saying here is that the range of big weird outcomes for the markets is much higher when you have this collision of bad fiscal policy with what the Fed is doing right now. And I think that's very, 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 very important. I mean, I think it's a fair statement that central banks generally like low currency balls here, right? It just makes their job easier. And we're in a state of where, we can talk about rate vol being super high and of course equity vols high, but FX vols are super, super high here. And it ultimately makes the central bank, we're all grappling through when central banks are going to be more, sort of not led around the nose by inflation and hydrocarbons, and when they can actually lead as opposed to be reactive. And these types of situations only make central banks, whether it's the BOE or even spill over to the Fed, more reactive.
Michael, that's right where I wanted to go. Neil Shearing to join us later in this hour with a real focus on the United Kingdom economy. But as Mr. Purvis, folks, talks about vol and, of course, his careful study of the Pacific Rim and ADXY, it is thrilling to bring you this morning Nick Benenbrook. He is Wells Fargo international economist, but he viscerally understands the Pacific Rim with his heritage of New Zealand, and far more, is the only person on the planet who has been award-winning in foreign exchange in back-to-back years. Nick, I guess it's good you're not an FX strategist this morning. Purvis talks about FX vol. Give us the vol we're going to see on British pound sterling.
Well, I think certainly for the next few days, we can expect this volatility to continue. It might actually be in the upwards direction because you could argue that political and policy uncertainty is reducing in the United Kingdom. And so we might see a bit more of a relief and go back towards the sort of even up to the 113, 114 level. So, I think we're going to see some further up move. Over the months ahead, I think as dust settles, we'll start to see markets calm down a little, and we might actually start to see the pound, when it's faced with the reality of the UK economy, the pound might start to give back some of those gains.
Nick, to what Michael Purvis alluded to, and if it is Britain in crisis, maybe it's Hungary in crisis, maybe it's Thailand in crisis, will Jerome Powell need to blink because of the international economics and politics we observe?
No, I don't think you will have to blink. I mean, we would still expect a 75 basis point increase at that November meeting from the Federal Reserve. Of course. And as one of your, you know, I think we still look for a 50 and eventually getting to 5% on the Fed funds rate. I think the UK events are instructive in the sense of it does come back, as one of your previous guests said, how sort of unorthodox or unusual are the fiscal policies. And, you know, they were fairly unorthodox in the case of the UK, just in terms of the magnitude and the way that they were delivered. And it doesn't look like here in the US, for example, or even across the Eurozone in general, that we're going to see such expansive fiscal policies. So for the major markets, I think it won't be an issue. But for the markets that you mentioned, the likes of Hungary and Thailand, they may face some challenges.
Michael Purvis still with us. And Michael, I'd love to get your take on what Nick is talking about, that there is some more stability, but the stability speaks to a more significant downturn, at least in the short run, based on the lack of borrowing. How much are you factoring that into some of your outcomes and your theses?
Look, I think what this whole Truss episode really sort of reiterates is that we need kind of boring policy, if you will, right? And I think there's this inevitable tension where you know, like a politician's one of their biggest enemies is surging food and energy inflation, and there's always sort of a temptation to put in novel fiscal policies when they're actually the worst things for the situation. So we kind of need to see things get a lot more boring. But I agree with my co-guest that I think if for the major markets here, if things can be a little bit more static and stable, then more of the blow-ups will be relegated to more the niche markets here. But I think if the takeaway here from this Truss situation is that she's gone and we're going to go to a much more technocratic and less quote unquote innovative fiscal policy, so responses to this high inflation, that's going to be sort of enhance market stability here, yeah, which is sorely needed.
Perhaps another way of saying talk of MMT might have died a very rapid death over the past few months. Nick Benenbrook is still with us. I am wondering what this means in terms of energy policy for Europe at a time when a lot of nations, including Germany, were looking to spend extensively to stave off some of the gaps in the household budgets. Does this torpedo some of that, or does that pressure the euro and just German yields higher in a way that hasn't fully been realized yet?
No, I don't think it's going to derail those energy price plans that we've seen across Europe. I did see some estimates the other day, maybe in the region of 40 to 50 billion euros to sort of help support the energy price plans there. And, even going back to the UK experience, it wasn't so much the initial energy price cap that caused the consternation on the part of market participants. It was the growth plan in late September and the unfunded policies there. So coming back to my earlier comment, I don't perceive the extent of fiscal support or fiscal expansion that they're talking about across Europe as being so dramatic that they'll have to move away from those policies.
Nick Benenbrook, just for you, and with such respect for your FX ability to call over the years, I looked at sterling New Zealand dollar. I don't know what that's called. Is that sterling Kiwi? Is that the fancy talk? I've never done it.
Me. I love this.
I've never done it before. But Nick Benenbrook, the bottom line is massive New Zealand strength over 20 years, and now we're buttressed down at the low end, a strong New Zealand dollar trading range. What are the ramifications for the global system if we see things like sterling Kiwi break out to new sterling weakness? That's an instability that Michael Purvis was talking about.
Well, again, I think coming back to your previous comment, though, Tom, it depends on the extent of volatility and just how dramatic those moves are. I've been around for a while, 20 years, maybe even longer. We've seen some unusual things. The Australian dollar trading above parity against the US dollar, for example, would be one of those. So I think so. If this is just reflective of maybe increasing commodity prices in general and just the relative performance of these economies, then if you continue to move in that direction, so long as it's orderly, I think it's not problematic. It does. 20 years ago, I was living in London for a couple of years, so maybe I should be living there now. It would have been much nicer given the Kiwi sterling exchange rate.
Wells Fargo international economist Nick Benenbrook, thank you so much. Also, our thanks to Michael Purvis for your guidance here. I do want to just bring you, and we've been talking about the lettuce concept for a while, but the reason why I find this interesting is because this has been just lighting up Twitter with Aldi stores in the United Kingdom putting out a Twitter post saying, what a great day to be a lettuce, and it's gotten, it's just
on this.
well,
I mean,
the reason why is because it perfectly encapsulates both the issues with food as well as just in terms of the gallows humor. I keep going back to this because where do we get that feeling of, oh my goodness, we're seeing our mortgage costs go up, we're seeing our energy costs go up.
This is from Aldi stores.
Yeah, this is from Aldi stores in the United Kingdom. What a great day to be a lettuce, and people are loving it. They're all sorts of other memes, etc. But it really does highlight the moment. That's why I keep highlighting it.
We welcome all of you of Global Wall Street and all tuning in on radio and television. An extraordinary day. I'm going to do a quick data check here, starting with Sterling, 112.58. Red and green on the screen. Thankfully, equity market's not giving us a story in the middle of earnings season. I guess I could say the 10-year real yield out to 1.71% is news, and United States yields are higher today. It's all been overwhelmed by the international relations of the resignation of the Prime Minister of the United Kingdom. Let us listen to Liz Truss earlier this morning.
We set out a vision for a low-tax, high-growth economy that would take advantage of the freedoms of Brexit. I recognise, though, given the situation, I cannot deliver the mandate on which I was elected by the Conservative Party. I have therefore spoken to His Majesty the King to notify him that I am resigning as leader of the Conservative Party.
Prime Minister Truss from that podium outside 10 Downing Street and the long walk back through that famous black door. Joining us now, Lizzie Burden is at 10 Downing Street. She's been on this story from the get-go. Lizzie, a general question for those of us not up to speed. How unified is Liz Truss's fractured Conservative Party?
Whatever the opposite of that is, completely divided, and these divisions have been sown for years, perhaps going back before Brexit, and that's what's so difficult in this leadership race. We heard from Graham Brady, the chairman of the 1922 Committee of Conservative Backbenchers, just now saying that there's going to be a leadership election by Friday. And Rishi Sunak may be the bookie's favourite, but he's incredibly divisive in the party because he's seen as having brought down Boris Johnson, even though he would be such a shoo-in to Jeremy Hunt's economic policies. He faces such a mountain to climb. But what you might see, even though this party is so divided, is that because there's such a fear of a general election, they know how divisive a leadership contest internally can be, that they all just fall behind one candidate and it doesn't actually have to go to the party membership.
Is Jeremy Hunt just playing hard to get? Does he actually want to be Prime Minister?
No, but this is all that markets care about, that Jeremy Hunt is safe. You've seen a lift in the pound and gilts the last time I had a look, and that's because markets are confident that these fiscal plans are going to go ahead. Graham Brady also said that the fiscal statement on the 31st of October that we were expecting is going to go ahead. It means that the Bank of England can take account of that on November the 3rd. And yeah, it's really all markets care about.
Lizzie, thank you so much for your coverage this morning through surveillance. I know you're going to be there through the United Kingdom afternoon, but we all Lisa and I and John greatly appreciate your effort today at 10 Downing Street. We return to Guy Johnson getting ready for a 10 o'clock effort in New York. And of course, not only up to speed on all of this elite talk, but I think Guy Johnson's got a spectacular knowledge about the other people
Oh my goodness.
as well.
Can I bring this out?
I'll let you bring this up from a very good source, Swinford over at the Times of London, and then you can go to Guy Johnson on this.
Well, Boris
because
Johnson.
Johnson to Johnson.
Yeah, exactly. The Times of London is saying that Boris Johnson is expected to stand in contest at a time when perhaps, where was he? The Caribbean? And people are wondering or trying to find this. But Guy Johnson is with us. Guy, your reaction to this headline?
Maybe he will cut his holiday short. Maybe he will return. It's interesting. So you've got a sort of two-stage process here. And I think we need to think about those two stages as being distinct. So it was interesting to hear what Lizzie had to say about the possibility of one candidate ultimately being put forward. Is there the tolerance within the Conservative Party after the huge volatility we've seen over the last few days for a Boris Johnson return? Is that something, are they prepared to go back to what was a fairly chaotic effort inside 10 Downing Street from Boris Johnson and his team? Or are they looking ahead thinking what we need here is actually stability? And Boris Johnson, as John Micklethwaite was putting out a little bit earlier on, not exactly synonymous with that, Tom.
My amateur take, Guy, is Johnson was thrown out because of scandal, cocktails, whatever it was. I don't remember the details. I don't care. Are the Brits, as Farrell would say, are they forgiving of that to say you were thrown out, you served your punishment? And would we see a different or new Prime Minister Boris Johnson October 29th?
There's been very little evidence of a new Boris Johnson, but I guess anything is possible. Boris Johnson, I suspect, is very popular within the Conservative Party grassroots, i.e. the party, but within the parliamentary party, which ultimately is going to decide which two candidates go forward, I don't know. And that is where the challenge for Boris Johnson is ultimately going to be here. Clearly, he would like to return. Right. Clearly, he is interested in retaking 10 Downing Street. But nevertheless, he has got to convince the parliamentary party that that is a good idea. And I think they threw him out because they were sick and tired of the turbulence. We just had even more turbulence. I'm not sure that they want any more
but Guy,
at this point.
There's also an issue here with the overhang of Brexit, because Boris Johnson oversaw the whole process. How much is Brexit still a popular decision, especially in the wake of the turmoil that we've seen over the past couple of months?
It's still a hugely divisive issue, Lisa, and as we were hearing earlier on, it is not a completed project. And therein lies the problem. Boris Johnson didn't get Brexit done. Do we want to return to the instability also that the issue of Brexit, when pursued aggressively, can generate? The Northern Ireland Protocol, we haven't talked much about that, have we? But it still lingers as an issue. It was interesting to hear what Mr. Macron over the channel had to say an hour or so ago.
Yeah.
The issue now is that the parliamentary party is in job preservation mode. Is Boris Johnson, is that boosterism, is that cakeism going to be enough to get him back into prime position? I don't know.
I want to frame the next 13 minutes for you folks, why you need to stay with us on radio and television. Neil Shearing's going to be up next with piercing conversation, but I've got to continue with Guy Johnson on the former prime minister. Is there almost a yearning by all for Boris, I can't believe I'm saying this, Guy, but Boris stability? I mean, is that the emotion that we're going to see into the British evening?
I think that's an oxymoron, Tom, but yes.
I was going to say so.
Could you put Boris Johnson and Jeremy Hunt together? Remember, they competed. You asked the question a little bit earlier on.
Come on. Are they on
does
speaking
Jeremy Hunt
terms?
want to be Prime Minister? He competed to be Prime Minister. What I think is interesting about Jeremy Hunt is, has the Boris wing of the Conservative Party forgiven Jeremy Hunt for basically competing with Boris Johnson? I suspect the answer is yes. Have they forgiven Rishi Sunak? I suspect the answer is no. So, and that's where I think all of this becomes extremely interesting as to kind of which factions are positioning sort of behind which candidates. But I think I come back to this issue. We have just had a huge bout of instability. That is something that the Conservative Party, I think, is desperate to put behind them.
Guy, how much, as we look to the likelihood of a Boris Johnson kind of prime ministership, yet again, are people looking for a celebrity versus a technocrat?
I think that comes down to the same issue, Lisa. They would like to be able to win the next general. They would like to be able to win the next general election. Are you going to do that with celebrity, or are you going to do that with stability? And we've still got 2 odd years to go until that general election. The searchlight of public opinion has yet to really settle on the Labour Party and its leadership. It will do at some point, and it will and it will be a huge challenge for them.
I think my solution there to Guy and to you, Lisa, is that Kenneth Branagh ought to come back and run for Prime Minister since he was just doing the Boris movie as well.
Guy Johnson in London, thank you so much for your coverage throughout the morning. I'm sure we'll be hearing much more, and you'll be joining starting at 10 for full coverage. Right now, we want to get a sense, just going to the economic picture, really at the core of the turmoil and the core of what's to come. Capital Economics Chief Economist Neil Shearing joining us now. What's your sense, Neil, of how the ramification of this will play out for the United Kingdom as the world's 6th largest economy at a time of such tumult, both from the leadership as well as, honestly, from an inflation standpoint?
Well, look, the 6th largest economy at the moment, but factoring the weaker pound, it may not be the 6th largest economy for much longer. I think that the key thing, and you touched on this in some of the reporting earlier, is less at the moment who's in number 10 and who's in number 11, who's running the Treasury, what they're saying about fiscal policy, the extent to which there's a steady hand on the tiller there in the context of all the tumult that we've seen over the past several weeks. Now, the news that Johnson might be back and putting his name on the ballot paper, I think is literally the last thing that the UK bond markets will want to see. So let's see how that one plays out. But the economic picture is pretty grim, I have to say. There's a huge squeeze in real incomes coming down the track. Interest rates have got to rise further, irrespective of what's happening to fiscal policy. The housing market looks vulnerable to me. The Bank of England needs to do more work to squeeze inflation out of the system. Every which way you look, there are challenges.
Neil, I want you to talk, and you've done great work on this at Capital Economics. I'd really say industry leading work on the polarity, the delusion, folks, is I go from Heathrow in on a limo to the fancy hotel, walk across the street, enjoy Queen Victoria Street, fly home and say I went to England. And that's, of course, a complete fiction. Neil Shearing, outside the elite climes of London, how bad is it for the United Kingdom economy?
It's bad. It's bad in London. It's bad in the United Kingdom generally. I think you're right. There is huge disparity, both of economic growth and income growth, and also wealth within the economy, and that's greater to a much greater extent in the UK than is in the case in other European cities, and there's other European countries, and there's lots of reason for that: poor infrastructure, poor skills. Poor dispersion of technologies across industries within the UK, but you're correct. I mean, London is and London and the southeast incomes and income growth are far higher than is the case elsewhere in the country. But this is not the case that the rest of the country is suffering while London is powering ahead. London is going to suffer in this downturn too.
You talked about the 6th largest economy for now and where it was headed. What do you see in terms of what kind of downturn you're expecting and how this turmoil really plays into it?
Well, look, in terms of the pure economic downturn, I think we're staring down the barrel of probably a 2% fall in GDP, something like that, peak to trough. I think a lot of that will be felt in the household sector. Consumers coming under enormous pressure, the housing market and construction coming under pressure too. The question really is whether or not that, in turn, there's feedback loops through the financial system that amplifies those shocks and makes things even worse. Now, interestingly, I think the interesting question from the market's perspective is how much of that is now priced in. It's interesting that the Truss has resigned this afternoon, London time, and the bond markets didn't really move. The currency markets not really moved. The big move came last week when Hunt came in, unwound a lot of the fiscal measures. And so I think a lot of that risk premium that went into the UK markets has probably already unwound itself.
Neil, we are advantaged to close with you today. Thank you so much. Neil Shearing for Capital Economics. Again, I can't say enough about the firms where get their research from Capital Economics. We protect the copyright of all of our guests. I'm going to say this now, Lisa, rather than at the end when we're rushing and crashing to break and we're worn out and all that. What an effort by our team today, and that we really didn't see this coming. I would say last night about 11 p.m. New York time, I was like, oh, tomorrow.
Yeah.
But we really, Qantas and the team really pieced this together today with, I think, a great set of voices within Bloomberg and outside as well.
And we have an incredible stable of talent here at Bloomberg. Just to take a step back, to really paint the picture, the shortest tenure of a prime ministership ever, going back, the second most, going back to the 1800s.
Canning, to the early 1800s,
to the early
1800s,
and that was ended by tuberculosis, highlights how fast this had moved. I keep going back to this, that Liz Truss accepted the prime minister role from the Queen and then handed in her resignation to the king because of the transition in power there, the transition in the sort of metaphor of some of this turmoil. How much does this reshape politics in the UK going forward?
I agree, totally.
And highlight the turmoil stemming more broadly from an inflationary regime that is new, at least over the past couple of
Kit
decades.
Jukes with a brilliant note of SocGen today on a 112.46 sterling, alluding to resilient dollar, sterling weaker. But I agree with you that there's ramifications here that our David Merritt talked about, not only for England, not only for financial London and Edinburgh, but also for Wales and Scotland and Northern Ireland.
And John Micklethwaite saying that this political moment went over the edge for this market.
There will be continued news, Lizzie Burden tells us, into the evening of London. Please stay with Bloomberg on radio and television. The Prime Minister has resigned.
Not a predictor of what to expect for the rest of earnings season. Banks do tend to march to their own drumbeat. Yes, we want to look at the consumer read through, we want to look at lending growth, but in an environment where liquidity is extremely ample, easy to access, that sort of lending queue has not been particularly profound as a driver of overall economic conditions. Obviously, companies, for example, are getting tremendous amount of cash. They're still sitting on large cash loads. They're still generally producing some cash flow. That is funding operations and certainly funding activity outside of financial sector lending conditions. Credit spreads likewise have been very tight relative to past experiences of stress. So credit has been somewhat ample, especially over the last year. So I think that the financials, while they are an indicator of some things, they've really lost their lead in a lot of ways. Maybe that lead is reestablished over the next couple of quarters, but this year in particular, we haven't seen financials operate as a leader.
Is there a leader? And I ask this at a time when we talked about United Airlines, for example, or some of the airline companies that might be benefiting disproportionately from business travel, from upper income individuals who are still able to travel even as lower income individuals pull back on spending at certain retailers or certain consumer facing shops. What is the industry to watch?
Yeah, there are three segments that are very traditionally leading indicators of overall market activity as well as overall earnings trends. Those are semiconductors and the technology space. Obviously, that's been an area where we've been watching inventories very closely. There are home builders in the consumer discretionary space. Notably, home builders have actually broken out of a downtrend. Will they be able to establish a steady pace of earnings growth over the next year is a very huge question. And then the third is transports within the industrial space. Those are the three segments that are true leading indicators of actual economic conditions. They're the most important segments to watch for earnings cues going forward. Yeah. I'd say the only other thing I'd load up on in there is mega cap stocks. The 5 biggest stocks in the index are now driving roughly 20% of income. They're about 25% of market cap of the S&P 500. Wow. So for the large cap index specifically, this group is impossible to ignore.
Gina, I want to pull out that book you and I loved, White Sandy Freed, and Ben, page 842, they talk about FX adjustment. My amateur take is 2 to 3%, multinational. There's a, who cares? It's noise. We're clearly not in a noise aspect. That 2 to 3% FX headwind, what's the new number?
Yeah, it's going to be a really interesting earnings season. Usually we get about 30% of companies on the index are actually exposed to currency because those are the biggest multinational companies. They're the ones that actually sell overseas. The companies most exposed to Europe and China in particular are the companies to watch. That's about 17% of sales on the index. But the degree to which the currency has moved would suggest that these companies are going to experience some degree of pretty extreme currency pressure, provided they weren't hedged coming into the season. Now, I think what's interesting about this is going into second quarter, remember we had the same phenomenon. The dollar was absolutely surging into second quarter earnings. We did see the multinationals generally underperform. Note currency as an underperformance factor. It had almost no net impact on the stocks. So will it impact the stocks is a very different question than will it impact the earnings stream. We think it definitely will impact the earnings stream. At this point in the cycle, every 1% gain in the dollar is worth about 17 bips on earnings growth. So we do have an impact overall, but will it impact the stocks or is it in the stocks is the key question for investors.
Hey, Gina, wonderful, as always. Gina Martin-Adams there of Bloomberg Intelligence responding to the earnings we've had so far. Looking ahead to the earnings still to come. Next week is just a massive week. Next Thursday, Apple and Amazon after the close, and Tom, the same day, earlier that morning, we get the ECB decision in the mix as well. So busy morning next Thursday, October 27th.
October 27th.
I've never been a big fan of bank earnings season. I'm all about the big tech players next week. Much more interested.
Well, Gina just mentioned that. I mean, the percent of capitalization, the percent of the market, the percent of the Dow Jones Industrial.
Of course, the Dow is very, very important. I'll change the subject quickly. I was busy reading a YouGov poll, and the headline reads as follows, Tom. Most Tory members say Liz Truss should resign. Surprise, surprise. The next line says Boris Johnson is the most popular successor of the Conservative Party members. That poll just out.
And I mentioned this yesterday. That's what Churchill did. Churchill would die and come back, right? Die and come back.
You reckon he might come back?
I'm unqualified.
Not Churchill. Not Churchill.
No.
Boris.
I could argue that Churchill is not making a comeback.
Coming up in the next hour, Jerome Schneider will be with us, the managing director over at PIMCO. Live from New York City this morning. Good morning. Equities doing better than good and Goldman doing okay. Equity futures advancing from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Slogans attacking President Xi Jinping featured on banners on a Beijing bridge last week have spread to other cities in China, as well as across the globe. Phrases from the original handwritten banners have criticized strict lockdowns and restrictions that have defined Xi's COVID-19 zero policy and called for new elections. German Chancellor Olaf Scholz has ordered an extension of the lives of the country's three remaining nuclear plants until April 2023. And that decision is meant to end a standoff between two coalition partners. The Greens are opposed to nuclear power, but the Free Democrats argue Germany should use all of the generation capacity available to tackle the energy crisis. Chip delivery time shrank by 4 days in September, the biggest drop in years. It's a sign that the industry's supply crunch is easing. Lead times, the gap between when a chip is ordered and when it's delivered, averaged 26.3 weeks in the period, according to Susquehanna Financial Group, down from nearly 27 weeks the prior month. Women in leadership roles are quitting at a faster rate than ever. A new report from McKinsey & Company and leanin.org, it shows that for every woman at the director level who gets promoted, 2 female directors are choosing to leave. A lack of advancement opportunities, flexibility, or unequal treatment are to blame. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The Fed is on a mission. This is a very intentional and aggressive tightening of domestic monetary conditions in an effort to slow growth, slow demand, specifically loosen up the labor market a little bit to get inflation back to target. So definitionally, there are going to be some things that probably break along the way.
The brilliant Bob Miller there, the head of America's fundamental fixed income over at BlackRock, live from New York City this morning. Good morning to you all. Equities pushing higher again on the S&P 500, pushing higher by 1.9% on the S&P, up by 69 points. Treasury yields moving the other way. We're down a basis point to 399.63, call it 399.40 on a 10-year right now in the FX market. Euro not doing much, a bit weaker going into the ECB next week. We're negative a tenth of 1% on euro dollar, 98.33, and crude up a tenth, 85.55. As we reported overnight, Tom, that we could get another SPR release from this White House, maybe getting that announcement later this week. And can we just tally up things so far? We've had 180 million barrels released from the SPR.
It's just different than my youth. I mean, I guess Bill Clinton was the first one to get out here with the experiment of a release, and this is very, very different. Granted, a war in Ukraine, but I'm going to barbell it, John, $86 on American oil, $92 on Brent crude. And obviously, you mentioned this earlier, it's the election, but
sure,
are those elevated prices? I don't
Tom,
know.
The question I'm asking is, how vulnerable are we to the whims of OPEC Plus next year if we've drained the SPR? Is this a one-off shock that we get over early next year and we can move on from, in which case this is an appropriate use of the SPR to get over a short-term one-off shock to cover a flow issue? Or is it something bigger than that? And if you believe it's the latter, then we're exposed next year and a little bit more vulnerable, Tom, than we otherwise would be.
We will see. Right now on GDP, and of course, this coming off the bang-up Goldman Sachs earnings and what we've seen, futures up 70. The VIX really doesn't move yet, 30.85. We get a view on the economy with Stephen Risciuto, Chief U.S. Economist at Mizuho. The tag team of Risciuto and Constam, outstanding at Mizuho. Steve Risciuto, I want to talk about the hope and prayer that inflation will come in. We're beginning to see glimmers of goods inflation coming down off of all the pandemic gyrations. Do you model that goods inflation can get back to a strong disinflation, or dare I say deflation?
Well, really good question. I think the answer to that is after we get through this cycle, there is a reality that is going to settle in that the world still exists in excess supply. And that, in fact, through the diversification of supply chains, we've probably amplified that excess supply, especially against the backdrop of global decelerations in growth that are likely to be sustainable, not just in the U.S., not just in Europe, but also in China. And the net result is, since we haven't destroyed the capacity as a result of the COVID shock and the latest inflation and the results of that, we're going to be sitting with too much capacity at some point in time, and that will drive down good prices and will lead to a deflationary bias down the pipeline. But the key, I think, for you is this going to lead to near zero interest rates again? And the answer is probably not.
Doug in Florida grilled to the New York Yankees this afternoon, 4 p.m. He emails in and says, ask Risciuto about housing. How does housing fold into service and goods inflation?
Well, I mean, housing is a critical part of it. It's one of the most interest rate sensitive sectors of the economy. The automobile space is the other side that's very, very interest rate sensitive. And we're seeing problems developing in both of those spaces. And yes, as demand gets pulled back, those are big ticket items. Those are items that get reflected very, very quickly in terms of the chains of production. And I think those are part and parcel of what we're experiencing in terms of the downward draft that we're already getting in terms of goods inflation. We're still struggling with the service inflation component of this, however.
Steve, you said something that I want you to elaborate on, that we're probably not going back to 0% interest rates again in the near future. What is the baseline interest rate that you see as where we end up once we're out of this inflationary and then disinflationary period?
Yeah, I think it's around 2%. I think it's consistent with the underlying trend rate of growth in the economy as to where real short-term interest rates have to be. The near zero interest rate environments occurred in an environment where we had systemic credit issues that had to be corrected in the economy, and therefore you needed to create abnormally low levels of interest rates to correct that problem. In this environment, we don't see those structural credit issues. There are going to be companies that go bankrupt. There are going to be financial institutions that have problems in here. But if you go back to areas like 1975, where we didn't have systemic credit problems really dominating the business cycle, we had upwards of 140 financial institutions that needed to be resolved and 2 insurance companies that needed to be assumed by other insurance companies. And we didn't have a systemic credit risk. So there are going to be, casualties as a result of this, but they're not going to lead to a systemic credit crunch environment.
The casualties, Steve, how much is that going to be the fiscal programs of a lot of developed markets? How much are you going to see a massive program to reduce debt in the developed world?
Well, there is no doubt that there's a lot of debt that has been accumulated, but also keep in mind, for most of these governments, including our own, a lot of the debt has now been internalized by central banks, and therefore, in our case in particular, all that interest expense gets credited back to the U.S. Treasury, and therefore is pretty much of a net wash. I don't think we're going to really reduce the debt as much as we are going to allow the economy to grow around the debt, which means we're not going to be able to go through expansive fiscal policy programs for quite some period of time without having it being reflected in long-term interest rates.
Hey, Steve, you're one of the best. It's always great to hear from you. Steve Rashuda there of Mizuho on the latest. Did you see the Mohamed El-Erian tweet yesterday? It got a ton of feedback. This one was fascinating. Here it is for you. An independent Federal Reserve is critical to the well-being of the US economy. Having said that, it is getting harder to justify such independence when 4 big operational errors of analysis, forecast, actions and communication are accompanied by a lack of accountability. Lisa, your thoughts?
Well, first, to just clarify, it does not seem like he is, in his clarification, saying that the Fed should not be independent. But the issue is, how much credibility has the Fed lost, and how do they need to regain it in order to protect themselves against losing said independence because of the faith that they have lost in some of these errors? It's a massive issue, and you're seeing this certainly with the political sphere, and you're going to hear that with more Elizabeth Warren discussions around what they're doing.
And Sanders too, without a doubt. Tom, I messaged Mohammed last night about this. Effectively, what he's trying to communicate here is that the errors that have been made have invited criticism and pushback around the central bank's independence.
I take real issue with this. I think Ambrose Evans-Pritchard, who Mohammed and I know well, did a tour de force in the Telegraph on this. The traditional theory and the construct of it, including the Phillips curve, and as the laureate Krugman mentions, the Beveridge curve, they don't work in a pandemic-adjusted regime shift, to use Bullard's phrase. And with that, they're flying blind every moment. They've made mistakes, no question about that, but it's not within a normal, theoretically founded structure. It's original. They're allowed to make mistakes.
To Lisa's point, Senator Sanders, Senator Warren, this is all just getting going. This is the beginning. It's not the end of any of this. When you start to see unemployment go the other way and the Fed comes out and says, yeah, this is the objective, we've got a problem.
And this is going to be an even bigger discussion when you go to the point that we were just talking about, where you have basically monetized fiscal budgets, and that's something else that's an issue.
Equity futures up 1.8% on the S&P. Live from New York, this is Bloomberg.
The Fed is still the central focus. And when it comes to the dollar, there's a lot of concern.
Clearly, inflation is becoming more entrenched.
I think it's in February and March. That's the sort of timing I have for dollar weakness to come back in.
The Fed is on a mission. This is a very intentional and aggressive tightening of domestic monetary conditions.
This is a long, drawn-out, multi-quarter economic downturn, not something that's going to reverse quickly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene on radio and television. Jamie says business is okay. Brian says business is okay. David says business is okay. John, there's a theme here.
And don't forget Jane. Jane says the US economy remains relatively resilient. So every single chief on Wall Street is basically telling you the same thing. 3Q is okay. Business is doing okay.
And we saw this the last quarter as well. And the one is, I guess, as Bramo says, it's the view forward in the conference call, and we'll have to see what they say.
The view forward is uncertain. It is uncertain. And if you want to get bullish, the ultimate lows, according to Bank of America and Mr. Hartnett, front half of 2023. No cuts, no party. Seems to be the story.
Everybody just again, we look at equities, bonds, currencies, commodities. We'll do that in a minute here. A fairly quiet day. But, John, not quiet in the United Kingdom. Continued volatility for Governor Bailey.
I mean, I can't keep up. So the FT came out overnight and suggested this Bank of England was ready to delay QT. Then the Bank of England came out several hours later and said that report was inaccurate. So, Tom, you decide. And sterling in between has been absolutely whipsawed. The Prime Minister's just about hanging on. We've had basically the budget. You'll get the full budget at the end of the month. And the Bank of England's going to make a decision in early November to hike interest rates, Tom, maybe by 75 basis points, perhaps even more.
Lisa, you featured earnings earlier in the brief, and to me it's the arc of the elites doing really well and a whole bunch of other people really struggling here within the UK, the US, and frankly the global economy as well. It looks like it's two global economies.
Which is the reason why it's going to be even more political as the Fed continues to tighten rates in response to the inflation and the persistence that you're seeing, particularly with people who do have more money that are spending it. And we talk about how it's an uncertain road forward. The earnings have been looking good. And so right now you're having a 4.93% Fed funds rate being priced into the market as of March 2022. What does that do to the economy? 2023. Yeah, I lose track of these years.
But still, that's on the edge of 5%. And John, we're not framing that.
Look at this rally. We're at 1.8% on the S&P 500. We had a monster move yesterday and we're adding to it. Bear market rally. I think that's what many people are calling it. Mike Wilson and Morgan Stanley expected it.
Okay, Wilson's been very good on this, and some of the bulls are adjusting. We'll get to that in a moment. Andrew Sheets with us in a moment. John, let's start the data. I'm going to go to yen, which is in, I guess, intervention territory, 149.13 on the edge of 150.
Kick it off with equities. Get the board up. Equities absolutely flying. We're flying here. Again, up by 1.9% on the S&P 500. Futures up 69. Yields not doing much. In and around 4% on a US 10-year. At the front end of the curve, through 450 last week. And the conversation we've got to have, how much scope is there for more upside on pricing this Fed terminal rate? You said we're close to 5 right now. How much further are we willing to push this?
But that's not the issue, right, that people are talking about, particularly Peter Scheer. He's talking about what's the weakness that would have to be seen for them to pull back from this, and how is that going to be priced? And I almost got the sense that once we treat bad news as bad news, that possibly is when we start to get the capitulation that everyone's been looking for the next cycle to start.
That's the Bramwell concept.
Well, what do you make of how we're treating the data so far? We had that monster upside surprise on CPI. And then we rallied really, really hard, and we're doing the same thing again this week.
Dow futures up 500 points just to get your attention.
Thanks,
the
Tom.
Bloomberg Financial Conditions Index, 1.5 to 1.2. It's less restrictive. And this morning, Andrew Sheets knows that. He's Chief Cross Asset Strategist at Morgan Stanley and joins us. It's going to be an amazing set of meetings, Andrew, at Morgan Stanley today to recalibrate into November. Take the jumble and make sense of it. How do you recalibrate to the end of the year?
Well, thanks, and it's really nice to be here with you guys. So look, I think you have an overlap of a tactical story with a bigger strategic story. Tactically, as you heard, my colleague Mike Wilson turned tactically bullish on the S&P as of Sunday night. You know, he sees the potential for a rally to 4,000. A number of the tactical indicators that we follow do suggest a market where sentiment's pretty negative. Things look oversold. Maybe actually earnings season, after a lot of negative guidance, turns out okay, and you're into a window where seasonality for risk assets is often somewhat better. But big picture, you know, we still have growth that's going to be slowing over the next 3 to 6 months. We still have a lot of monetary policy tightening ahead of us, even if markets don't price anything in additional above what's already expected. So, and you still have earnings that we think in the U.S. and Europe will need to be revised down, you know, in the fourth quarter or the first quarter next year. So I think the way to think about this is a bear market rally. It's short, it's sharp, it still matters, but the big picture hasn't changed, and there's still work to be done, I think, before we can say this bear market's over.
Andrew, to Lisa's point, we've priced in a big rate hiking cycle. Maybe we haven't started to price in the consequences just yet. What do you think the consequences will be, and can we put some numbers on it? I hear this short, shallow nonsense all the time. I have no idea what it actually means. Andrew, what do you think it means?
Well, I think it means that you could see a downturn that matters a lot more to earnings than it does to GDP. That we've been through an environment where goods consumption has soared relative to services consumption, you know, the type of economy where kind of everybody buys a barbecue and nobody goes to the dentist, so to speak. And, you know, that's a type of environment that is generally good for earnings. The S&P 500 global equities are really good at monetizing goods and turning them into earnings. They're a lot less good at monetizing services and turning those into earnings. So I think you could have an environment, if you look at those consumption series, where, goods demand comes down, services demand holds up pretty well. The overall GDP effect is pretty modest, but ultimately the earnings impact is larger. And to be more specific, housing is so important to goods demand. Think of it, every time somebody moves, people buy furniture, they buy electronic goods. There's a lot of stuff that gets bought in a housing transaction, and yet given this move in rates, we're seeing housing transaction volume really decline, to some of the sharpest deceleration we've ever seen.
How much are long dated bonds the best haven right now if people are starting to think that perhaps we're pricing in peak Fed, we're pricing in a Fed that gets as aggressive as we've seen for decades?
Well, I do think you've seen more value come back into the long end of the market, but again, I think you also have some challenges there where you're dealing with a pretty high vol asset class, and I think there's some really legitimate uncertainties around where kind of new neutral rates are going to be, and also where, what is the type of kind of real interest rate that's required to slow the economy, and I think we still kind of don't really know that. And I think there's a genuinely large cloud of uncertainty out there. So I think it's probably still a little bit too early to kind of go into the very long end of the curve. But, one asset class that we think has a good kind of risk reward combination here would be something like 1 to 5 year corporate bonds in the US. They yield about 5.5%. That's not that far away from the earnings yield of the S&P 500. And as an asset class that we think can still provide, some pretty decent income, above what we think inflation is over the next 12 months, while still providing some ballast and less volatility than other things.
Andrew, just one final question. The number that jumped out for me in your latest report, Mike Wilson's from over the weekend, was just how far you think this bear market rally can go. Something like 4,100. Now, Andrew, that's a big monster move higher. And Andrew, I wonder, when you look at that, at what point would you look at it and say, oh, maybe we're not right about this. Maybe this is more than just a bear market rally. What would tell you?
Sure. So I do think the inflation numbers are very important. If we see positive surprises to inflation, there is a lot of good that can come from that, right? Then the market can start to think maybe the Fed doesn't need to do so much. Maybe we can start to see the Fed backing off, and that relieves pressure from rates, which can swing back into equities. I think seeing labor force participation continue to climb, that would be quite good, suggesting the supply side of the economy is stronger, that we can have more growth for a lower level of inflation. And then on the earnings front, a reason why we've been cautious has been around the view that margins will come down ultimately, and earnings estimates will come down. Maybe the inventory problem is better than we expect. Maybe companies are able to defend margins through cost cuts that don't impact the broader economy to such a negative extent. And I think that's where the bull case lies.
Okay, Andrew, you and the team have just been absolutely awesome this year. Appreciate it, as always. Andrew Sheets there of Morgan Stanley. Appreciated what Andrew had to say there. Drew a distinction between GDP, short and shallow, and earnings, maybe not short and shallow. Tom, there's a difference.
Well, there is, and I'm going to go back to this on the revenue dynamic and down the income statement. You can choose it, and it's different sector to sector what happens on the income statement, but they're going to adapt, as Mr. Sheets talked about at the end there. It's going to be one part pricing power, which we all know, and it's going to be one part cost cutting. And you know what? They're going to get to the other side.
Drew Madison MetLife writes in on the Bloomberg. Lisa, he says short and sharp, not shallow. That's the pushback.
Yeah.
Get a lot of.
Well, and this is sort of the economic play, but just going to what you're talking about with earnings, how much, going back to what Steve Rasciuto said, do we have to reset corporate performance and the earnings in a 2% Fed funds world? If that's where we're heading back to, it's not a 0%, it's 2%. How much do you take away from the momentum of the financialized world and potentially give back to the real economy?
BofA's fund manager survey today, the theme of it was capitulation. And if we can push that just one step further and build on what you just said, I don't think people have capitulated at all.